Okay, good morning, my dear future child accountants. The future child accountants are reduced further. Anyway, that's the nature of profession. We'll do our job. Let's continue to the next standard, which is Ind AS 23, borrowing cost. So, what are the major elements of this? Let's take a quick overview. Borrowing cost, we don't limit ourselves just to interest. We will consider many other elements such as amortization, even to the extent of foreign exchange difference also will be considered as borrowing cost. We'll look at that what is foreign exchange difference in a while. We have two types of borrowing. If you have a particular loan taken for a project, it's called a specific borrowing. We take the specific interest rate. Or if you take many borrowings, it's called as general borrowing, and we are going to take an average rate. The numerator will be total interest, denominator will be total borrowings. The accounting treatment, you will capitalize the asset. You will capitalize the interest expense, provide the asset is a qualifying asset, and qualifying means it should be substantial period to get ready for use. And normally we say 12 months, though it is not a compulsory phenomenon. So qualifying asset basically means generally interest cost is not part of any cost of the asset. Even if you know the costing, when we prepare cost sheet, cost of a product, interest expense will not be part of the asset. But when the asset is taking substantial period, so much long, then even interest we consider as a essential element of cost. Therefore, we capitalize it. So even CA is an asset because you know you are called as qualifying after passing exam, and it will take substantial period, maybe substantial period to get ready for use. Again, the point is to get ready for use, not the asset put to use. In all other situations like loan taken for working capital purpose or any for purchase of machinery and all, we mean that asset is already ready for use. In those cases, expense will be charged off. And we will suspend temporarily if active development is interrupted. For example, if you are constructing a building and there is a court stay that you cannot continue the construction activities until the activities are resumed, the capitalization process should be stopped temporarily, and then that period expense will be taken to P&L account. What is this exchange difference read with AS 11 or Ind AS 21? It's part of accounting standard as well as AS. The concept is you know in general when you take loan in India you have to pay more interest. When you take loan in USD terms you will have a lesser interest. But if you remember, when there's one theory called as parity theorem, interest rate parity theorem, which says that even though you save interest but you lose in one way because the exchange rate will be higher. Therefore, when you pay exchange rate, even though you are calling it as exchange difference, but in substance it is to be reported as borrowing cost. So how are we going to calculate is this? You calculate the interest on Indian equivalent rupee loan as if had you taken the loan in India, that is US dollar multiplied by the opening rate multiplied by the Indian loan rate. That will give you the interest had you taken in Indian rupee terms, and you compare it with the actual interest, the saving, what you think is saving, it is not saving, it is reported as borrowing cost. If exchange difference on the loan is anything beyond that, that excess you can call it as exchange difference under Ind AS 21. This is the brief summary of the standards. Let us understand more by doing problems. Yes, please. No, there is no exhaustive list. They just use the word active development is interrupted. So asset should not be in progress. So they also standard also use the word if it is a temporary nature, then you need not stop it. You can continue to capitalize. See, for example, when you are constructing activity, you might see some rocky surface and you have to wait for some time. It might delay the process, but they are necessary. So COVID also, there is a lockdown 21 days, 1 month. So if you have to answer in one answer yes or no, I cannot do it. But what I would recommend if this question comes in exam, if it is not substantial, that is lockdown happened, for 21 days, 20 days, and then some activities were allowed to resume the work. In that case, I would consider that 2-3 weeks or 1 month as a temporary phenomenon. I will continue to capitalize. But if the activities are stopped, in the sense laborers are not coming, they are not allowed, and we are not getting the funds, we are stopped for 3 months, 6 months, in those cases I will not take it as a temporary phenomenon. I will take it as a interruption, and capitalization is suspended. So if it is a temporary phenomenon, you will continue. If it is a substantial phenomenon, it's recommended to not to capitalize. A company deals in product of dairy products. It prepares and sells various milk products like ghee, butter, cheese. First of all, you don't have anything and you go to exam hall and they make you, or they then tempt you with these terminologies. The company borrowed funds from bank for manufacturing operation. The cheese takes substantial longer period to get ready for use. State whether borrowing cost incurred to finance the production of inventories that have long production period be capitalized. This can be cheese, or this can be a wine company which substantially take longer period of time. AS 16, this point was actually addressed, and even inventory was part of qualifying asset. As per Ind AS 23, repetitive inventory, that is the word they use. If it is repetitive inventory, meaning in the regular course of business, the interest part is not considered as capital. I mean, it's not called as qualifying asset. So in a repetitive basis, the capitalization is not allowed. But in case if this was a specific special request, a software company might develop a customized product. A construction company might construct for requirement as a one-off scenario. It's not a repetitive inventory. It's a specific request. It's out of your regular course of business. In those cases, you can capitalize it. So the word used again to be remembered is repetitive inventory, meaning what you do in a normal course of business, that interest element not capitalized. That is fine. That is not capitalized. If you get a request from a customer to build something which will take 2 years for that particular customer's request, so you don't do it for every customer. It's a one-off exception scenario. Those cases you can capitalize. Alcohol also you cannot capitalize. For alcohol company, that is your normal course of business. You keep producing. It will take 2 years, 3 years. Still fine. It will not be capitalized. So basically, they are trying to tell qualifying asset means something which is not ordinary. It should be something exceptional. A company is in the process of developing computer software. The asset has been qualified for recognition purpose. However, the development of computer software will take substantial period of time to complete, especially when you give it to preparation of income tax website to a company like Infosys and all. I don't know whether you've seen what and all happens. Yeah, that's what they're trying to tell. The development of software takes substantial period of time to complete. Can computer software be termed as qualifying asset? Yes, there is no exception that intangibles cannot be qualifying asset. None of those things. So it is a qualifying asset. Is the management intention considered assessing whether asset is a qualifying asset? Yes, management is considered to refer regarding the word substantial asset, substantial period also, and also that whether ready for its intended use. We have to take the period till it's ready for intended use. So not just ready for use, ready for the intended use and purpose. So what is the intended use? Only management should tell. Otherwise, people can use the asset for different purposes. We cannot take that into consideration. Only the purpose as defined by the management. For that purpose is the asset ready. Not only in this standard, the same principle apply for Ind AS 16 property, plant, equipment as well. Asset ready for intended use. That is the point management should definitely decide. A telecom company has acquired 3G license. The license could be sold or licensed to third party. However, management decides to use it to operate a wireless network. Development of the network starts when the license is acquired. Should the borrowing cost on the acquisition of 3G license capitalized until the network is ready for its intended use? Back to our regular question, the asset should uh, be capable of being used. I know it can be sold or licensed. So when we say qualifying asset, we should, again, as we just discussed, it should be used for the intended purpose. The fact that it can be used cannot be the answer. Now in this case you have used the license. I mean, you have acquired the license, but can you start using? Can you start using it? They want to use it for their own purposes. They want to distribute. They want to use their own services. The management intends to use to operate the wireless network, and the development of network starts when the license acquired. So unless the network is complete, you start giving services, it is not ready for the intended use. So until then it will be capitalized. Of course we have to assume that it is a qualifying asset. I mean, we should assume that it takes substantial period. That is not given in the problem. If this question comes in the exam, you say that if it expected to consider a substantial period, and then this also will come under qualifying asset, because until the network equipments are ready, it cannot be used. So how much ever knowledge you have, until you pass this examination, you have a certificate, you cannot say in the balance sheet. So until that point in time, your knowledge is still not ready for use. So all the equipments you have, all the licenses you acquire, is not ready for use until its intended purpose can be applied. On 1st of April 2001, A Limited took a loan of 8% loan for 50 lakhs for the construction of building, which is repayable after 6 years. Okay, loan period is after 6 years on 31st March 2007. Yes, 2001 to 2007, 6 years. The construction of the building was completed on 31st March 2003. A Limited started constructing a new building in the year 2003-4. You took the loan in 2001 and the construction started in the year 2003. Construction completed in 2003. Oh, you started a new building. Okay, fine. New building on the year 2003-4. So they took 2 years, complete one building. Now they're starting one more building, for which he used the existing borrowings. He has outstanding general purpose loan of 25 lakh. Interest on which is payable is 9%. And 15 lakh interest on which interest payable is 7%. So there are 3 types of loan. One is 8% loan, specific borrowing. Then 9% loan and 7% loan. These are general, not specific borrowing. Is the specific borrowing transferred to general borrowing pool once the respective qualifying asset is completed? Yes, definitely. You take a loan for a particular purpose. Once the purpose is fulfilled, then it will be under any other general borrowing. Yes, it will be transferred. So on the first building, I hope it takes asset is complete 2 years. So 50 lakh into 8% into 2 years, that will be the amount of interest capitalized on the first building. But for the second building, what we should do, we should take the average rate. So 50 lakh into 8%, 25 lakh into 9%, 15 lakh into 7%. So that total interest in the numerator, denominator total loan 50 lakh plus 25 plus 50, that's at 80 lakhs. Then you take the average rate of interest. And they have not asked us to calculate. The only question is, will it come to the general pool once it is served its purpose? It is yes. If specific borrowings were not repaid once relevant qualifying asset is completed, then they become general borrowings as long as they are still outstanding. The amount is still to be payable. So borrowing cost eligible is capitalized by applying rate on qualifying asset. The amount of borrowing cost eligible is limited to the actual borrowing cost. Okay, this is a regular thing. You will take the average cost. The average cost is applied on the amount spent on qualifying asset, and the amount capitalized cannot exceed the actual amount being paid. Those are the general points. Okay, this is also not that difficult. Okay, let's go further. Let's take the next one. Let's see, at least here some calculation is required. An entity construct a new head office building commencing on 1st September, which continues till 31st December. So only for September, October, November, December, 4 months. Directly attributable, no, not even December, yeah. Directly attributable expenditure at the beginning of the month in the assets is 1 lakh in September and 2,50,000 in the months of October to December. So 1 lakh and 2,50,000, total 3,50,000 you can say. The entity has not taken any specific borrowing to the finance the construction. The asset has incurred the finance cost on its general borrowing during the construction period. During the year, the entity had issued a 10% debenture with a face value of 20 lakhs and overdraft of 5 lakh, which increased to 7,50,000 in the December 2001. Interest was paid on the overdraft at 15% until October. Then the rate was increased to 16%. Calculate the capitalization rate for computing the borrowing cost in accordance with Ind AS 23 borrowing cost. So the requirement is not to compute the borrowing cost to be capitalized. It is just the rate, the average rate. So numerator we are going to calculate the interest. Denominator is going to be the total loan. Okay, so what is the interest paid? You took loan of 20 lakhs. During the year, entity issued a debenture with the face value 20 lakh and interest is 10%. We will take it from September to December. Corresponding period means September, October, November, December for a period of 4 months. So it will be 20 lakh multiplied by 10% multiplied by 4 months. 66,667. Yeah, that is the first amount. Then overdraft, which was a 5 lakh, rate of interest is 15%. To which month? Overdraft was 5 lakh, increased to 7 lakh 15 December. Okay, last month higher overdraft, and 15% until October 1st. So until October 1st means we take September month. So only 1 month it will be 5 lakh into 10% into 1 by 12. 15%, sorry. 5 lakh into 15%. 10% was debentures, right? Correct. 5 lakh into 15% for 1 month. I think 6250. Then September over, October, November. You still have amount is 5 lakh, but rate of interest became 16%. So 5 lakh into 16% into 2 by 12. October, November. Hope you're getting this. 5 lakh into 16% into 2 by 12, 2 months. October, November. Then December, the amount is increased to 7 lakh 50, rate of interest 16 only. So 7 lakh into 7 lakh 50,000 into 16% into 1 by 12. So which means 7 lakh 50, no, you have to, they meant the balance, average balance. The balance was 5 lakh for 2 months and last month the balance became 7 lakh 50. So the last month 7 lakh 50,000 into 16% for 1 month into 1 by 12. 10,000. So total interest is 96,250. In the denominator also we should, I mean in the when you calculate the interest denominator also we should take the proportionate number of months. That's why they said for 20 lakh they took 4 months. Then for 5 lakh they took 3 months, that is September. Only 1 month, anyway, does not matter. 5 lakh was there throughout this, so they have taken 5 lakh into 3 by 12, and only for the last 7 lakh 50,000 they have taken only for 1 month. So this is the denominator amount after taking it to the number of months correspondingly. So 96,250 by this amount outstanding, you get the construction period. So the point to be observed here is numerator you calculate interest into the period. The same thing you apply for denominator as well. The interest as well as loan both should be correspondingly for number of months. Yes, please. into number of months. That's correct. The person, because sometimes you might feel anyway we have taken the number of months, should we take it again? This percentage is per annum basis. This percentage what we calculated is per annum basis effectively. So when you calculate on expenditures amount spent, they have not asked, I would have applied on this number, right? On the this number, expenditure on the asset is 1 lakh and then the 2,50,000 each of the months. So on 1 lakh you are going to apply 3.756% for full 4 months. Then you incur 2,50,000 in next month, you apply only for October. If you spend beginning of October, November, December into 3 by 12. Then November again you spend 2,50,000 into 2 by 12. December again beginning you spend into 1 by 12. So that will be the process for you to capitalize the interest cost. So in each step the number of months impact should be taken into consideration. Okay, so this problem is actually slightly controversial in the sense I have little bit of different opinion maybe, but we'll read. This is not come in exam, but it added in the previous version of study material. In a group company, in a group with parent company P, about the consolidation again, there are 3 subsidiaries with the following business: A real estate company, B construction company, C finance company. Parent company has no operating activities on its own but performs management function for its subsidiaries. Financing activities and the cash management in the group are coordinated centrally. Finance company is a vehicle used by the group solely for raising finance. All the entities in the group prepare Ind AS financial statements. The following information is relevant for the current period 2001-2. Real estate company, borrowings 10 lakh, interest of 7%. Expenditure on qualifying asset during the period amounts to 15 lakh 40,000. So if at this point in time we read, on 15 lakh 40,000 you have taken borrowing of only 10 lakh, so on 10 lakh 7% that would be capitalized. All construction works performed by construction company. Construction company is the same group company. Okay. Amount invoiced to real estate company included 10% of profit margin. So construction is done by company A, which is real estate, and amount invoiced to real estate company included 10% profit margin. Okay. Then constructing company, company B. So who is constructing actually, company B or company A? All the construction were performed by construction company means company B. So it is like, if you think of a group, it is like a interdepartmental transfers. Company A is the acquirer or asset coming in, and for company B it is the asset given out, sales. Include 10% margin. So when you prepare the group accounts, that profit margin should be adjusted. Construction company, no borrowings during the period. Financed 10 lakh of expenditure on qualifying asset using its own cash resources. So construction company through its activities generated 10 lakh and spent on qualifying expenditure through own cash resources. So they have not taken any loan. No borrowings, no loan. Finance company raised 20 lakh, 7% per annum externally. So finance company has taken loan and issued the loan to parent company for general purposes at the rate of 8%. Parent company used the loan from a finance company, what we have just read now, and that is the loan is taken to acquire a new subsidiary company. No qualifying asset apart from the real estate company and reconstruction company. Parent company did not issue the loans to other entities during the period. What is the amount of borrowing cost eligible for capitalization in each of the 4 entities, individual as well as parent, for the period ending 2001-2? Let's take the easier one first, which is construction company. Construction company has no borrowings, so there is no question of any interest to be capitalized. What about the finance company? Finance company has taken loan, true, but their objective is to give loan, and when they are giving loan, that is not asset, that is not a qualifying asset. That asset is substantial period to get ready for use. So for finance company there is no expenditure, and on construction company there is no interest. So the two things are easy. Now coming to real estate company. Real estate company has taken a loan of 10 lakh and they have spent 15 lakh 40,000. That is a different issue. They have taken loan of 10 lakh on that 7%, so should be 70,000. Yes, 70,000 is the interest capitalized in the real estate company. The confusion will come regarding the consolidated financial statement, because one company has charged interest also, I mean the profit also will transfer, so can we capitalized on those numbers? Okay, let's see what the consolidated annual statements have taken. Let's read. General borrowing of the group 10 lakh 20 lakh, is that correct? Let's check it out. One borrowing is this 10 lakh. One, this finance, this is a one source, this will not take it. And 20 lakh which the finance company has taken. Now when two companies take loan, that means group also has taken loan. So 20 lakh also is our loan, 10 lakh is also our loan. That is 20 lakh and 10 lakh. Okay, now what is the total expenditure for the group? On 10 lakh 7%, on 20 lakh 7%. Oh, both are 7%. So 30 lakh on that 7%. So 2 lakh 10,000. The total expenditure on qualifying asset are added up. Profit margin charged by the construction company is eliminated. So what is the amount of the expenditure? Is 15 lakh 40,000, and 15 lakh 40,000 includes the 10% margin. So if I say cost plus, it will become 110%. 100 cost, 10% this, 110%. So 15 lakh 40,000 into 10 by 110, or you can do into 100 by 110, will get cost of 14 lakh. And the construction company, they have borrowed 10 lakh. So 14 lakh is the real cost, and construction company's cost is 10 lakh. So the expenditure they are telling 24 lakh. Does it make sense? 10 plus 24, 10 lakh is the borrowings, and 14 lakh is this. Construction company, the 10 lakh expenditure on qualifying asset using own resources. Now this is not a borrowing, but this is an expenditure. So there are two things. One is source, one is application. The source, the loan what you have received are real estate company has taken 10 lakh loan, and this finance company has taken 20 lakh loan. So 30 lakh is the loan taken, that is a borrowing. And money utilized in generation of an asset is construction company has spent 10 lakh, that is also amount spent, and the 15 lakh 40,000 is also amount spent, but 15 lakh 40 includes the interdepartment, I mean the transfers between companies, unrealized profit you eliminate, that comes to 14 lakh. So the amount of borrowing is 10 plus 20 30 lakh, but the amount spent is 10 lakh plus 14 lakh 24 lakh. So the capitalization rate they have applied on this 24 lakh. The total interest expenditure of the group higher than the borrowing cost eligible, therefore you have to limit only for 1,68,000. So what is the cost which is incurred? 30 lakh into 7%, which is 2,10,000 is incurred, but what is eligible is 24 lakh is the amount spent. On the amount spent, 7% is 1,68,000. So whichever is lower, basically the amount capitalized cannot exceed the amount which is eligible. So though you incurred 2 lakh 10, eligible is 1 lakh 68, the balance amount we'll have to charge it out to P&L account. So this is what about this. Again, this can be calculated slightly differently. I mean, little bit of mathematics if you want to apply. You can do like this. You have I mean this one. You have taken a loan of 10 lakh, which is incurred towards 15 lakh 40,000. But out of 10 lakh, only 14 lakh I can capitalize. So should I do like in proportion of 14 lakh and 1 lakh 40,000? That will be complicated, but in my view that is also can be a way of calculation. But anyway, I don't recommend you to go with that method. So ultimately, summary of this problem is this: as far as real estate company is concerned, they have spent 10 lakh on that 7%, you will capitalize. Construction company from own resources, nothing capitalized. Finance company, they don't have qualifying asset, therefore it is not capitalized. Regarding the parent company, you compare two things: what is the loan taken and what is the loan, I mean what is the expenses incurred. Loan taken is 10 lakh plus 20 lakh 30 lakh. Utilized expenditure 10 lakh here and 14 lakh after eliminating the expenditure. So you calculate the interest on the loan, and interest eligible you take whichever is lower. One more point may arise: what about this 8%? Because they have taken loan at 7%, given the loan at 8%. So 1% profit they made. But that 8% is a payment for the finance. I mean, for finance company, it's income, and for a other company, it will be a payment. So that 8% will be set off in the consolidation process. So if you prepare the group, 8% will not have any place to report. So that 8% will not have any roles. Again, mathematically, it can be done in different ways. I think from exam point of view, this much is sufficient. Maybe this is important in my opinion, because it is having multiple companies and consolidation. That's what institute keeps looking. Wherever that opportunity is there, can I include consolidation? They will look for that kind of problems. And especially when there's something is added in the study material and not yet come in examination, that is having very high chance of being asked. So according to me, this is important problem from exam point of view. So they calculate easier. We have to calculate separately in the sense we take this number. How do we apply it here? In this case, it was 700. We'll take the average rate because two loans will be there. We take it as a not a specific loan. We take it as a general borrowing, and general borrowing we take the average rate. That would be the case. Okay, so anything else in Ind AS 23? And again, please remember, interest when we capitalize, it is not the simple interest. We always go with anywhere interest in this standard, in this Ind AS means effective rate of interest, compounding interest. Even the interest what you show under lease, if ROU asset is yet to be ready for use or something, even that can be capitalized instead of taking the interest expense to P&L account. So they don't restrict only to the actual interest paid, any sort of interest expense recognized. So does it mean preference share dividend, the dividend also can be taken as borrowing cost? Preference share dividend we take it to P&L if the preference share in the nature of debt. Yes, that also can be capitalized. Because for us, preference share is not preference share. For us, preference share is borrowings. So dividend is not dividend. Dividend is us interest for us. So it is capitalized. Of course, if it is in the nature of equity, we don't take it into consideration. We don't capitalize. But only thing they have not gone mad to that extent is the on equity share capital also there is an opportunity cost. Should we capitalize that? They have not gone mad to that extent. It is only till the interest element or in the nature of interest. That's the beauty of this standard. The interest may be under exchange difference, Interest may be finance cost in leases. Interest may be finance cost in employee benefits, in different standard. As long as it is in the nature of interest, it will be covering under this standard. And if it is qualifying asset, you will capitalize. This very small standard, but somehow I like this standard. This one and deferred tax in standards also have little bit of favorites. Anyway, let's go further. This standard intangible asset is again part of your carry forward from your previous life, AS 26, but that is having vast difference with respect to Ind AS 38, because Ind AS 38 is a replica of PPE. So the rules what we discussed in PPE, we discussed yesterday, long time back, hope you remember it. We had like cost model, revaluation model, depreciation, revaluation reserve. When you revalue upwards, you take it to revaluation reserve. Revalue downwards, you take it to P&L. Subsequently, if you reverse it, the previous loss should be adjusted first, then only you take it. All those rules is applicable here as well. And the revaluation reserve, you can transfer it to retained earnings in the year of derecognition of the asset, or to the extent of additional depreciation, you can take it to the retained earnings as a free reserves. The rules, those rules, and two methods of creation of revaluation reserve. One is proportionate method or elimination method. All those things is as it is applicable to this standards. Some special points are there, only that one let us focus on. First point first, that is what is an intangible asset. Intangible asset is an asset, first of all, means it's a resource controlled, having future economic benefits, result of past events. That is where it perfectly suits. Even our CA degree is an intangible asset. But only problem is it cannot be recognized because CA degree don't have reliable measurement of cost. The cost cannot be measured, so I cannot take into my books. If CA prepares books of accounts in my asset side, I cannot write CA degree, even though it is generating so much of resources. Intangible asset means it should be identifiable, means capable of being separated. Separate in the sense it should be capable of being having some use. Goodwill cannot be separated, but it can be converted. It, as a part of business, you can sell. Brand, as a part of business, you can sell. Franchisee, you can sell. Non-monetary asset, meaning it is not monetary. Monetary means having a fixed or a determinable amount, like debtors, bill receivables is monetary. Inventory, investment, share capital, reserves and surplus, these are all non-monetary. Fixed assets non-monetary because these things don't have a particular value. It's not fixed amount. That's why it's non-monetary. Approximately we show it in our balance sheet. Examples of intangible assets are numerous. This point will be everywhere. Resource control, the ability to get FEB, future economic benefits, and or you can restrict others. In case of patents and franchisee or license, when you have, you can restrict others from using the asset. That is also a resource controlled by you. Typical exam question is this: if training is given to employees, is it an intangible asset? It satisfies the definition. Yes, it has future economic benefits, but it cannot be controlled by the entity. The knowledge cannot be controlled by the entity, and therefore it does not satisfy the recognition criteria. Agreement is what? Agreement for employment, not for use of knowledge. The agreement is employee will work with us. The agreement is not that he has to use the knowledge. That knowledge cannot be controlled. How it is to be put to use. From the knowledge, the resource, we cannot generate it. And that knowledge, how to put to use, we cannot control it. And therefore, it is not intangible asset on the recognition principle. And that's one of the reason why. Anyway, we will come to those points a little bit later. I'll explain that as well. So it's a non-monetary asset. That is a major point of it. Apart from that, if you acquire as a separate acquisition, yes, you take it as part of normal rules what we discussed in PP. Any expenses incurred attributable to acquisition up to the point asset ready for use is capitalized. You may say installation expense, non-recoverable duties and taxes, insurance, transportation, foreign exchange clear expense, any expenses incurred up to the point asset ready for use, just like in case of PP is applicable here as well. As a part of business combination, usually all the assets are recognized at fair value. As part of business combination, only goodwill will be a balancing figure. By a government grant, if it is at non-monetary, I mean free of cost, you can recognize the grant at non-monetary, or you recognize the asset at fair value, and you recognize the fair value as the government grants. Entry will be like intangible asset account debit to government grant to the extent of fair value if something is free of cost. Internally generated goodwill cannot be reported, recognized. For the same reason, it does not have reliable measurement of cost, and therefore expenses such as heavy advertisement expenditure, marketing, sales, promotion is not capitalized. Under any circumstance it is transferred to P&L account. And any expenses acquired subsequently to the date of acquisition is charged off to P&L. For example, amount paid as legal charges to defend a suit, it will be expense. But during the course of acquisition of patents, before the patent is being acquired, if there is any court case going on, that can be capitalized, because that expense is before the asset is ready for intended use. But once the title is in your name, after 5-6 years somebody file a case to defend the title, you pay some expenses, they are in the nature of repair expenses, will be transferred to P&L as expense, not capitalized. Exactly like a PP. If you purchase a second-hand machinery, you do all those tinkering, painting, that will be capitalized. But once the asset is in use as a day-to-day maintenance, servicing, 2-3 years later you spend any money, that will be expensed off. The same logic process applies here. The extra thing which comes in intangible asset is internally generated assets, intangibles, which is basically like patents, or we say that research and development expenditure. Let's take a look at that. R&D. Yeah, franchisee fees you acquired having a period of 5 years, you pay extra to renew the period till 3 years. Extra 3 years you can capitalize, as long as again it has a future economic benefit subsequently. Cost can be measured, future economic benefits can be established, expense can be capitalized. So in that sense, this standard and PP are replica. The principles are same, the terminology is different. There we use the word depreciation, here we use the word amortization. Only one more small point will come. In case of PP, the residual value is not a constraint, we can estimate it. But for intangible assets, if you want to have a residual value, you need to have some sort of market, some sort of evidence, because intangible assets are not visible, right? So it's very easy to manipulate. So when you want to have a residual value for intangible assets, you have to demonstrate the market somehow. And again, the amortization thing should reflect the future economic benefits. Once the asset is held for sale, amortization is stopped, it will go to Ind AS 105. Those rules are repeatable here. The only thing I told you, residual value, you need to have a commitment by third party, otherwise residual value is deemed to be 0. And asset useful price should be revalued. All those things are there. The only extra point which we will address is regarding internally generated intangible asset, that is research and development. Research expense is the expense incurred with the objective of gaining knowledge where the output is not guaranteed, output is uncertain. In those cases, we will charge it off to P&L. Development expenditure is where you start applying things. Expenses will be capitalized. Of course, you should demonstrate the technical feasibility, the intention to compete, the market for the product, and the future economic benefits, or the ability to measure all the costs directly attributable, labor, material, overheads, testing, all those things can be capitalized. This is very popular, I would say, in two companies, two industry. One would be pharmaceutical industry, other would be software industry. In those two cases, in examination also, the questions will be revolving around these two industries. But interestingly, some companies, pharmaceutical companies, I've seen their marketing expense is more than their research expense. You should look at their P&L account to believe it. But that is a fact. The general expenses, admin, selling, overheads are not capitalized. So understand the difference between research and development expenditure. And once it is a research expense, subsequently, if it qualifies as asset, what is taken to P&L account will not be withdrawn. Once taken to P&L as expense, that will not be considered as asset later. It will be taken as asset in only in one situation, in case of business combination. In case of acquisition, if the asset satisfy the definition of intangible asset, then that will be part of business combination taken on fair value basis. But the words are very interesting, because in general we always use the word research and development interchangeably, R&D, but for our accounting purpose it is different. Research and development is as different as difference between your knowledge and application. Knowledge is knowing that tomato is a fruit. Application is don't put that in fruit salads. Knowledge a good chart accountant is the one who knows Income Tax Act. The great chart accountant is the one who knows income tax officer. So that is what the difference between a research and development actually comes to. If you have good knowledge about the cricket or any game, you can't become a good player. At best, you can become an umpire. But for you to become a player, you should know how to apply. That's again, this is a point very easy to explain, but practically to apply this is not so easy, because when you interact with the management, how will you tell them you are spending this money, but we don't know whether you get the benefit or not? They will prove the point. No, we get the benefits. So according to them, everything is same, R&D. Only accountant, we have to convince them, no, research expense means the result is not established. And we being, our blood is full of prudence principles. Unless something is established, I cannot take it to the balance sheet. Fortunately, unfortunately, I'm also doing the financial management side, because I do valuations. So what I do, when I prepare financial statements, I charge it up as expense. And when I'm valuing those company for brokerage houses, those expense I will add back. I will capitalize, because as an investor, I am not in prudence principle mindset. I am looking at the realistic things. So these assets also will be capitalized, and then I'll appreciate, and accordingly I'll do valuation under various approaches. Anyway, this is the important points regarding the research and development on intangible assets. Let us take a few problems. PQR Limited, a gaming developer company, listed company that you know, who develop games. Anyway, there is quite a few companies where Rakesh Jhunjhunwala is also invested, developer game. There is also a casino which is listed. We know only to play in casino, but do you know a listed company which is running casinos? So if you don't want to play in casino, become an owner of it, buy the shares of casino. The company name is Delta Corp. Anyway, few years back, it developed a new game called as Cloud9. Maybe that IPL, some new things and all will come here. That's the best part of our advertisement, right? They'll give advertisement like play that, what is that, IPL games, the Dream 11. And for the 6-year-old, they come advertisement, learn coding. For the age-old people, we should do IPL gaming. I don't know. The game sold over 10 lakh copies around the world and was extremely profitable. Due to the popularity, PQR Limited released a new game in the Cloud9 series every year. The games continue to be the bestseller, maybe PUBG or something. Based on the management's expectation, estimates of cash flow projection to the Cloud9 video game series over next 5 years have been prepared. I mean, I'm just reading, I'm getting an idea like, why don't you prepare a game where there is different levels on accounting standard, on Ind AS, on Companies Act, on this. Like you answer, you go to next level, or you some section is coming, you shoot it. I'm just getting an idea. I think somebody will prepare. I have no idea. Is nobody's universe. Okay, but maybe some games can come where everybody you can enjoy as well as you can learn new things. So you keep answering things. You go to the second level, subsequent level. Is there? MCQs, but game. Look, no, not like a game kind of thing. Like you have game means you have to be that you have to feel that you are shooting somebody, and the question is there. Like you have five weapons. If you want one extra weapon, you answer this question. Something like that. Okay. Yeah, PUBG will come where ICA will be there inside. CA president will be there. Your boss also will be there. Different companies' boss will be there. Anyway, the games continue to be the bestseller based on the management's expectations. The estimation of cash flow projection to the for the Cloud9 video games over next 5 years have been prepared. Okay, so they have projected for next 5 years. Whenever the number inverts, I would say that would be important information. Based on these projections, PQR Limited believes that Cloud9 series brand should be recognized at 20 lakhs. Where that number suddenly coming? PQR Limited also paid 10 lakh to MNC Limited to acquire the rights of another video game series called Headspace video game series. This series have huge demand in the market. Discuss the accounting treatment of the above financial statements of PQR Limited. It has future economic benefits, but is the reliable measurement of cost? That's important recognition criteria. They have developed new games. So when you develop the new games, what you can capitalize, yes, you can capitalize, but that is restricted to the cost. The profit element cannot be recognized. Here also Ind AS that PPE also. Suddenly they're coming up with the word 20 lakh. I'm not sure where it is coming from. It paid 10 lakh to acquire the rights. That may be considered as intangible asset, may be amortized, but not the internally generated game. If you want to capitalize, you can do only to the extent of cost incurred, but not the profit element. So what the standard says, they talk about the definition. Asset is a resource. Intangible asset means this. Regarding internally generated intangible assets, some paragraph is there. The cash flow projection will lead to future economic benefits. In order to determine whether meet opposite conditions, the following provisions is there. The price the entity pays, that is for separately acquiring an asset, that is not applicable here. So the entity expects there to be inflow of economic benefits even if there is uncertainty. Therefore, probability recognition criteria, paragraph 2 is considered satisfied. I don't know why they talk about these things. Separately acquired intangible assets. That is not at all relevant here. But anyway, maybe for 10 lakh point they are telling the amount paid to acquire the rights. The Headspace has purchased 10 lakh and it is expected to generate benefits. Intangible assets should be recognized. Yeah. So the 10 lakh will be recognized. The internally generated assets you can capitalize only if you have only to the extent of cost. But if we don't have information on cost, so we don't capitalize that much, but only the amount paid 10 lakhs that is separately acquired assets will capitalize. So in the examination you should talk about two terminologies. The first case is all about acquired assets where the economic benefit is assumed. The second one is internally generated assets. You have to establish the benefits and then it can be capitalized only to the extent of cost incurred. So that those two terminologies you have to use: internally generated assets and acquired assets. Yes, please. Can they capitalize what? the cost that you are incurring to develop the game, you can capitalize as long as the asset has longer benefits. If that video game you're expecting is to be there for next 4 or 5 years, and this cost definitely can be amortized over a period of 4 or 5 years. But normally in video game business, what happens is things become so fast outdated. So it's very difficult to establish a longer horizon of economic benefits. Or you can also prove that this game what we developed, we can transfer it to others. That also we can capitalize. Again, this standard is very easy to explain, practically very challenging to apply. If I ask the question, I'm preparing PPT, can I capitalize this cost? The effort put in to prepare a PPT, can it be capitalized? Okay, I am doing it for myself, I may not do it. Let's say I am paying somebody and getting the animations done. I'm paying the money as consultancy, whatever you call it. So that I can capitalize as what? Assets. Can I sell this PPT to somebody else? So that I cannot give one answer for PPT in general. Actually, the question of PPT is specific, but within it also what purpose? I've seen so many websites where they sell PPT only. They make the animation, predefined animation. You just have to put in a proper place, especially for investor presentation and all. People do it. More than PPT, Excels. There are so many Excel defined formats where people sell. Even the income tax website, not this year, earlier year, they used to give Excel utility. So they would have paid and acquired that Excel. So should those be capitalized? Should those be intangible assets? So many gray areas will be there. It's easy to discuss in exam and classroom scenario. Practically, this is having very challenging approach, especially the internally generated intangible assets, for the reason these days the generation is intangible assets. The companies with tangible assets are easily to replicate. I have machinery, I have building, somebody else will start with machinery and building, because capital is not a constraint. It is mobile. The moment of capital is mobile, is throughout the world. Anywhere you can generate the money. Intangible asset is where you cannot replicate so easily. Why Facebook don't have an alternative? Because you cannot build one more Facebook so easily. You cannot build one more Google so easily, and they work, they thrive so that it is not substituted so easily. So the intangible asset is a big business or big element in the real life, not only for companies but also for individual as CAs. Ultimately, it's our brand which is being sold. Either your work or you're in office, ultimately you are branded as CA, and your CA brand is with ICI. So whatever happens to ICI, it will affect the CA as well. So and whatever the work you do, whether in employment or in practice, it's always a person who is being given importance. The work comes later. Work can be later, or you can also pay somebody, get the consultancy done. That is easy. The presence of a CA in any office, any work is your individual presence. It's not the knowledge you are. Knowledge is easily, you can get it in various sources. So make sure that the trust is maintained, whether in office or in clients with practice. Okay, let us go further. X Limited purchased franchisee from a restaurant chain, maybe like KFC, Burger King, Pizza Hut, restaurant chain at a cost of 1 crore under a contract for a period of 10 years. Can the franchisee right be recognized as intangible assets? Absolutely yes. In the examination, we can, they say, can the franchise be recognized? The answer is yes, full stop, and next question. We can't do it. In the exam, you have to give the full story. Intangible asset is defined as asset or a resource controlled by entity having future economic benefits as a result of past event, which is non-monetary in nature, capable of being sold, and in the given case The franchisee cost has a reliable measurement of cost, and it can establish the future benefits over a period of 10 years, and both the criteria is satisfied, benefits and the reliable measurement of cost. And in cases of acquisition, there is a presumption that it has a future economic benefits. That is also there in case of acquisition of intangibles. All these stories you have to write and amortize to reflect the benefit pattern over a period of 10 years. Delimited is a publishing house, leading publishing house. Now, where are publishing house? Everything is closed only now. Purchased copyright of a book from author for publishing the same. Who will buy the books now? As per the terms of the contract, if Delimited choose to make the payment upfront, the copyright consideration is 80 lakh is to be paid, which is in line with general price. However, the contract is also provided in case the Delimited choose to pay the consideration after 2 years, it will require to pay 1 crore. At what value should intangible asset be recognized? It is 80 lakhs. This is also called as the cash price or fair value. The extra amount of 20 lakh is not attributable to the value of the asset, but to the time value of money. The technical word used in standard is deferred credit terms. Applicable in this standard, applicable in PP, applicable also in Ind AS 2. When any amount is paid towards time value of money but not towards the value of the asset, it is not capitalized, it is charged to P&L as interest expense. But if this happens to be qualifying asset, then you may capitalize it as per Ind AS 23. That's a different matter. But in general, it is attributable to interest expense, not capitalized. 80 lakh is capitalized. Impairment of assets. This is like, you see, I am getting paired. I mean, when you get married, you get impaired, I think. So, impairment, I am paired, impairment. Ind AS 36, what is the basic concept? I'll quickly tell you. So, normal process is you have an asset which is gradually decreased, is called as depreciation. Over a useful life, it becomes scrap value. That is a normal phenomenon, depreciation. But suddenly, if the asset is met with an accident and you see that the value reduced, but something unexpected, beyond normal loss, and that is what is called as the impairment. So ultimately, you are born, and over a period of time, ultimately you reach your end of your life. That is a normal life. Suddenly, if you are met with an accident, maybe you get married or you are in a relationship, suddenly you fall into scrap value. That is where you call it as impairment. So impairment, does not apply to one particular thing we should look at. Impairment does not apply to inventories, because in the inventory itself we value cost or NRV, whichever is less. Does not apply to deferred tax, because deferred tax itself will take care of any impairment. That is, when the value is lesser, we have to review and transfer it to P&L account. And even non-current assets and all, we have Ind AS 109 also, impairment is discussed separately for provision of doubtful debts specifically. Impairment is now applicable to subsidiaries, associates and joint venture. That's a special situation. Let's not worry about that. It is weakening in the value of the asset. How do you know something is impaired? First of all, should we go every year and check, is there impairment? Is there impairment? No, there has to be a indicator. Just like your parents. Will they come and speak to you every day? What happened to you? Anything happened to you? Suddenly one day you open the books and start reading in the night. They'll ask, what happens? Suddenly you are reading. Anything, should we speak to anybody? There has to be some sort of indicators. Same thing with respect to the disease or corona as well. You don't have to go for the corona test every day. Only when there are symptoms you go and test it. That's what this indicator is all about. External indicators means the value of the asset is declined, maybe market value, technological changes, interest rates have increased, the market value will decrease, or internal source, like there might be a physical damage, a short circuit, accident, or economic performance of the asset. That is, it was supposed to produce so many number of units, not producing. All those things we will classify it as indicators, and when there is indicator, we are going for impairment test. Impairment test, how do we calculate? Let us look at the formula quickly. Impairment loss is calculated as carrying amount minus recoverable amount. A recoverable amount is whichever is higher, that is value in use, or it is sold. That is a general phenomenon to get the benefit from any asset. Either you use the asset or you sell the asset. You can't do both, of course. Maybe inventory I sell, but fixed assets machinery I'm going to use it. So the asset has most of the times has value in use rather than value in sales. Of course, it's easy to calculate the value by selling, but difficult to calculate the value by using it. Some asset we can calculate, some asset we cannot. So recoverable amount is difference between carrying amount and recoverable amount. Recoverable amount is whichever is higher of fair value less cost to sell, or the value in use. A fair value is like a selling price, but fair value because we are using general selling price, not a specific selling price. Value in use, it means the present value of future cash flows from the asset. So all the cash flows we expect, pre-tax cash flow discounted, the present value you get. While doing the discounting, we should take the residual value as well after the useful life. That also will be part of the cash flow. Discounted present value, that is what is value in use, or fair value, whichever is higher. Recoverable amount. Carrying amount, remember, impairment loss is always done at the end of the year. Revaluation is always done at the beginning of the year, and depreciation is in middle of the year. So when they tell you revaluation is done at the end of the year and having remaining useful life of 3 years, but for the year you should take divide by 6. I don't know whether you understood what I'm trying to tell. They will tell you in the examination question, the revaluation is done on 31st March 2021 having remaining life of 6 years. But if you have to provide depreciation for the year 31st March 2021, you should take that remaining life plus 1. Because revaluation is done always at the beginning. Whereas this impairment is always done at the end. Because if you don't do impairment loss at the end, what will happen is if you take the beginning value, the value of impairment loss include depreciation. I know P&L account will be remaining same, profit remaining same, but the reporting will not be appropriate because the depreciation amount will give a different signal, impairment loss will give a different signal. Depreciation is a normal reduction in the value of the asset. Impairment loss means there is something that unexpected have taken place, which is not expected. So some physical damage or something unexpected have taken place that will definitely catch the attention of users, especially the investors, because if some asset is impaired, you might expect the asset to be purchased in the future years. That might affect cash flow statement, and cash flow statement, you know, FCFA valuation and all. When you're going to purchase the asset, the FCFA will reduce, the value of the share might reduce. But depreciation, we are not going to worry about those elements. So it has the impact in terms of analysis. Therefore, impairment should be after charging the current year depreciation. Recognition, we will transfer it to P&L account. If there is any revaluation reserve exists, first you set off against that, just like revaluation loss, excess only, you will take it to the P&L account. And subsequently, we can reverse impairment loss. So yes, we can reverse it, but only to the extent up to the value of the asset. If the asset had not impaired, what would be that value? Only to that extent you can reverse it. If you want to reverse more, then you have to call it as revaluation reserve. But many times, you know, that we cannot value the value in use individually. It's very difficult to ascertain the value of an asset, the cash flows from individual asset. For example, if we take the class into consideration, if you have the chairs, you can say per student or per chair, occupancy is likely to be this. Okay, we can calculate the cash flow per occupancy basis. But what is the cash flow from generator? What is the cash flow from projector? What is the cash flow from board? Cash flow from computers? It is not associated with particular unit. So we are going to select a group of units. The group of unit is called as the cash generating unit. So this classroom can be one group. The other classroom can be one group. These two classrooms put together can be one group. It's a smallest group of units that is capable of generating independent cash flows. So if individual asset recoverable amount cannot be determinable, we go for group, and what we do is we calculate the recoverable amount of the group as a whole. So calculate the impairment of group as a whole. Then the impairment loss will be applied at CGU level, means at pro rata basis, proportionate basis. And this may also include goodwill or something called as the corporate assets, like a ERP system, some centralized services, which is applicable for the company as a whole, not shared by a particular unit. In those cases, it's called as corporate assets, or even goodwill. Goodwill, you know, it will be usually applicable for company as a whole. So goodwill impairment, CGU impairment has to be done at a larger CGU. So usually try to understand this impairment happens at hierarchy. First at asset level, then at small CGU level, then larger CGU level, and then at entity level. The smallest is the asset level, and the biggest CGU is at the entity level. So again, if you understand, appreciate these things, our life also becomes much bigger. When you look at only yourself, you are okay, my life is big. When you think that no, I'm part of a family, I'm part of the district, I'm part of the state, I'm part of the country, I'm part of the universe, I'm part of the galaxy, you keep going the extent, then it will be only that dot. You can't even count yourself a dot there, and for that you are getting marks. You are not getting marks and all that. We hear so many news, right, that people go for suicide for not passing 10th standard, 12th standard, or not having some breakup, and they go for suicide. At least they should speak to CA students once. If we had to do the same thing, how many times we should die in one life? For every 6 months once we have to die, then every 3 months once some event will happen. But according to me, that's the biggest advantage that CA can have, others will not have. That is the experience of failure. Without experiencing failure, I bet nobody can become CA. Without experience of failure, whatever the definition of failure may be, but there has to be some sort of blockage in your life. Only when you cross, you will get the confidence to face the examination. How much ever thing it is, that is a part and parcel of everybody's life. That's what I say in general. Heated gold becomes ornament, tortured student becomes chart accountant. There is no exception, no exemption. Okay, impairment loss. When you calculate at a CGU level, you will distribute according to all the assets proportionately, even to CGU asset proportionately. But if you have a goodwill, the impairment will be first allocated towards goodwill. And in case of reversal of impairment loss, everything will happen proportionately, and last thing it will come to goodwill, and it will never come to goodwill, meaning reversal of goodwill impairment not allowed. Because if we do, it amounts to recognition of internally generated goodwill indirectly, because it's impaired. Now it's come back, means we have put that back into place. That is as good as internal generated assets. So reversal of impairment loss not allowed under Ind AS, allowed under AS. So that is about corporate assets, goodwill, all again similar things. Ultimate, the rule is this: first you do it at an individual level, then you do it at a CGU level. You allocate the impairment loss in proportionate. If you have any goodwill, first thing is yes, you will do it goodwill, and then to the other assets pro rata basis. Reversal of goodwill not allowed. Okay, any questions on intangible assets before we take up problems? Okay, let's go for problems then. Entity A acquires entity B for 50 million. Again, this is one standard where it cannot be learnt independently. It will have intangible assets, it will have consolidation, and it will have impairment. Entity A acquires entity B for 50 million, of which 35 million is the fair value of the identifiable assets acquired and liability measured, which means 15 million would be goodwill. The acquisition of B Limited is to be integrated into two entities CGU, which net assets as follows: CGU 1 25 lakh, CGU 2 10 lakh, so effectively total 35. So goodwill will be for both. In addition to the net asset acquired that are designated to CGU 2, the acquiring entity expects CGU 2 to benefit from certain synergies related to the acquisition. That is, example, CGU is expected to realize higher sales of its product because of the access to the acquired entity's distribution of channels. There is no synergic goodwill attributable to other CGUs of as 33 million and 17 million respectively. 33 plus 17, 50. Okay. Determine the allocation of goodwill to each CGU. There is no synergistic goodwill attribute to the CGU as rupees 33 million and 17 million respectively. What is that English? One second. Just ensure that any sentence is missing there. Okay, I think there's some sentence which got missed. So what they're supposed to tell is there is no synergy benefit between goodwill attributable to other CGU full stop, and then there's one sentence. Entity A allocated 33 million and 17 million respectively. So that sentence got missed in the question. Okay, so basically the answer is very simple. With goodwill, how much is the amount? Without goodwill, how much is the amount? Difference is attributable to goodwill. With goodwill is 33. Without goodwill is 25. Therefore, 8 is attributable to CGU. With goodwill is 17. Without goodwill is 10. So 7 is attributable. That's all. Goodwill attributable is 8 and 7. This is one simple explanation. With goodwill amount, without goodwill amount, difference is attributable goodwill. But for this, some complicated English sentence is there in the standards. How to allocate goodwill, I can't pronounce it, but that sentence is something complicated. Only Shashi Tharoor can come and interpret for us, I think. Okay. That's all. The point here is this: attributable goodwill is with goodwill and without goodwill. That is the goodwill to be allocated towards CG, nothing else. This problem will take it. This has not come in the exam, but has come in the study material. And this has a lot of flavors, no? Masala flavors are there. Can be challenging. Let's read. A Limited acquires 80% of shares in subsidiary B for rupees 3,200. On date of acquisition, B's Limited net identifiable assets is 3,000. A elects to measure NCI at proportionate share of net identifiable assets. Therefore, it recognizes like this. Purchase consideration, they have just told 3,200. NCI is a proportionate basis of net assets 3,000. NCI will be remaining 20%, so 600 minus net assets 3,000. Therefore, goodwill 800. Indirectly, we can say like this: 3,000 was the assets, and holding company share is 80%, which means your share of net assets is 2,400, but you paid 3,200. Therefore, what is attributable to holding company share is 800. Goodwill attributable to holding company share means NCI recognized on proportionate basis. At the end of the next financial year, B Limited's carrying amount is reduced to 2,700. Next financial year, carrying amount is reduced to 2,700, excluding goodwill. So basically, 3,000 became 2,700 because that is also excluding goodwill. Recoverable amount of B Limited's asset is 2,000. Case 1, 2,800. Case 2, calculate the impairment loss allocable to parent and NCI in both the cases. Okay, so if you understand like this, usually we allocate what is the goodwill, what is the other assets. We will write like carrying amounts one line, recoverable amount one line. This is the usual format. In any number of columns like machinery, any other assets, different column, goodwill also be one column. Carrying amount, recoverable amount, we'll do it on total basis. Okay, I'll just show you what Institute has done only, so that I can save some time on writing. Uh, Please understand this very carefully. I'll do a little slow on this. This is very important, in my opinion, as far as exam is concerned. Because consolidation, the moment you see consolidation, many people go to next question. And what happens in exam? Next question also will have some consolidation like this, because this is has impairment, and it feels like all standard will revolve around this core concept. Okay, so carrying amounts. Goodwill 800, that's what we recognized initially. Goodwill 800, and other assets is 2700. So 800, 2700, and that is 3500. And what is the recoverable amount? Recoverable amount is 2000. When I say recoverable amount, it is including the value of goodwill also. It is the entity as a whole, not just assets. So if you carefully look at it, what is going to be impairment loss? 3500 is the total. If I say impairment loss is 2000, therefore 1700 will be my impairment loss. And out of 1700 impairment loss, how much I'll give it to goodwill? Goodwill will be full, 800, and I'll give it to others. 1700 minus 800 will be 900. But there's one small issue here. If you understand the basic concept of consolidation, this will be a cakewalk. When we do consolidation, we take the subsidiary company's asset fully and we put in the consolidated balance sheet, 100%, irrespective of what is controlled by what is owned by holding company. So 100 rupees we take it, but holding company has 70%. That means 30 rupees we show it as non-controlling interest. But related to goodwill, we have a choice. When we calculate goodwill on proportionate basis, it means the goodwill what I'm showing in my books of accounts in this method is only related to the holding company share. When impairment happens, it should be only related to holding company share. Impairment I cannot fully set off against holding company share. See, this is the impairment happening with respect to subsidiary company. And in this case, in the example I just told you, what is the impairment loss? Impairment loss is 1700. Now 1700 I cannot take only to goodwill, because that goodwill only represents the holding company's goodwill. We want the entire subsidiary company's goodwill to be adjusted, not just the goodwill relevant to the holding company share, and that is what they are calling it as unrecognized NCI. In the sense, the goodwill related to NCI share which is not recognized because we are following proportionate basis, and that also should be impaired indirectly. So what I'm doing, I'm adding it. I'll tell you how to do without this calculation. I'm adding this number. So 3500 I'm adding, mean I'm recognizing. How I got 200? Very simple. 800 is relevant for 80%. How much for 20%? 800 is related to holding company share. NCI share 20%, that is 200. So we got 3700. Recoverable amount is 2000. Impairment loss is 1700. Out of 1700, 800 goes to goodwill, 700 goes to other assets. Therefore, impairment loss recognized is 1500. And what will happen to other assets now after carrying the impairment loss? 2700 minus 700, it becomes 2000. That's what is carrying amount, right? I mean, recoverable amounts 2000. Therefore, goodwill 800, parent, everything is eliminated. Other assets, we had impairment loss of 700. Out of 700, 560 is going to the other assets, 140 is going to basically NCI, because it is that NCI goodwill also should be impaired. The basic concept is, because NCI was not recognized, now you add, then later you subtract. So what they've asked, calculate the impairment loss allocable to parent. Allocable to parent is How much allocable to parents? 800. That's the maximum goodwill you can write off. And allocable to NCI is 140. Take 2 minutes. Just take that glance of the solution. If you don't want to show the unallocated unrecognized NCI, if you want to show it directly. Okay, if you do it directly, what would happen? Goodwill I'll write 800. This I'll write 2500. 3500. Recoverable amount is 2000. So the difference will become 1500. Out of 1500, I will give 800 to goodwill as it is. 1500 only, no? I'll give 800 to this, and 700 I will give it to the other assets. But that 700, what should I do? I will further take one portion and I should give it to NCI. What portion of NCI should be given? How much impairment I would have recognized? 200, and of that, what is that amount which is being now impaired? That is what this amount ultimately comes to, 140. You can calculate those number mathematically directly, but I think this method is more 20%. The 700 of impairment loss or other assets, 20% you are giving it to NCI. That's 20% is what is ultimately coming. Yes, that's what 140 is all about. Like, as I told, mathematically you can get it, but I would recommend show the answer like this. I know mathematically you get 700, 20%, 140, you will get it. But I would recommend present it with unrecognized NCI, in the sense basically what you have to do, even though they follow proportionate basis, had they followed full value, how would be the calculation look like? Make it look like in that sense. Answer won't be different. Presentation, see, you are right. Logically also I agree with you. But I don't know the institute whether the validator will have compare with the institute solution and this. Now, if the validator is fine enough to understand, you'll get marks. There is no doubt about it. But wherever possible, I will try to present the way what institute has done it. Wherever possible. Institute solution format is this. So we just follow the same format. That is unrecognized NCI. We'll show it as if we have done it. This will happen only when your impairment loss is exceeding the goodwill amount. If the goodwill amount is not exceeded, then we are not coming to other assets. If you are not coming to other assets, then this actual calculation will not have any impact. Even if you calculate, it will not have any impact. And maybe that is what is the second case, case 2. I'm just thinking whether it can be explained in some different way. This is okay. Now this 1500 is going to other assets 700, and from 700 it goes to NCI 140 and other assets 560. Yes. Let's see if we can think in this manner. What is the NCI as on the date of acquisition? It was 600. What would be the NCI as on the date of consolidation? It has become 2700, which means the net assets from 3000, it has become 2700. So 300 loss they must have incurred it, and 300 loss they've incurred, it means 20% should go to the, or yeah, 20% should go to the NCI. So 60 if I take it, can I say 600 minus 60, 540 will be the NCI as on the date of consolidation. Or I can say 2700 into 20%. That is the NCI as on the date of consolidation. But now this amount becoming 2000. Now can I say 2000 into 20%, 400 is my NCI? Can we say that? So 540 should become 140. So I should reduce by 140. That is what is impairment they are telling here. Maybe if we can write it slightly differently, or okay. So whatever the amount of decrease in the value of the asset, they are giving a share to the NCI also. You better show the calculation like this, but this would ultimately mean that this 2700 is becoming 2000. So 2700 becoming 2000 means that 700, 20%, 140 should be subtracted from NCI. But why I don't recommend this method? Because what will you do in the next case? Will you say the 100 increase, NCI should get a share? That will not happen that way. Indirectly what is happening is this, but I cannot do it in every case possible. So we will show the way what institute has followed it, or let's see if we can present it slightly if possible. Let's try our level best. What you would do is, in regular process, how you would have done, you will write goodwill related to holding company, goodwill related to NCI, other assets, total. So what is the existing amount given? What is the carrying amount? Related to holding company, okay. So holding company 800, so NCI is 200. What is the other assets coming to? Excluding goodwill 2700, yes, 2700. So this is coming to 3700, and recoverable amounts 2000. So impairment loss 1700. So you will allocate against the holding company 800, 200 NCI, 700 other assets. So revised carrying amounts, this would become 0, this would become 0, this would become 2000. So ultimately this is what the way you can present uh, related to the goodwill. How do you want to present it? And you know, when the other assets reduces, even NCI will have to be reduced. In the sense, other assets means what? The other assets is owned by two people. Holding company share go to ConPL, outside shares goes to NCI. So other assets impairments, holding company share 2000, no, not 2700, sorry, 700 into 80%, that is 560 to ConPL. NCI share 700 to 20%, 140 to NCI. If you want to pass a journal entry, other assets account debit 700, sorry, ConPL 560, NCI 140 to other assets 700. Hope this will not be confusing at least. In fact, whatever they have done, only I have done the same thing. I just showed in a same column so that it is flowing in a logical manner, that's all. So calculation what I have done is not different, just the presentation part, that's all. Just imagine, not for further calculation, just imagine if I had not done like this, what would have happened? This would be 3500, impairment loss would be 1500, 800 goes to goodwill, 700 goes to other assets, and 80% goes to this, 20% goes to this. So nothing would have happened here. That's because we should do second case also. Second case 2800. Let's follow this one just for understanding, then we'll look at it. Same process. It is the recoverable amount is 2800 instead of 2000. So what would happen to this? The impairment loss would be 900, and out of 900, NCI has 800, this has 200. Others will remain, but this goodwill, how much will you reduce now? You have to give it to both of them. 700, 80% means this 720, and this would be 180, and this would be 0, right? 0. And revised carrying amount, this will be 80, this will be 20, and this would be 2700. So this entry itself will not come because other assets is not impaired. Let's see what institute has done. 3500, 700, 2800, impairment loss 900. Of that 80% they have given to impairment loss, like we have done, and 80 is carrying amounts after impairment, correct? 800 minus 720 is 80. Other assets 2700. So entire 720 goodwill is allocated to only 720 is allocated, balance 80 is continued. And here if I ignore this and I like the way we did what will happen if I not allocate it? I don't get the same answer. Here when I don't allocate, if I ignore this allocation and I don't allocate this NCI, then it will be 3,500. 3,500 minus 2,800 means 700. 700 entirely I will give it to the holding company. NCI column itself will not come. So that difference would arise. So for that reason, you stick to this format. Simple format: goodwill of holding company, goodwill of NCI, other assets, take the impairment, carrying amount, difference impairment, allocate remaining carrying amount. In other assets, any impairment is there, further allocate to holding company share, NCI share, to be taken to ConPL as well as NCI column. Okay, I hope that is fine. Any other doubts on this one? Balance 80 will continue, correct. Goodwill balance 80 will continue because it's not impaired. Balance 80 will continue. If you don't do it like this, if you write here 2,800 and you write here 3,500 and this is 2,800, then you write 700, right? Then 700 you take it to goodwill and 100 would have continued, but 80 only should continue, because what we should continue is only related to the holding company shares. So the balance 80 goodwill definitely continue. Entire goodwill is not impaired, so it will continue. NC will never come in standalone. Who's standalone? Subsidiary cannot have their own NCI. Subsidiary will have only share capital. This 200 you mean notional. Only for proper allocation of impairment. So that it is taken to goodwill NCI or goodwill holding company properly. Only for that purpose. We don't report it. We don't report it. Because they followed a proportionate method. Had they followed fair value method, this question itself would not have arisen. The goodwill itself will take care of everything. This column is notional. Correct. The first line itself goodwill 1,000. So no need to worry about notional calculation there. Fair value of NCA portion, that how, if not given, what would you do usually? How you valued 80%, same way you value 20%. So 20% means the 1/4 of 3,200, 400, and the fair value would be 400. So instead of writing the 400, no, this is 3,200 is 800, sorry, 800. 1/4 of 300, 800. This would have been 800. So 4,000 minus 4,000 minus 1,000. 1,000 you would have got. 1,000 would be the goodwill. If you have to calculate in that manner. Second case once more, rewrite this. Only change is this recoverable amount is not 2,000, it is 2,800. So the impairment loss is 900. Of that 900, you take holding company allocation 80%, 720. NCI allocation 180. This is nothing, though this is 0. So revised carrying amount, this will be 80, this will be 20, this will be 2,700. This is anyway unrecognized, So don't even worry about it. Only this is what the impairment of 80 is all about. In the sense, fair value adjustment means had the given fair value method. Fair value, like, okay, no, usually in this case, okay, whatever the number, let's say fair value is 300 rupees. Then our goodwill would not be 800, our goodwill will be 1100. This column itself will not come. We'll have goodwill column, others column. You allocate it here. I mean, first you allocate towards goodwill fully. When you allocate it to goodwill fully, it will automatically go to NCI also, ConPL also. So the question of dividing between do not arise. Even if you take it also, it will not have any impact. So when you take it into only one column, goodwill, others. So you don't have to worry about goodwill related to NCI. That is on the date of acquisition. Impairment also same thing. But we don't take it to the impairment when you're doing goodwill. It will come in 3 columns. It will come in ConPL, it will come in NCI, it will come in goodwill. So goodwill is reduced full amount. Holding company share ConPL you reduce. NCI you reduce it in NCI shares. So NCI also will get reduced when you do only when you do fair value method. If it is a proportionate method, NCI column will not come. NCI is not impaired basically. A problem related to goodwill again. Let's say something can be learnt in this problem as well. On 31st March 2001, Vision Limited acquired 80% in equity shares of Vision Limited for 180 million. The fair value of net assets, including the consolidated statements, on financial position on 31st March 2001 were 200 million. Oh, for 200 million, you paid 190 capital reserve. No, 200 million, you are having only 80%. So 180 and you paid for 190. So I think goodwill is 10 million. It is group's policy to value the non-controlling interest on the date of acquisition at proportionate share method. On March 2004, after 3 years, the Vision Limited carried out the new annual review and goodwill on the consolidation and found evidence of impairment. No impairment had been evident when the review was carried on 2-3. So no problem 2 years. Problem came in 3rd year. Yeah, marriage also. 1st, 2nd year, no problem. 3rd year, impairment starts. The review involved allocating the assets of Vision into 3 cash generating units, computing the value of each unit, the carrying value of the individual units before impairment of adjustments are given, intangible assets of unit A and unit B, property, plant, equipment, current assets, value in use. It was not possible to meaningfully allocate the goodwill on consolidation on individual cash generating units, but all other assets are allocated in the table shown above. The intangible assets of Mission Limited have no ascertainable market value, but all the current assets have market value that is equal to carrying amount. The value in use of Mission Limited as single cash generating unit is 350. Discuss, yeah, this problem has to be discussed only. Compute the accounting treatment of impairment loss as per Ind AS 36. So first of all, what is goodwill? 200 into 80%, 160, and the 190 is the purchase consideration. So goodwill is 30. So goodwill is 30 million. This can be reviewed impairment CGU, okay, in 2 parts. A and C have the values more than the carrying amounts. However, the value of B is less than carrying amount. This means assets of B are impaired. Impairment, okay. So what is the impairment loss? Individually, if you compare, value in use 180 and total is 170. So I think A is not impaired. at this point in time. If I look at it, C is also not impaired. See, individually I'm asking about it. So 180, which is higher carrying amount, 104 is higher carrying amount, so only impairment happening is with respect to B, and that's what they're telling here. This means the assets of B are impaired by 24. So the impairment loss after charging 24, what will happen? You will divide the 24 to only B, but within B, which assets? Intangible assets is there, property, plant, equipment is there, current asset is there. We cannot allocate anything to current assets because current assets comprise of inventory valued as per Ind AS 2, debtors as per Ind AS 109, and cash cannot have impairments. Typically, current assets cannot be impaired. Therefore, the 24 what we calculated here is allocated only towards intangible assets and property equipment in the ratio of 5:1. So that's what they have done, 4 and 20. So this is only related to C. Okay. So after this, what will happen to the remaining amounts? Unit A. Let's look at this. Unit A. The total amounts. Unit A remains 170. Unit C remains at 100, but Unit B now became 66. That's the amounts, I think. 170, 100, 66. Okay. Now coming to the goodwill. Goodwill is calculated at 30 million, and recoverable amount of Mission Limited as a single cash generating unit is 350 million. So what is the total of all these things, or let's see what they have calculated, the goodwill calculation. So again, same concept what we just discussed, in the sense when you have to allocate to other assets, what we should do, goodwill related to holding company, goodwill related to NCI, then other assets. So let's write that instead of looking at their calculation, then we'll compare. I have the space here, can use it. Okay, so goodwill related to holding company, goodwill related to NCI, and other assets we have unit ABC total. So goodwill related to holding company is 30. And 30 represents 80%. How much for 20%? 1/4, so 7.5. And ABC, A is 170, B is 66, C is 100. So total 7.5. So how much total you get? 373.5. Okay, so this is carrying amounts. What is the recoverable amount? 350. So 23.5 is the impairment, and 23.5 will be divided between holding company 80%, 20%. How much you get? 80% means 18.8. So they've got different answers. Oh, they have already done the remaining amount. Okay. Okay, let's allocate. How much you get? 18.8875 something. 18.8. And NCI 4.75. 4.7. Okay. So that this is 12.2, 11.2 remaining goodwill. They got different answer, is it? they have done it. Goodwill 37.5, okay. Impairment loss of 23.5 allocated to goodwill. No, 23.5 into 80%, 18.8 is recognized. And they have allocated 11.2. Same thing, they have only done it, right? Yeah, same thing, only they have done it. Okay, does not matter. So what is the total impairment? Goodwill amount is 30. 30 minus 18.8, 11.2 should be the answer. They got 14, no? Oh. Oh, they have added the numbers. So they have taken 37.5 minus these two numbers, huh? Okay, 37.4. Okay, they have added both. Okay, fine. So this is 11.2 and this is the 7 plus 7.5 minus 4.7 means 2 point something. 2.8. Oh, they have added these two numbers. Okay, they have recognized this basically. But it does not matter. But in our concept format works, so we can allocate. We can follow this structure in exams. Okay, so this will take care of the impairment of goodwill. Okay, so moving on to the next standard, Ind AS 40, investment property. Okay, so basically what is an investment property? It is land and building or land or any part of it which is there for the purpose of earning rentals or capital appreciation, or the purpose is undetermined. So basically means that it is not used for your business purpose. Only property. If machinery is held for rental purpose, that is given, that will come under Ind AS 16 only. But the property which is given for rental to others, property which is capital appreciation purpose, meaning as an investment, not for use, or it is undetermined, you don't know the purpose, it will come under Ind AS 40, investment property. If it is used for the purpose of business, Ind AS 16 would apply. If it is used for the purpose of like in the normal course of business for real estate developers, this will be part of Ind AS 2, inventories. Or if it is in the construction contract, you are going to sell it, again Ind AS 2 and Ind AS 115, when you sell it, those principles would apply. If it is occupied by employees of the company and you are charging rental to the employees, it will still be considered as Ind AS 16, for the reason, why are you giving it to employees? For taking benefits in the business. So even though it is rental to employees, it will be still be considered as Ind AS 16, not as property. Even the operating lease, if the property given on operating lease to others, this will be part of Ind AS 40. So either held as owner or held as a lessee, but of course given it to somebody else on rental basis. So basically sublease would come under this definition. And the recognition is only on cost model. Cost model in the sense you cannot do a reevaluation. You will still show as a disclosure, but it is not recognized. Again, some people cost model think it is cost. Cost model means we provide depreciation, but reevaluation is not permitted. That's the meaning of cost model. When you transfer from let's say one of the Ind AS 40 to other cases, we will have to transfer it at cost. So you might transfer from rental to others, you might start using it for your own business purpose later. Then you will go to Ind AS 16. On the date of transfer, it will be recognized on cost basis. So that would be Ind AS 40. Quick summary. We'll understand more with the help of few problems. Netravati Limited purchased commercial office space as an investment property in Global Trade Center Commercial Bank Complex for 5 crores. They purchased the property. However, for purchasing the same, the company had to obtain membership of the Global Trade Center Commercial Complex Association by paying 6,25,000 as one-time joining fees. Netravati Limited wants to write off one-time joining fee paid as expense under membership and subscription charges and the value of property 5 crores. Advice: would your answer change if office space was purchased in the intention of using it as administrative property? This is in connection with acquisition of an asset. The same rule what we applied in Ind AS 2, Ind AS 16, Ind AS 38, same rule applicable here as well. Any expense incurred up to the point asset ready for use should be capitalized. So 6,25,000 will be capitalized. If the property was for administrative center, then it will be classified under Ind AS 16, but still this would be capitalized. Capitalization will not change, but only thing is regarding the which standard we would apply. The first situation in Ind AS 40, second situation in Ind AS 16. X Limited is engaged in the construction industry and prepares its financial statements up to March. On 1st of April, X Limited purchased a large property consisting of land also for 2 crore and immediately began to lease the property to Y Limited on operating lease, a case of purchase and given. That means this person is a lessor. And when you are a lessor and operating lease means asset will continue to be recognized and the operating lease income will be taken to P&L. If it was a financing lease, the asset whatever you have given will be de-recognized. In place of that, net investment in lease, NIL, the present value of lease payment, that would be replaced, the value of asset. But that is not happening here because it is operating lease. Annual lease rental is 20,000. Annual lease rental is 20,000. 20 lakh. 20 lakh. Okay. And fair value of the property was 2.6 crores. Under the terms of lease, Y Limited was able to cancel the lease by giving 6 months notice in writing to X Limited and gave this notice on 31st March 2005 and vacated the property on 30th September 2005. On 30th September, the fair value of the property was 2.9 crores. On 1st of October 2005, X Limited immediately began to convert the property into separate flats of equal size, of which X Limited intended to sell the ordinary course of its business. X Limited spent total of 60 lakh on the conversion project between September to March. The project was incomplete on 31st March and the directors of X Limited estimated that they need to spend further 40 lakhs to complete the project, after which the flat could be sold for 50 lakh. Examine and show how 3 events would be reported in the financial statements of X Limited. So first thing, they purchased, they give it on lease, then lease contract cancelled, they converted the property for the sale purpose. Actually, there is one small conflict in the solution because I don't know this solution, I'll have to read. But in some institute solution I've seen, when you convert the property from investment property to the Ind AS 2, the inventory, they have converted on fair value basis. We do an income tax that you convert on fair value basis, but as per Ind AS we have to value on cost only, transfer at cost, transfers. But institute sometime has taken fair value, they have recognized the gain on transfers. I would recommend whatever institute says they will follow, but let's see what institute has done it. Okay, initially you have purchased 2 crore, therefore you will measure at 2 crore at cost in AS 40. On September 2005, that is when the investment property is converted into inventory. Okay, thank God here they have given the correct answer. They do not change the cost of the property measurement or for disclosure purpose. So even though on the date of conversion, it will be still valued at 2 crore and not at 2.9 crore. The fair value change, the gain will not be recognized when you convert the nature of the property. In income tax, you recognize that profit. Since the property is a lease, the rental income of 10 lakh would be recognized in the P&L for the half year. Yes, half year only you recognize it as operating lease, you take it to P&L account. The additional cost of 60 lakh for developing the flats were incurred, and therefore that would be added to the cost of inventory given the closing stock of 2.6 crores. Suddenly this is what 60 lakh, correct, the answer is fine. 2.9 is irrelevant. Your cost of the transfer was 2 crore and you have spent now 60 lakh. In the sense, it is now your inventory. Inventory means any expense incurred should be added to the cost of inventory. 2 crore transferred from Ind AS 16 to Ind AS 2 and incurred expenses 60 lakh. So cost of inventory on 31st of March would be 2.6 crores. Selling price expected to be fair value 50 lakhs. That's all. Oh, per flat. Okay, each flat. How many flats they can make it then? Okay, see again the information of number in words. So they'll make you search for it. Whenever you read that, it's better you mark something or write somewhere so that that information you don't have to search later. So 50 lakhs into 10. So sale value is 5 crores, but the cost is 2 point something 6 crores. So sale value is net realizable value is more, cost is less. So as per Ind AS 2, it will be valued at cost or NRV, whichever is less. Interesting problem, not complicated one though. Ind AS 16 is there, Ind AS 2 is there. In one of the RTP solution, I think they have made a mistake. They have transferred at fair value basis. Now here they have corrected it. It is transferred at cost. Fair value on the date of conversion does not matter. Okay, next. January 21 question. On April 19, the entity purchased office block for 50 lakh. Oh, it's a similar question or something in all is there. And paid a non-refundable property tax and direct legal cost of 2 lakh 50 and 50,000 respectively. These expenses will be capitalized because it is in course of acquisition. Same thing with Ind AS 16, same thing with Ind AS 38. While acquiring the building during 19, the entity developed the building into two-story building. Expenditure of redevelopment were 1 lakh for approval, 10 lakh for construction cost, including 60,000 refundable cost. Refundable purchase taxes will not be part of cost of the asset. 40,000 due to abnormal wastage of material and labor. Abnormal wastage cost also will not be capitalized. When redevelopment of the building was completed on 1st of October 19, after 6 months, the entity rents out the ground floor of the building to its subsidiary under operating lease in return for rental payment. The subsidiary uses the building as a retail outlet for its products. The entity kept the first floor for its administration and maintenance staff usage. Equal value can be attributable to each floor. How the entity account for all the transaction mentioned the expenses in the books of account. Also discuss how the building would be shown in consolidated financial statements. You see, wherever you go, this will not leave you. Of the entity of the group and in the separate financial statements as per the relevant Ind AS. Basically, they also don't know which standard to apply. So they told you relevant Ind AS, but in the exam, you should mention which name it is. What and all to be capitalized? 50 lakh purchase price, non-refundable and legal cost 50,000. That comes to 52.5 plus 0.5, 53 lakhs. Expenses on development also will be capitalized. 1 lakh is capitalized out of 10 lakh. 60,000 is refundable. Subtract 9 lakh 40 is capitalized. 40,000 abnormal wastage is not capitalized. Ultimately, cost of capitalization, adding all these things, comes to 63 lakh 40,000. Okay, once you construct, once the redevelopment is done, you give it the rental to ground floor, the building under operating lease. So this will be shown under Ind AS 16. give it to somebody else. You are a lessor, the subsidiary is the lessee. In the books of lessor, it will be shown as Ind AS 16. Give it on operating lease purpose. In the books of subsidiary, they don't show the asset, or they will show the asset. I don't know. They might show the asset on ROU basis and lease present value, lease payment basis under Ind AS 116. Subsidiary uses for business purpose. Okay, that is for the ground floor. For the first floor, they kept it own for administrative purpose, which means this will be reported under Ind AS 16 PPE. So 40,000 we divide by 2, whatever amount we get, one portion will go to property, plant, equipment under Ind AS 16, one portion goes to lease under Ind AS 116. I mean, it will be classified under Ind AS 40, but it is lease. But reporting will happen under Ind AS 40, and means we have to follow cost model. We can't provide revaluation. So that's what they have done. Equal value can be attributed to each floor. So 6,40,000 divided by 2. On 1st of October, the carry value of building and this whatever the floor, you are going to report it as PP 31,70,000, property 31,70,000. Both are equal. This point is very interesting. How will you report in consolidated financial statements? This is a very interesting point. If you treat the group as a whole, the ground floor is occupied by subsidiary, the first floor is occupied by holding company, but overall it is belonging to the company only, which means the entire building will be valued under PP, not under Ind AS 40. But when you think about separate financial statements in the books of holding company, then from the holding company as an entity point of view, this building is given on rental basis. So it will be valued at investment property. So in the separate financial statements, it will be held to earn rentals, so classified as an item of investment property. The ground floor investment property, the first floor is Ind AS 16 PP. Whereas in consolidated financial statements, entire amount will be classified as investment property. So that's a small point, interesting points. Ind AS 40 as well as Ind AS 16 as well as Ind AS 116 to an extent, and also consolidation we talked about. So Ind AS 110 also you can talk about it. Fine. So okay, this is about investment property. Any other question connected with Ind AS property, investment property? Okay, let's move on. Okay, so next standard, Ind AS 105, non-current assets held for sale and discontinued operations. This standard, is like age-old home, old age home. After your useful life, but before your disposal, you need some place. Old age home, that is what is old age home in accounting standard is called as Ind AS 105. Non-current assets used for such a long time, either under Ind AS 16 PP or under Ind AS 38 intangible assets or under Ind AS 40 investment property, where you are used under different standard, but while going everybody will pass through same standard. So while being used, you are in different place. Life is also like that. You are in different place, different name, different work, different profession, different life. But when you die, everybody will follow through the same process. That when you die, your body is called as body. People don't put a name behind it. Anyway, before that happens, you will come under Ind AS 105. You can also think like a hospital. Everybody is same. So when you are in hospital, when you are in Ind AS 105, non-current assets held for sale, the question of depreciation do not arise. Depreciation will cease and you will value your cost or NRV, whichever is less. You don't provide any depreciation. Okay, so one word is discontinued operations. The other is asset held for non-current asset held for sale. Let's look at the first one. Okay. Applies to all non-current assets held for sale, for distribution to owners, all disposal groups held for sale purpose, discontinued operations. And it does not apply to Ind AS 12, Ind AS 19. Those standards will directly take care of themselves. So those assets will not come to Ind AS 105. Okay, classification requirements, that is what is important from exam point of view. It should be available for immediate sale in the present condition. That means you are sure that it is going to be discontinued. It is sure. There is no doubt there. We may do it, may not do it. We have a non-current asset, we have a machinery, it is kept aside, we are sure we are going to sell it off. That is what is discontinued operations. Sometimes you also speak with your friends, right? If person is going through a patch up phase or a breakup phase, you'll ask him, are you sure you are having breakup? Because I can try after that. No? Anyway. So available for immediate sale in the sense that the asset is not having any doubt it will come back to the usage. It is held for sale in the present condition. So you're not having the intention like, no, I have a car, I'll do repair, I'll do painting, then I'll sell it. It is not in the present condition. It has to be in the immediate present condition for you to enter this standard. Basically, doctor has given up all the things. Now no more things left. Only one thing is left, that is you have to go out. Then you come to this standard. Usual customary terms and all is accepted. So small things might be there, like you have to clean a setup and you have to package it. Those things you don't put a condition that not in present condition. Customary elements are accepted. For example, typical example even institute gives you, you have an office, an office building you are planning to sell, and that office is your head office. So unless you find a alternative place, you cannot exit this. That means it is not available for sale in the present condition. Alternatively, while giving the office on sale basis, you have to clean all the things up, you have to remove all the extra accessories. Those things are very normal. Still building is held for sale purpose. So if they continue to be vital, as I told you, for head office kind of thing, it will not come under Ind AS 105. You should not have the intention to sell in the distant future. You may sell after 6 months, after 1 year, I don't know, then it will not come under this standard. Sale must be highly probable, so management should be committed to sell. There should be active program, that is you should make an announcement in the Facebook, Google ads, newspaper, means they should be serious basically. That's what it is all about. And marketed at reasonable price. The value of the normal property is 1 lakh and you show it at 21 lakh, you know nobody will come. You can't tell, no, I have done everything, I have given advertisement at 21 lakh. That is not a reasonable price. That will not be part of Ind AS 105. And sale should be probable to be completed within 1 year, and significant change in your mindset should not be there. If the criteria is met after the reporting period, then it will become non-adjusting event, and still it will be disclosed in notes to accounts. Abandoned assets, meaning assets not in active use, is not asset held for sale purpose. This one thing you have to be very clear, especially in case of corona situation. You don't have enough demand for your product, so machinery is not being used. It is actively not in use. It is abandoned from active use. Does not mean held for sale purpose. It is like you take 1 month leave, 1 week leave, or sabbatical 6 months leave. Does not mean your useful life is over. Your useful life is over only when you decide, okay, now I am quitting from all the things. When you clearly, explicitly say that it is held for sale, until that point, abandonment and all will not be called as asset held for sale purpose. Then group of assets, disposal group also classified for held for sale purpose. Then group means it's not one asset. Group of asset, like in the impairment we discussed CGU, put together one group, or in segment reporting we say one full segment is held for sale purpose. So we are going to add all of them in the sense value of fixed assets, value of inventory minus some liability, net amount. We are going to treat it as a net group. That is what is group held for sale purpose. On the date of application of this Ind AS, as per respective Ind AS, but from the date on which it comes to this standard, it's going to be lower of cost or NRV. You don't use NRV, fair value less cost to sell. Depreciation will start. Impairment loss also can be recognized if fair value is less and cost carrying amount is more. Then you will have impairment loss. If you have impairment loss, you know, first you will allocate to goodwill, others on pro rata basis. Subsequent reversal, it is allowed if sufficient evidence is there, but not allowed in case of goodwill. Reversal of impairment loss is permitted, just like Ind AS 36. Impairment loss is permitted only to the extent of the value. If there was no impairment, what would be the value of the carrying amount of the asset? Only to up to that extent reversal is allowed, not beyond that. And in the balance sheet, you will show separately from others. Like I told you, know, even age, people are aged, you give them separate room at home also. They will not mingle with everybody else. So in the balance sheet also, if asset is held for sale purpose, they should clearly marked and showed the building non-current assets. Then below that you write down assets or non-current assets held for sale purpose under 105. P&L account also, the profit impact should be shown separately. This is the group of assets or assets held for sale. And if you talk about a series of operations, discontinued operations, set of activities, it's a component of an entity. For example, it is a case of demerger, maybe a company selling its holding, or the holding company selling its subsidiary, or you're selling a major retail outlet, or a segment itself you're stopping. All these things will come under discontinued operations. Maybe like Tata Motors decides we will stop the petroleum vehicles, we will focus only on electric vehicles. Then in such case the petrol vehicles will be called as discontinued operations. You stopping the major line. Just Pizza Hut stops one small unit, that is not called as discontinued operations. You have to discontinue a major component that represents a major line of business and is part of single or phased plan. That is fine. Even subsidiary acquired exclusively with the intention to resale will also be called as discontinued operation, because you're not planning to run the business. You're planning to sell the subsidiary in the near future as possible. Anyway, that is the brief summary of the standard. When we take a problem, we'll get more ideas. Let us take a look at some problems. Following is the extract of consolidated or start. See, wherever you go, the word consolidation will not leave you. You keep going to next problem, you would have gone to the last page of the question paper. So that giving up consolidation is not a choice. You just have to learn, live with it. Following is the extract of consolidated financial statements of A Limited for the year ended on. And this is one more point of advice for you. The moment you read the first sentence as consolidation, it is not necessarily a consolidation problem. So don't lose hope at the beginning. Asset carrying amount, attributed goodwill, intangible assets, financial assets measured at fair value through other comprehensive income, property, financial instruments also coming. Property, plant, equipment, deferred tax asset, current assets, inventory, receivable, cash balance, current liability, non-current liability. So net of the group value is 2250. On 15th September 2001, so after maybe 5.5 months, entity A decides to sell the business. In that process of selling, they wanted to give you some challenges. So this question came up. It noted that the business meets the condition of disposal group classified as held for sale in accordance with Ind AS 105. Very good. However, it does not meet the condition to be classified as discontinued operations in accordance with this standard. What happened to them? It will satisfy disposal group, but it will not satisfy discontinued operation, meaning as a group it is going to be sold, not as a major line of business. Discontinued operation means it has to be a major line, component, segment. That's not the case. It is that group of assets, collection of assets, unit, CGU is being sold. Disposal group is stated in the following amounts immediately prior to reclassification as held for sale. Attributed goodwill, intangible assets, same amounts, 200, intangible assets 930, financial assets 360, Amounts are different. Okay, one is on 31st of March. These amounts are on 15th of April, September. So 5.5 months later. One was the opening balance. These are the amounts at the time of classification into 105. Deferred tax asset, current assets, current liabilities, net 160. Entity A proposed to whom? To sell the disposal group for 19 lakhs. From 2160 19 lakhs. Is this rupees in thousands? Oh, okay, fine. 2160,000. So 21 lakh. And they are proposing to sell for 19 lakh. Estimated the cost to be 70,000. This cost consists of professional fees to be paid to external lawyers and accountants. On 2002 at year end, there has been no change to the plan to sell the disposal group and still expects to sell within 1 year of its initial classification. Mr. X, an accountant of entity A, remeasured the following assets. So still it's not over. He remeasured the following assets in accordance with the respective standards available for sale: financial assets, deferred tax asset, current assets, current liabilities. The disposal group has not been trading well, that's why you are deciding to sell. And its fair value less cost to sell is 16,50,000 required. What would be the value of assets and liabilities within the disposal group on the following dates in accordance in days 105? So we should give on maybe a columnar basis what happened or on the date of classification and what on the year end date, which means this opening balance information is not relevant. We'll only go with what is there on 15th of September. Okay, let's take a look at the amounts, what and all they have given quickly. On 15th of September, amount given was attributed goodwill 200, intangible assets 930, financial asset measured 360, property plant equipment 1020, deferred tax asset 250, current assets inventories 520, current liabilities 870, non-current liabilities 2160. So you will recognize this on 31st of, on 15th of September. As per the value on Ind AS 105, we are going to value cost or fair value less cost to sell, whichever is less. So what information is available as on September 15th? Entity A proposed to sell for 19 lakh and the cost to sell will be 70,000. So 19 lakh minus 70,000, that is what you get, 18 lakh 30,000. The fair value less cost to sell on the date of classification. The entire group as a whole, not as an individual asset. Then you start allocating one by one. You do it on proportionate basis. Of course, out of this amount, entire amount first will be going towards goodwill. Goodwill is the one which gets impaired first. Then the remaining amount one by one. This current liabilities, non-current liabilities, liability we never touch any allocation, so don't even worry about it. Current assets, impairment does not apply. Ind AS 10 also, why also will not apply? Because it would have already been covered under inventory or trade receivables respectively. A deferred tax asset, again it is covered under deferred tax separately, it will not come here, no impairment. So what we have left with is 330 minus 200, that is 130. We should divide in the ratio of this intangible assets to property equipment. Even financial assets will cover under separately, impairment is there, so that will not be covering here. So in the ratio of 93 is to 102, I think. Only two items left. So 93 is to 102, divide 330, I mean not 330, the 330 minus 200, 130. 130 divide in the ratio of 9 into 93 by 195. Hope you get it. 62 and 68 approximately. So that's the process. First allocation to goodwill, remove whichever is not going to be impaired. Only pending item is intangible assets and PPE, divide in their proportionate basis on the carrying amount. This is as on date of reclassification. And now year end, what happens? Year end values again given, financial assets and all, and they have given the fair value less cost to sell is 16,50,000. We will repeat the same process. Impairment loss allocated to goodwill and other to pro rata basis. Following assets are not in measurement of scope of the standard. That's what we just discussed. Deferred tax, current assets and current liabilities. All other assets outside the scope of this measurement measured in accordance with the relevant standards. Okay, so that is what happened. Now coming to the 31st of March information, what we have. These are the values we had. Just take a look at this: 868, 360, 952, 250, 520, 870, 250. I hope you remember the numbers. If not, I assume it. Same numbers have been taken here: 868, 360, whatever the date of classification on 15th September. Year end, they set the value. This was anyway, goodwill is taken away completely. Financial asset was 868, and year end value they have given anything? Nothing particularly, right? No, nothing is given here. Let's go to the next line. Intangible assets. Maybe we would have to again proportionately allocate. Later we'll do it. Financial assets, on the date of classification we had 360. On the year end, financial asset became 410. Oh, increased. That doesn't matter. We don't worry about the number. Okay, 360 was there. It became 410. The change in value. Might have you acquired more assets and all can happen. So 360 was there. It became 410. 50 is purchased. Then what about the deferred tax assets? Deferred tax asset was 250. And the deferred tax asset became 230. So 250 was there. 20 change happened. 230 outer column. What about PPE? Nothing is there in PPE here. Okay, so at the year end PP is not given. So this PP, what was there, 1020, we allocated some impairment also, I think 68. So we will start with 952, and 952 we will be further reducing by impairment on a proportionate basis, just like we have done on 15th of September. What about current assets? Current assets on this date was 520 on the date of classification. Year end current assets became 400. So 520 became 400. Therefore, they are not shown here. 520 became 400. The change is 120. So what and all is over. Let's look at on the values. Financial assets we have done. Deferred tax asset we discussed. Current assets we discussed. Okay, current liability, non-current liability, 900, 250. Earlier it was 870, 250. That is just a disclosure. So 870, 250 became 900, 250. So this 250 remains as it is. This 870 became 900, which means there is an increase or change by 30. That's only a disclosure. That column, second column, is not of relevance. Okay, so carrying amount, don't worry, carrying amount, look at the amount on 31st March 2002. If you look at these values, or if you take these two columns put together, it was 1830 minus 120. That is the value standing on 31st of March. That would be 1610, I think. So 1610, no, 1610 is 1710, sorry, 1710 is, this is the value as on the date of year end, but recoverable amount is 16,50,000, so 1650. So difference is the impairment 60, and will be allocated to goodwill if you have any. Nothing goodwill, so it will be allocated to the intangible assets and the PP, and that was the two things which I had earlier also. In the same ratio you can divide to, okay, here only in the ratio of intangible assets and PP you will divide. Other things remains as it is. Okay, so that's about this problem. See if you have any doubts. No, this is disclosure. There's no question of revaluation reserve. I mean, in this situation you're asking, or here situational? No, there is no increase, no? No, that's only disclosure. We are preparing the balance sheet as on this date, 31st March. And as on this date, the value of the current assets, let's say, is 400. 520 has become 400, would have been already recorded in our books. Maybe cash received, debtors reduced. So those 120 I will not take it to any adjustments. That is only a disclosure from the date of classification till the year end what happened as a reconciliation in the notes to accounts we are showing. But if I look at my trial balance, it's already showing at 400s. So we don't have to show any further accounting for that. Again, this question, in my opinion, is important for examination. Okay, any other doubt in this one? Okay, next. Identify which of the following is a disposable group on 31st March 2001. So what is a disposable group? First of all, two items, a disposable group, and then we had discontinued operations. Discontinued operation means it has to be operations, mean major line of business. Group means set of assets held for sale purpose, and it should be available for sale in the immediate condition without any further extra elements. On 21st March 2001, XYZ Limited announced the board's intention to sell its share in a subsidiary company Alpha, contingent upon the approval of Alpha shareholders. It seems unlikely the approval will be granted in the near future, and no specific potential buyer has been identified. So you are not likely to sell, therefore it will not be classified as sale. Okay. Shares are not available for immediate sale, therefore approval is required. It is not highly probable. It is not classified as Ind AS 105. PQR entered into a contract to sell the entire delivery fleet of vehicles, means group of assets operated from its warehouse to competitor. It's very good. You are not selling it to anybody else. You're selling it to your own competitor. Maybe you are running into losses because of these assets. You give it to competitor, so let them also suffer. The assets will be transferred on 20th of April, from which the date the group will outsource delivery activities to another company. So we are on 31st of March and they have sold, they are entered into a contract to sell on 14th March. Assets will be sold in 20th of April. This is definitely classified for sale. It's immediately in present condition as well, highly probable, and on the reporting date contract is also entered into, the intention to sell is there, maybe at reasonable price, available for sale in the present condition, satisfy the conditions, it is held for sale. On 16th Jan 2001, DEF's management and shareholder approve a plan to sell retail business in Mumbai, and a consultant is hired to manage the sale. On 31st March 2001, the heads of the agreement had been signed, although due diligence and the negotiation of the final terms are still in process. The transaction is expected to be completed in 2001. So due diligence is pending. So what if in the due diligence it was found that they are having some issues in tax, labor, company law, I don't know what not. So in those cases the agreement may not go through. So in those cases it will be not presented, held for sale. You mean in the third point? If the transaction is expected to be completed in April 2001, and so in April 2001, if the accounts are still pending, so as on 31st of March, we are having the condition of due diligence pending, and before the approval of accounts, they decided that, I mean, the due diligence is complete, you can take it as adjusting event. It will be classified as 105. No question of reclassification. I mean, yeah. I mean, it will be moved from all other things to Ind AS 105, considering it as adjusting event. But one small point: the management have on January 2001, they have approved a plan. If this was done in 15th of April and the transaction complete by 30th of April on the same day, that would be non-adjusting, because the situation of the contract was not existed on 31st of March. So in this example, if it was before approval of accounts, we can take it as adjusting event. But based on the information what we have, the due diligence is not complete, not available in the present condition, so we'll not take it as available for sale. On 28th February 2001, entity X is committed. What committed means, we remember something only. Committed on the following plans: to sell a property after completion of certain renovation to increase the value prior to selling. These renovations are expected to be completed within a short span of time, 2 months. I know it's short span of time, but still it is not available in the present condition. So until that renovation is complete, it should not be classified as available for sale. The property cannot be classified as held for sale. To sell a commercial building to a buyer after the occupant vacates the building, the time required for vacating the building is usual and customary for the sale of such property. The entity considers the sale to be highly probable. Can the above mentioned property be classified as non-current? The second case, highly probable, and it is, I know there is a condition that the occupant has to vacate, but it is expected in the normal course of business. They have to exit it, they have to go out. It is usual and that is customary as well. So this is highly probable, available for sale in the present condition. It will be classified as for sale on the reporting date. Okay, so the next standard, Ind AS 41, agricultures. Agricultural activity related to biological transformation. What is English phrase? Biological transformation. You grow or living animal or plant, that is called as the biological assets for sale purpose, conversion into agriculture produce, but not bearer plants, because bearer plants are covered under Ind AS 16. So if you have to just understand the basic application of the standard, so if you are thinking about Tetra Pak, the process starts from plucking the fruits from the orange trees, then process it, and then it is available for sale. So when the process of plucking the orange trees, the cost of the tree development and all will come under Ind AS 16, whereas the process of plucking orange fruit, that is under agriculture, Ind AS 41. Once it is processed as goods and available for sale, from that point onwards we apply Ind AS 2. Of course, if you are selling the fruit as it is, then it will be under Ind AS 41 only, it will not come under Ind AS 2. But once you process it in the regular manner, then you can say it is available for sale, Ind AS 2 will apply. Recognition, same rule, expenses should be incurred, future economic benefit should be there, and reliable measurement of cost I cannot tell. If you remember the example of living animal, also I told you 100 cows was there, 2 you purchased, 2 you sold, year end you have 101. I cannot determine the reliable measurement of that one extra cow, but I can determine the fair value of it, the cost at which, the value at which the asset is going to be sold. Therefore, the standard says not Ind AS 2 cost or NRV, whichever is less, we don't tell. We will value it on fair value basis. That means we recognize to an element profit also. That's permitted because we can't go with the pure cost basis. So measurement, initial recognition when you purchase will be at cost, but if internally developed, then it will be at fair value basis. Subsequent recognition, it will be on fair value less cost to sell. The difference between initial recognition and this one, subsequent recognition, will be transferred to P&L account, and there we'll divide this into two parts. One is changes due to physical, other change due to price. You know, when the age, the cow having 3 years, let's say in the previous year it was 3-year aged cow and it was, let's say, 10,000. Year end, this cow would have become 4 years and it's 12,000. We know the change is 2,000, will go to P&L account as fair value change. But in the notes to account, we should break it up for what purpose. So as on this date, if the age of the cow was 3 years and it is, let's say, 10,500, then that means if the cow was not aged, time was freezed and the cow was not aged, then also you would have got 10,000 to 10,500. That would be mainly because of the price change. But 3 years is 10,500, 4 years 12,000. So this 1,500 is the life change, or we say due to physical changes. Or you know, in your costing you will say like price variance and volume variance. So price changes, the price variance, physical changes, the volume variance should be shown in the notes to accounts. If fair value not available, then you can go with cost if available. If both are not available, close the books of accounts. If you receive any government grant, you can recognize the biological assets at fair value basis, recognize the grant when it is receivable. If it is a conditional grant, then when reasonable assurance is there that grant is expected to be satisfied, the condition expected satisfied, you can recognize the grant. If it is related to time proportional, for example, in case of agriculture and all, they might tell you for 5 years subsidy so much, allocate the grant over a period of number of years to P&L account. If biological is measured at cost, you see in days 20 we had two methods. Either it is subtracted from the cost of the asset, or a deferred income is created. The same thing you apply when you measure the biological assets on cost basis. The rule of Ind AS 20 would apply here as well. Okay, there's a brief discussion on Ind AS 101, Ind AS 41 on agriculture. Let's take up some problems to get more clarity. XY Limited is a farming entity. This is the only standard, I think, which is related to a specific industry, which is not a generic standard. Thank God, only one. In future, we don't know. XY Limited is a farming entity where cows are milked on a daily basis. Milk is taken, that's what it means. Milk is kept in cold storage immediately after milking and sold it to retail distributor on a weekly basis. On 1st April 2001, XY Limited had a herd, I don't know, what is that English? Anyway, 500 cows which were all 3 years old. During the year, some of the cows became sick. Okay, Papa. And on 30th of September, 20 cows died. On 1st of October, XY Limited purchased 20 replacement cows in the market for 21,000 each. Maybe after solving this problem, we can also do some agriculture farming. These 20 cows were all 1 year old when they were purchased. On 31st March 2002, so 6 months later, so it would be 1 year, 6 months. XY Limited had 1,000 liters of milk in the cold storage which had not been sold to retail distributor, so it will be valued on a fair value basis. The market price of the milk on 31st March 2002 was 20 per liter. for this only, for valuing the closing stock. When selling the milk to distributor, X Limited incurs selling cost of 1 per liter. So we will are going to subtract this fair value less cost to sell. The amount did not change during the year 2002 and are not expected to change during April 2002. Okay. Information relating to fair value and cost to sell is given below. XY Limited is a farming, again, it's a repetition. In the metal also is like that. No, I think in the metal is not. I think here it's a repetition, I think. Okay, the table is given. So here it's there. Okay. So what is the table look like? Fair value of dairy cow aged on 1st of April, 1st of October, 31st of March, 1 year, 1.5 year, 3 years. Cost to sell a cow, that is last column, I think. 1, 2, 3, 4 they have given, and the last column I think is cost to sell. I think this should come something like this. Okay. Now it looks better in the material. I think it's so anyway, understood that cost to sell will come on the last column. You can assume that the fair value of a 3.5-year cow on 1st of April is 27,000. Past necessary journal entries for the above transaction with respect to the cows in the financial statements of XY Limited for the end of March 2 also show the amount lying inventory, if any. Okay, let's understand the cow's lifespan here. You had at the beginning 500. How many died? 20 died and 20 purchased. So I think 500 only at the year end also. So 500 was there, 20 died, 20 you purchased, and at the year end it is 500 ultimately. But out of 500, 20 is the latest purchased, which is just 1.5 years old, whereas the remaining 480 survivors who are not died are 3 years old earlier, now plus 1, so it is 4 years old. Okay, beginning value, let's try to understand. I think beginning value also not given. Beginning means the cows were all were 3 years old. So 3 years old, what is the value at the beginning on 1st of April? It is 27,000. So you can see that here 27,000. Okay, so 27,000 was the opening value of 3 years old. So 27,000 multiplied by 500. Okay, not 27,000. 1,000 expense also was there. 1,000. 1 per liter. Okay, that is different. Was there any expense on this cows? Oh, that will be in the table, right? Yeah, 1,000. Opening was 1,000. So your net selling price, you can say 27,000 minus 1,000, 26,000. 26,000 multiplied by 500. 26,000 multiplied by 500, and that is what is 1.3 crores is the opening balance. During the year, 20 cows were died, that is 20 cows, and they were 6 months old. Extra 6 months means 3.5 years old. Anyway, that does not matter. So to that extent, the value of the cows will be reduced, de-recognized. I would say that will be taken to P&L account. That to that extent, the cows died would be taken to P&L account. So 20 multiplied by 26,000, same as opening balance. 5,20,000. Thank God opening cows only died, which was purchased did not die. And there was nothing added in the year end. The closing balance is perfectly tallied. So 1st of April this is done, 1.3 crores. 1st of October this is done, 5.2 crores. And you purchased on 1st of October by paying on 1st of October. How many months old? 1 year. As a replacement, the cows were purchased. All the cows were 1 year old. That is your purchase price, the cost at which you acquired. So 20 cows multiplied by the cost of purchase would be 21,000. 21,000. Yeah, 21,000 multiplied by 20 cows, and that would be 4 lakh. But yeah, 1,000 expense. I mean, this also will happen in case of agriculture. A special point, try to remember this one. This means that on the date of acquisition, if you do fair valuation, the cost of acquisition is 21,000. But if you have to sell on the same date, you have to incur 1,000 costs, which means the fair value of that cow on the date of acquisition itself is 20,000. In other words, the fair value less cost to the cost to sell 1,000 going to be incurred. I will adjust it now itself on the date of, not on the year end, on the date of purchase. Therefore, 21,000 is the indirect fair value if I sell it, and 1,000 is my cost. Therefore, I incur 21,000, but 20,000 is my value of the cows. Indirectly, it means that 1,000 rupees is going to be transferred to P&L account as a loss on initial recognition. Initially only you are going to recognize a loss. I hope you are able to get this point. Okay. Yes. If it is kept for use, correct, you have to do valuation on the date of acquisition. For sale or for use, different. On the date of purchase, you have to value it. At the time of purchase, you have to value it. So what entry you pass, journal entry wise, if you think on this date, entry would be like whatever the biological assets account debit to cash. How much you are paying cash? You are paying cash of 21,000. And as on this date, I am valuing this asset, and the fair value of this asset is just 21,000 less cost to sell. You understand this point? Why we are doing this one? Let me show the chart. See if you are able to connect that point. Anyway, I'm not able to get it, but what a point I'm trying to tell is, you have to value on purchase as well as developed. At the time of acquisition, you have to value it on fair value basis. So you are acquiring on this date, the cost of acquisition is 21,000. As on this date, as on 1st of October, your cost of acquisition 21,000. You will pass an entry as biological assets to cash 21,000. As on this date, you value the asset. The fair value is 21,000, but the valuation is not fair value. The valuation is fair value less cost to sell. So 21 minus 1,000. So 20,000 is my fair value less cost to sell, but asset value is 1,000. So it's, I'm going to write like loss on recognition or something to biological assets 1,000. So that the biological assets now will become 21 debit, 1 credit. Effectively it will be debit of 20,000. That loss 1 will be taken to P&L account. So that's what this calculation, this table shows it. You are taking the value at 20,000 multiplied by 20, 4 lakh. Then 31st of March, this 480 cows continued, and they were having 3 years earlier. Now their age would be 4 years, and the value of 4 years cows is 4 years cows on 31st of March is here 4-year cows, 31st of March is 26,500, and the fair value less cost to sell. So 26,500 minus 1,500 multiplied by 480. Hope you get that. 480 multiplied 2,500, you get 1,21,90,000. The new cows purchased over 6-year-old, now it becomes 1.5 years old. So 1.5 years. Uh, 1.5 years old, the fair value less cost to sell, 1.5 years. Fair value is 23,500, less cost to sell 1,100. So 23,500 minus 1,100 multiplied by 20 cows. So that's what you would have done here. 23,500 minus 1,100 multiplied by 20 cows. This is the value of the value of the biological asset at the end of the year. Inventory, of course, is again valued separately. This is only regarding the biological assets related to cows. This table, see if you are able to understand. You don't have to show this table also. Directly you can calculate within brackets. That is also fine. Similar. The difference is, when we say NRV, it is net selling price. Selling price means you can take one-off transaction also as selling price. But fair value means what is fair to everybody in general. So difference will come there, but for exam purpose, more or less it is same. We look at the journal entry, but before that, any doubts on this? Again, these kind of questions you can expect in exam. This is study material question, can come. Correct. The difference on the date of acquisition and the difference as on the balance sheet date. This difference would be taken to P&L. And that on the date of acquisition, the fair value change, 1,000. That also will be taken to P&L, loss on acquisition. That also will come. That will be reflected here. The physical change and price change will be a notes to accounts information. Net amount, this is the net amount what we are calculating now here. This difference between these two will be the net amount. This you analyze. For example, this cow was 4 years, this was 3 years, this change 1 year, this 480, you multiply it by the 3-year cow as on date and compare that with this. That difference would be the price change, quantity change. That is the information to be provided in the notes to accounts. That will not have impact in our journal entries. That net amount will reflect both. Yeah, the total cost, that's what total cost will reflect. The breakup you go for the additional calculations if they ask. Otherwise that is not required. Okay, so let's go to the journal entries. Let's understand. On 1st of October, the loss of death, as I told you, what we calculated here just now, that is this 5,20,000, what is being subtracted. This will go to P&L account basically. Loss of death, 5,20,000, death of 20 cows. Then purchase of 20 cows, you do biological asset account debit to bank. Okay, they have directly done it on a net basis, is it 4 lakh? They have directly taken 4 lakh. What entry I showed you is 21,000 into 20, 4,20,000. Then expense is the loss you have taken into P&L account 20,000. They are recognized only on 4 lakh. Net impact is same. You can pass 2 entries or you can pass net 1 entry. Both ways it's fine. This is the transaction or the entry on 1st of October. And year ends, you have to account for remeasurement of old cows. Okay, you can do directly. They are calculating it separately. Anyway, you can pass one net entry, you can pass two separate entry, both are fine. Then let's just do the net amount. What is the net amount coming to? 1.28 minus this 1.26. Just find out the difference. 1 1 2,40,000. That's the net effect. They are showing it separately. Old cost separately, new cost separately. We can show one entry in the exam, that is also fine. They have shown separately, but that is also fine. Then, oh, they have not shown the entry for this. The milk in the year end, it has to be fair value less cost to sell. 20 per liter is the selling price. Fair value less cost to sell 1 rupee. So 19 rupees in the cold storage on the year end, 1000. So value will be 1000 into 19,000 will be as inventory valued on fair value less cost to sell in the balance sheet. Yeah, that's all. The biological assets amount and the amount of milk to be shown in the balance sheet. First you value on the date of manufacturing, on the date when the agriculture produce comes. That entry will be like P&L account debit, agricultural produce account debit to P&L. And on the year end we will revalue it on fair value less cost to sell basis. It is inventory not valued under Ind AS 2. Correct. That is why on the date of getting that milk we value on fair value basis. 20 rupees, yes. And in the year end we value it on again fair value basis. When Ind AS 2 will come, this milk, if you make it into cheese, make it as a product and then sell, that product will be valued as cost or NR, whichever is less, as inventory. Once it becomes cheese, it will be considered as inventory as per Ind AS. It's valued under Ind AS 2. Both are inventories. When it is milk as it is, it's an inventory valued under Ind AS 41. When the milk becomes cheese, it is inventory valued under Ind AS 2. Both are inventories. Valuation standard differs. Both will come under current assets. Yes. The valuation mechanism is different because I cannot apply Ind AS 2 for agricultural activities because the cost cannot be ascertained. So for that they have made a separate standard. Correct. At fair value. Milk to fair value gain or fair value agricultural produce. Milk inventory account is debited, the whatever the asset, the gain will be taken to P&L. Don't think it's entire gain. Cost also would have been taken to P&L. That will rectify. That will nullify. You would have incurred the expenses, the food given to the cows. All those things will be taken to P&L. Correct. That's exactly correct. We are recognizing the produce at fair value means there is an element of profit being recognized even before its sales. But we don't have a better choice. So we are compromising on the foundation principle that we have to wait for the sales to happen to recognize sales. We are not waiting. Means you should recognize it on cost basis, but we don't have it. So the reasonable method available is to go with fair value. The sale value will be 115. The sale consideration value will be 115. Revenue recognition. 115 is sales revenue recognition. That is when you recognize sales, when that milk is transferred, that is when the control should be transferred. 115 will apply. Or if you have entered into an agreement, all those things will apply. Yeah, 115 will apply on sales. On inventory, Ind AS 2 don't apply. We still value under Ind AS 41. Okay, next. Let's see, we'll understand anything different here. Company X purchased a beef cattle at auction of rupees 1 lakh. 100 beef, not 1 lakh each. Hope so. English sometimes we don't know how to interpret. It's like telling father hit son because he was drunk. So who was drunk? In English sometimes interpretation is possible. I hope it is not each, looking at the amount. On 30th September, subsequent transportation cost were 1 lakh 1000, that is similar to the cost X would have to incur to sell the cattle at auction. Additionally, there would be 2% selling fee on the market price of the cattle to be incurred by the seller. Before we go to the information on 31st of March, try to understand what amount should we recognize at this point in time. What is our cash outflow at this point in time? To bank, how much do I write? 1 lakh I'm paying towards the beef cattle and 1000 I'm incurring on the transportation cost. So to bank is 1 lakh 1000. 1 lakh on the payment towards the cattle and 1000 towards the transportation cost incurred. Total cost outflow is 1 lakh 1000. What would be my value of the assets? Value of the cattle. Fair value less cost to sell. What is the fair value? Same. 1 lakh only I will take fair value. Less cost to sell. Cost of transportation 1000. So 1 lakh minus 1000 I will do. It would become 99,000. But that's not it. 2% of the selling would be a fee on market price. So 2% on 1 lakh means 2000 more. So 1 lakh minus 1000 minus 2000, fair value will become 97,000. But my payment is 1 lakh 1000. So my loss on initial recognition is 4,000. Indirectly, 1000 I have spent it, 3000 I am going to spend it. Both of them are recognized now itself. Again, logically, why? Because I am recognizing fair value. Fair value means I am going to sell. Indirectly, that profit element that you're worried about, in a way it is being compensated. I'm going to make profit. I'm going to make expense. Now itself you recognize. Indirectly, that is the concept. Anyway, initial loss is 4,000. On 31st March 2002, the market value of the cattle in most relevant market access is 1,10,000. Transportation cost would be 1 lakh and auctioneer fees 2% would be payable by seller. So at this point in time, what would be the transaction, valuation if you do 1,10,000 minus 1,000 minus 2,200, I think, right? 2% on 1 lakh means 2,200. So what will be the value? 1,10,000 minus 1,000 minus 2,200. 1,06,800, and initially we recognized it 97,000. So the gain 1,06,000 minus 97, some 7,000-8,000. 9,800 is what is debited to biological asset, credited to gain on sale, transferred to P&L account. Revaluation, fair value of the cattle. On June 1st, X Limited sold 18 cattle for 20,000 and incurred transportation charges of 150. In addition, there was a 2% auctioneer fee on the market price of the cattle paid by the seller. So you are going to pass an entry, bank account debits, how much money is coming in, 20,000 is sold, minus 150, minus 2%. Yeah, that's all. 20,000 minus 150 minus 2%. 2% means 400, I think. So 19,450. 19,450 is the cost which you are transferring from biological assets, and you will transfer that to the cost of sales. It will go to the P&L account as a cost. And money receipts will be, yeah, the entry will be this 19,450. Account debit, selling expenses 550. The expense is what we just discussed. To revenue, to sales 20,000. But one more element will come, because you see we have already recognized some much amount earlier on the inventory. That also should be adjusted. How much we valued inventory as on this date, how much will be the value? I think you told 1,06,800. That is towards how many? Towards 100. and how much for 18? 19,224. But we are recognizing the cost at 19,450. We have already recognized the cost at 19,224. The extra cost is whatever the gain or loss, I don't know, the difference, it is taken to P&L account. The extra gain as compared to the cost. Just take a look at this journal entry particularly. See if you have any doubts. This is on the sale after 31st of March. Whatever was in the inventory is going to the P&L account as a cost. Two things are going. One is your actual whatever amount incurred, and other thing is the proportionate amount of inventory. Actually, you could have taken direct net amount also. You see 19,451 amounts you are crediting, and you're debiting gain of 226 and debit of 19,450, effectively 19,224, I think. That's what you are taking into P&L account, which is the proportionate of your inventory. From the inventory, it goes to P&L account. That's what our format, right? In the P&L, we do opening stock. It is considered as cost of sales in the year of sales. Okay, so that is this one. Then on 15th September 2002, the fair value of the remaining cattle were 82,820. Fair value only given. 42 cattle were slaughtered on that day with a total slaughter cost of 4,200. The total market price of the carcasses, I don't know how to pronounce it, on that day was 48,300. And expected transportation cost to sell these is 420. No other costs are expected. What else you are going to do it? So on this date, again you have to revalue the fair value change. You should take it to P&L account. How much would be the fair value change? We had earlier valued at 1,06,800, and now we are valuing at 19,000 something is sold. The remaining would be the fair value of the remaining 82 cattle. Let's calculate these numbers. So that was a number, right? 106,800. Was that the number? 106,800 or 106 something inventory. Okay. 106,800 relates to how many cattle? Relates to 100. We want to compare it with 82. So 106,800 divided by 100 into 82. Okay, 87,576 plus 19,450, right? You incurred additional, you purchased something, no, you sold. No, this will not come, sorry. Okay, whatever 87 you got it, this is now related to 82 cows. So divide by 82 multiplied by 42, because this is you could have directly done it anyway. So divide by 82 multiplied by 42, because 42 cows were slaughtered. We want that cost. 44,856. That's what they are writing it as. To biological asset transferred to P&L account. Just like we don't say cost of sales, we can say cost of slaughter and whatever it is. The remaining cows what we have now will be valued at fair value less cost to sell. Remaining cows will be 42, 40, 40. Remaining is 40. Okay, remaining 40 we don't have to worry. They only have given, I think. The market price of that day was 48,300. So 48,300, I think you'll have to incur some cost. 420, the fair value less cost to sell. So 48,300 minus 420. 47,880, and this is going to biological asset. Then to bank the amount spent on transportation, I think, some slaughtering cost, sorry. The balancing figure is the loss on remeasurement, also taken to P&L account. Both ideally. Anyway. Then subsequently, On 30th September, the market price of the remaining 40 cattle was 44,800. The expected transportation cost is 400. Remaining 40 we don't have to do per unit basis. They just told 44,800. Transportation cost you subtract 400 and minus 2%. 2% of 44,800 maybe 496 something. 296. So 44,800 minus 2% minus 400. 43,504. Now this is the fair value. What is the cost of the whatever our previous recognition? Previous recognition same process only, that is 106,800 was related to 100 cows, and how much related to 40 cows? 42,720. So 42,720 is already part of our inventory. We are valuing at 43,504. So 784. Why something is not adding up? Okay, how much you get? 7,000? 784. Okay. 784. Maybe that they're transferring that 19,450 also here, maybe that is which is being acquired, is it? They have sold it. They have sold, and why this is coming? Okay, 106,800 was on 31st of March. On September, have you done the revaluation on the date of sale for the existing inventory? No, right? We have accounted only for the sales, I think. We have not done any revaluation of this. We have transferred it to sales. Maybe they are incurring this amount also. They are including this amount also here. This 19,450, 226. We are transferring it separately. Maybe they are accounting everything in one line. So you do this. 19,450 is the cost. Subtract 226 and subtract 784. What they are transferring is on net basis. We are accounting for three separate entries. 226 we take it to P&L account separately. 19,450 we take it to P&L account separately, and 784 we take it to P&L account separately. All the three amounts, net amount, they are telling it as 18,440 here. So you don't have to worry about this thing. We are recognizing three entries separately, and all the three ultimately goes to P&L account. So that way you understand, that is sufficient. Which one? Together. No, no, they will transfer it to that ledger. That entry they have not done it. This 19450 and this 226, they will transfer to loss on remeasurement accounts. That entry they have not shown. Ultimate 18450 will go to P&L accounts as a net impact, as the cost of inventory or cost of remeasurement. They have shown one calculation, one amount, but it means that these amounts are not transferred to P&L. These amounts are transferred to this ledger, loss on remeasurement, and from loss on remeasurement they take it to P&L account. 226 already there, no? This one, this gain. No, they're not. They're showing it as P&L, but they're not reflecting that. No. No, they're showing it in the P&L accounts. Okay, they transfer 226 to P&L, and they transfer 19450 to P&L, and they transfer the loss on measurement to P&L account. Don't understand like that. They have shown gain on sale. What you understand is this: 226 is transferred to loss on remeasurement. 19450 is transferred to loss on remeasurements. This 784 what we calculated transferred to loss on remeasurement, and from here it goes to P&L account. 2, I would say. Yeah, they have accounted 226, but this will be transferred to loss on remeasurement. On a net basis, it will be taken to P&L account. Or you write loss on remeasurement. Don't write 18440. You write only that 784 7 something. You got it. Only that you write. Effectively, everything will be reflected in P&L account in the form of net loss on remeasurement. Okay, so that's about this Ind AS 41. Agriculture, again, this one of the ignored standards, so I thought spending a little bit more time, because usually in regular reading this is not given much importance. An institute knows to give importance. Area like this one, consolidation, impairment and goodwill, the areas which are not very comfortable for you to do revision or to read, I thought that is the time I have spent it here. And I think the institute also will focus on those areas in the examination. Okay, any other question on this agriculture? Looking at the time, I think we may not be able to do Ind AS 101, that is on that, because even though it's 101, it is actually all the other standard put together, and the analysis of financial statement, maybe that I may not be able to cover it, because analysis also is covering all the standards in one place. Maybe for those things I'll upload a separate video. Maybe I've done it already, but anyway, I'll just share it on the challenge once more. So only those things I may not be able to do it. Others I'll try to cover my level best today itself. Okay, fine. That is Ind AS 41 agriculture. Okay, so moving on to the liability standards, Ind AS 19. Quickly look at the charts, then we look at the problems. Employee benefits, there are 4 types. One is short-term employee benefits payable within 12 months. Long-term employee benefits beyond 12 months, that will be present value. Post-employment benefits, we have 2 types. One is defined contribution plan, defined benefit plan. Then termination benefits, that is when employee decides to leave or when the entity decides employee should leave. Short-term employee benefits, especially relating to this accumulating and non-accumulating, in the sense it's called as paid compensated absence. For absence, you get compensated. For CA students, we don't know that concept, but practically you have that. That is sick leave, casual leave, all those. You ask those things to your principal, they will tell you, you please leave. But other companies where there is employment obligation and all, Accumulating means the leave can be accumulated and can be utilized in the next year, and therefore to that extent also expense should be recognized. When we do the problem, we'll understand better. Non-accumulating means you don't have to recognize any expense. The challenges will come with respect to post-employment benefits. Defined contribution plan, typical example is gratuity. Defined provident fund, defined contribution plan example is provident fund, where entity contributes to outside entity and there ends the obligation, nothing else to be recognized. Whereas defined benefit plans, entity assumes the obligation of maintaining two things. One is recognizing asset as well as recognizing liabilities. Asset, that is what is fair value of defined benefit plan assets. Liabilities is the whatever your, for example, gratuity you're planning to pay after 20 years, but now only you have to recognize the proportionate expense based on the estimates. Again, this theory based, rather than this, let's take up a problem. You will be able to follow it better. Let's read some problems. Mr. Rajan is working for Infotech Limited. Consider the following particulars. Annual salary 30 lakh. Total working days 300 days. This is what we also say, when somebody comes to income tax filing initially, especially during your initial articleship period, you'll be looking at the form 16, like 30 lakhs, only so many number of days, and you look at your bank account and your bank balance will be the number of digits they will have in their salaries. Working days 300 days. Leave allowed as per company policy 10 days leave utilized by Mr. Rajan 8 days. Unutilized leave are settled by way of payment and accordingly carry forward of such leaves to the subsequent period is not allowed. Compute the total employment benefit expense for the year 2001 in reporting period. I don't know whether you are aware of it. In your articleship also you're eligible for like 1/6, 1/5 something of that total number of days worked. You are eligible for that leave. 99.99999% of the people I have not seen that will be not used because you don't get that leave, so no question of utilizing it. So unutilized portion, imagine if you get a catch for it. In articleship you don't get it, but here in employment you get unutilized leave. Also, popularly we call it as the leave encashment. So in this case what they are telling is you have paid salary of 30 lakhs. You recognize that as expense. Number of days allowed is 10 days, but he has taken only 8 days. So 2 days leave he can carry forward. I mean, it's not carry forward. To the extent of 2 days, cash is paid. Leave encashment. So when you recognize the expense, you don't wait till you actually make the payment in the next year. Because if you wait for actual leave encashment, that will be cash basis of accounting. Accrual basis means he has worked in this year and therefore the expense is relevant for this year. It might be encashed later. So for those 2 days salary or for those 2 days amount, which he will get it later in the next year as leave encashment, but in the current year only we should recognize the expense on accrual basis. And how do we do that? That I have small difference of opinion, but the standard does not say how to do it, so you can argue the way you want it. So what it is done is 30 lakh divided by 300, so they will tell you it is 10,000 per day and 2 days unutilized. So 2 days into 10,000 means 20,000 rupees is accrued expense. So what journal entry you pass is like this: salary account debit 30 lakh 20,000. You write like to bank 30 lakhs and then write to outstanding salary or provision for leave encashment, you write it as 20,000. Anyway, this is what institute says, straightforward, but I have a small difference of opinion as regards the calculation of per day is concerned. My opinion is it should not be divided by 300 days. It should be divided by 290 days. Because he is expected to work for 290 days. 10 days is expected. So it should be, in my opinion, 30 lakh divided by 290. that is the expenses is expected to work, and he has worked extra 2 days. So for the 2 days multiplied by 2, you recognize additional expense, is my opinion. But practically how it is calculated, there is no law regarding it. See, in inventory, normal loss we calculate. How do we calculate? Numerator is the total purchase price and all. Denominator is expected units. The number of units purchased minus normal loss. Then you calculate abnormal loss and all. According to me, that should be the calculation. But anyway, this is what institute has done. Let us follow this from exam point of view. Practically, that's a contract between employee and employer. However they speak, that will be the final terms. Okay, next. This is how practically is done. That is what exactly. So 30 lakh is for how many days of work? So how many days you have worked? In this case, how many days you have worked? So now you worked for less number of days. Then why provision should be created? You told that this 30 lakh is for 300 days of efforts, but you have worked for 298 days, so you have worked for lesser number of days. That's what I was telling. It's actually for 290 days. I'm telling logic. The thing is, these things cannot be explained to the general public, and therefore what everybody follows is what is convenient that everybody can understand. You're talking about amount. I'm talking about the efforts. The effort as an employer, what I'm expecting from you. Okay, just imagine you have worked exactly how many days you're supposed to work. You have worked for 290 days if you have taken entire leave. So if I compute the number of units, let's say if I compute number of billing hours to be billed to the client, I will bill for 290 only. I will not bill for 300 hours. So this 10 is an extra thing which I am taking. So indirectly, that 30 lakh should be spread across 290 days. That's the concept of normal loss I was trying to tell. You purchase worth 300 units, but I'm supposed to receive only 290 units. The 300 units cost expense I'm spread across 290. That expense will be absorbed. That is logical. Need not be real. Exactly. That's why 300 days you're taken. Otherwise, they should have taken 365 days. They have taken 300. That logic they partially apply. They're divided by 300 days. Actually speaking, it is 250 days. Because 2 days in a week, 52 into 2, approximately 100, 365 minus 100, 250 days is the working days. In that sense, they have taken 1 week, 1 day per week as holidays. But anyway, this is again very difficult to convince others, because it's purely mathematical. So it's logical but not real. So that's why practically also this is not followed in many places. What people mostly follow is this because everybody else can understand. It's more of a convenience rather than what is right. But anyway, hopefully, because Ind AS also is moving in that direction. Ind AS is more than convenience. We're trying to see what is supposed to be the real representation. That is what we are trying to do. So hopefully someday. Standard does not talk about this. That is why we have this difference. Maybe someday standard also might put telling that the calculation mechanism, they might tell whatever total expense divided by expected number of days. They might give you like that. Okay, but exam purpose, let's keep it simple. Number of days, salary, you will get the per day amount. Mr. Niranjan is working for Infotech Limited. Consider the following particulars: annual salary, number of days, leave allowed, leave taken, leave unutilized, first year, second year. Based on past experience, Infotech Limited assumes that Mr. Niranjan will avail unutilized leave of 3 days. So he has unutilized leave of 3 days, and you are expecting that 3 days will be utilized. Infotech Limited, it contends that it will record 30 lakh as employee benefit in the year 2001 and 1 2 stating the leaves will, if any, will be utilized in 1, 2. This also many people will tell, and many people follow in accounts as well, but we can't accept it. What they're telling is, here he has worked for 7 days, and here he worked was 13 days. So 3 days short and 3 days surplus. So that will set off. So ultimately my outflow is 30 lakh only. I'll recognize 60 lakh total 2 years. Seems everything fine. Again, many people also follow like this. But as far as the accounting at least is concerned, we should divide 30 lakh by 300, means again that 10,000 per day multiplied by 3 days. So here you recognize 3 days, 10,000 into 3 lakh. 3 lakh or 30,000? 10,000 into 3 days, okay. 30,000 rupees will be recognized as expense in this year. You are going to credit like to provision for encashment or to outstanding salary in the first year. Second year that will be debited, in the sense you are utilizing it. So 30 lakh is the expense, 30 lakh is the expense. Additionally, you are going to recognize, if you understand by way of a journal entry, it will be even more faster. So you are paying cash 30 lakh and you recognize 2 provision for leave encashment, that for 3 days unutilized leave. Next year when he actually uses, that will be debited. Provision for leave encashment 30,000 is debited, thereby that expense is adjusted. Ultimately, in the year in which he is working more, we are recognizing more expense, and in the next year when he is working less, we are recognizing less expense. That is the connection or basic concept of accrual. Expectation. That's what he is having. 3 days. In this problem, he is worked for 7 days. He is expected to work for 3 days. That he is not worked for 3 days. So to what extent we should recognize expense? Out of these 3 days, how many days is expected to utilize, or how many 3 days expected to be paid? What I was telling you is, how many days he utilized does not matter. How many days he is expected to work? 30 lakhs divided by 290. Whether he is taken 7 days leave or 4 days leave, my expense per day will remain same. The 3 days set off. The set off because in this case it happened. That's the maximum at least. That's the maximum he can set off. So how many days for which you have to recognize expense depends on the management estimate, the past experience. So in this problem, the experience is the management estimate that he will utilize all the 3 days. So you will recognize 3 days salary, and that's what you recognize, 3 days salary, and everything happened according to expectations. You recognize 3 days salary as a provision, 30,000 extra liability. Next year he utilized, you debited 30,000, that is set off. The question may come, what if he has not utilized and he cannot carry forward? Then also you will debit 30,000. This not as an expense but as a change in estimate. We estimated 3 days he will take, he has not utilized. So the 30,000 what was liability no longer be paid, you debit and close it, and you can transfer it to P&L, or you can adjust it in the employee benefit expenses account. Okay. This problem should ideally clarify that situation. Assume the same information as in the previous illustration. Based on the past experience, Infotech Limited assumes Niranjan will avail unutilized leave for 2 days. He has 3 days left, but the management estimate is 2 days. Indirectly telling, we will not allow him 3 days. We will give him permission only for 2 days. However, Mr. Niranjan availed its actual all 3 days brought forward from leave. Company telling we'll give you 2, he'll tell no, I will take 3. Ultimately, he ended up in taking 3. Compute the expense to be recognized and also pass the entries for both the years. So first year we don't recognize 30,000. We recognize only for 2 days, so it is 20,000. So first entry will be employee benefit expense 30 lakh 20 to bank 30 lakh to provision for leave encashment 20,000. And next year he was supposed to receive 30,000 benefit. We don't show the 30,000 benefit, or 20,000 only. We have the liability. Only that liability we can close it. So entry will be provision for leave encashment 20,000, employee benefit expense 20 lakh 80,000, bank account 30 lakh. Indirectly, if you observe, 10,000 extra expense we are accounting for it. How? Just imagine if 2 days was his expectation and 2 days what he actually taken as well. Or let's say, if you remember, 3 days was earlier in the previous illustration. What was the expense recognized? If you remember this was expense recognized as 29 lakh 70,000. 30,000 we debited. Now what happened? 20,000 we debited, but expense is 2980, which means additional 10,000 expense we are recognizing. Indirectly, he is utilizing it. Yeah, so whether he has taken 2 days or 3 days, our answer will remain same indirectly, because that's a liability we created earlier, and we are going to debit that liability and close it. Amount whatever you're going to pay will be to bank. The balancing figure will be taken to P&L account. Okay, so any other doubts in this vesting, non-vesting, accumulating, big calculation they have given, but that's all the answer. Okay, any other doubts? Okay, next. Let's do this also quickly. An entity has 100 employees who are entitled to 10 working days. The information of number is in words. Sick leave for each year. Unused sick leave may be carried forward for 1 financial year. So if you're not falling sick this year, you can fall sick next year, but not beyond that. Sick leave is taken out of the current year's entitlement and then out of any balance brought forward from the previous year. That is only 4 basis. So on 31st March 2001, average unused entitlement is 2 days. Maximum is only 2 days, so 10 days. Okay. Based on the past experience, the management expects only 20% of the employees will use only 1 day. So we don't recognize 2 days. We recognize as the expense only for 1 day, to the extent of management expectation, to what extent employee will use the leave. Salary per day is 2,500. Compute the expenses in terms of short-term compensated absences if they are assumed to be vested short-term, or if they are assumed to be non-vested short-term compensated absence. If it is vested, then how much we are going to recognize? Vested means they will be carried forward and they will someday will recognize it, even though it's a carry forward thing. So how many employees are there? 100 employees multiplied by how many days they are entitled. Management expectation of 20% all will not work. 10 days they are entitled, but you can't carry forward 10 days. You have to fall sick somehow 8 days. You can only carry forward you unused leave may be carried forward for 1 year. The sick leave is taken first years. Okay. Average unused entitlement is 2 days per employee. So 100 employees multiplied by 2 days per employees into 2,500 per day. So 100 into 2 days into 2,500, that is 5 lakh. That is if it is vested, means it will be utilized. It will not lapse. We are sure it will be utilized. If it is going to be lapsed, then we should take only to what extent management expects. That is what they are telling. 20% of the employees, so 100 employees multiplied by 20%, only 1 day, multiplied by 2,500, and that is where it lapse will happen, only 50,000. So the management estimation comes into play only in non-vested, where there will be a time restriction beyond which it will lapse. A company pays each employee lump sum one time benefit upon retirement. So basically they tell, take this retirement, don't come back. We are paying one time lump sum gratuity, you can say. The benefit is computed on the basis of employees' years in service in the company and final salary per retirement, even more typical case of gratuity because it is based on last drawn salary. To cover its liability from remuneration, the company contributes 3% of annual gross salaries to the fund. Would this obligation represent a defined benefit contribution plan or a defined benefit plan? Defined contribution plan means entity will contribute and the entity will not be further responsible for any changes in the value of investments or liabilities. PF is an example. But here entity is contributing, but ultimately it is the responsibility of the entity to settle when the employee leaves. So the risk still falls on employer, therefore it is a defined benefit plan. It is not a mediator. Which fund? Contributes 3% of annual gross salary to a fund. That does not mean that whatever is there in the fund is what you are going to give it to them. You have a responsibility of payment based on the final salary. So number of years worked multiplied by last drawn salary, that is the amount you have to give. How much is there in the fund? That is your management. The employer has the responsibility to make the payment based on the last drawn salary. What is there in the fund is the problem of the employer. Defined contribution plan. That's why it is not defined contribution plan. It is defined benefit plan. You are putting the money to a fund. Putting the money is your convenience. Whether you put it or not is secondary. There's no to cover this liability from this remuneration, meaning this is like saving. See, what happens is, let's say you want to purchase iPhone 1 lakh. I don't know whether amount is small. At least for example purpose, we'll take 1 lakh. So what, to save 1 lakh, you know that 1 lakh suddenly you will not have in bank account. So you contribute to a fund. You keep saving every month 5,000, 6,000. And after some months you see balance is 60,000. You go and tell, I have 60,000, I have contributed to fund, give me the phone. No, this is the fund for which I have contributed. The person say 1 lakh is the value. You contribute to the fund, you take it from your cash, you take it from somebody else's pocket, you give me 1 lakh. So this fund is, you should treat like a maybe mutual fund. You're invested in some maybe PMS, portfolio management service companies. So you have invested elsewhere so that you cannot take the burden of a big amount. To save yourself from big payments, because you know gratuity will be substantial payments, you invest somewhere so that you can take this money and give it to him. That's a convenience, or maybe in a legal restriction that the employer should not say I don't have money, so he has to save that money. Contribution plan means you put the money over there, you don't ask the employer, you directly go to the fund and get the money. PF is that's the case. So PF, this is what you should supposed to get. Employer is no way involved. PF office will give you the money. There are situations where the companies will take policy. They will take policy, either individual or a group, and they contribute to a separate established fund in that sense. That is a defined contribution plan. Because there the money goes from the fund directly to the employee. Employer is not involved. Here the fund is not that. The company contributes fund, but what is important is how the benefit is designed. The benefit is computed not on the amount available in the fund, not on the insurance policy amount. It is on the employee's now years in service and final salary to retirement. If they have taken any insurance policy to cover this and they take responsibility to make the payment, where employer responsibility is not there, you can say it's a defined contribution plan. To cover this liability means to manage that contingency, to be able to be ready with the cash balance. No, it is just that amount will be big. You want to be ready with the payment, ready with the settlement. Again, see, if you, the English may look like that. To cover the liability means, okay, we want to cover means you want to protect the risk completely. We come from that, we have to understand from the context. So the context is, to cover the liability does not mean moving away from the protection. It just means that to settle the amount on time. That's the point. Not covering the risk. I know the word cover may be for risk, but it is not covering the risk. What they say is the company will have to carry the risk in case funds assets are not sufficient. So you are using the fund, but you can't transfer the responsibility. So English also to be interpreted in that manner. So we say that behind every successful man there is woman. If you want more success, more hard work. So many times the context we have to apply. Next, Acer Limited provides lump sum remuneration upon retirement of its employees. Remuneration is paid out of the fund to which Acer Limited contributes 12% of annual gross salaries. Contributions are made twice a year, that is November in the financial year and June after financial year end. The total annual gross salary is amounted to 50 crores. Contribution made by the Acer Limited in November was 2.8 crores. Remuneration depends on the number of employees service and the amount of cash in the fund at the time of retirement. Acer Limited has no further obligation except for contributions. How this should be appear in the statement as on 31st March. This, the point here is, Acer Limited has no further obligations. Though this is a defined contribution plan. So whatever the amount paid will be recognized as expense in the year in which contribution is paid. No further liability, no further assets. So 50 crores. Okay, 2.8 crores directly they have given. 2.8 crores. 50 crores gross salary, 2.8 contribution made. Because you are supposed to contribute 12%, 12% of 50 means 6 crores, out of which 2.8 you already recognized, balance 3.2 will recognize as a liability, expense yet to be paid. 3.2 crores to contribution payable, 2.8 already paid, 6 crores your contribution, just like PF expense, goes to the P&L account. And that's why I usually tell in my regular classes, how you define different contribution plan, different benefit plan in real life is the way Indian parents and the other countries' parents teach the student, children, how they take care of it. That Indian parents make sure that they save the money for bringing up their children's, their education expenses, their marriage, and the future generation, grandchildren's and politicians and all generation together save the money. That is their defined benefit plan. What the foreign parents will do, we will take care of you up to the age of 15, 16. After that, it is left to you. We are not going to be bothered about your life. You have to live independently. That is defined contribution plan. Beyond that, we are not responsible. That's the irony. We copy everything from the West. Be it dress, habits, absolutely fine. Good things like time management, independent living, these things we don't take it. I wish this also would be copied. So basically what is happening is that they are copying our good things and we are copying their bad things. So in both ways the difference is increasing, and that will deviate further in the times to come. Okay, so that is about Ind AS 19 employee benefits. Any questions relating to this? Maybe I can do some asset ceiling or something. There's one concept called as asset ceiling. I'll take it up that. How will the following information be presented in the balance sheet of Udyog Limited? Present value of defined benefit obligations 2975, fair value of plan assets 2750, 2975, asset ceiling 175. Usually, how do we present in the balance sheet? It will be liabilities minus assets, net defined benefits. So liability value in this case is 2750. asset value is 2975, which is actually not normal. The liability was supposed to be higher, asset is supposed to be less. So difference coming to 225. This is the negative number of liability. Negative liability means we should show it as assets. But in asset ceiling is there that this value cannot realize more than 175. You know, prudence principle basically. We would like to limit ourselves only to 175, but the difference is coming to be, I mean, difference is there. The difference we take it to P&L account as loss on asset ceiling is taken to the P&L account there, because liability is more, I mean, liability is less, asset is more, but we cannot show more assets than 225. The excess 50 what we have, the loss on asset ceiling is transferred to no, this is actually calculated on the basis of how much asset in case you have to settle the liability today. Logically you think, what is the meaning of these assets? We have a liability of 2750 and we have a realizable value of asset of 2975. So if I settle this liability today, that means surplus will be available with me to the extent of 225. But is it really convertible into cash? Because you see here I have not done fair value, apply prudence principle and all I have not done. So if you apply those probability, risk into consideration, how much value you will receive, considering the volatility, probability, how much is the value which you actually realize, assuming you will set the liability today itself. That amount would represent 175. So you cannot go beyond that asset in the balance sheet. So whichever is lesser, the difference will go to P&L account. Okay, so that is about Ind AS 90. Ind AS 37, briefly, provisions, contingent liabilities and contingent assets. So basic definition of liabilities, it is a resource control, it is a present obligation of the entity having outflow of economic resources. Then what is a contingent liability? Normal definition of student regarding contingent liabilities, which may or may not happen, or we'll say may or November happen. Contingent liability definition is not a present obligation, it is a possible obligation depending on occurrence of an event which is contingent in nature. Therefore we use may or may not happen. So provision means it is also a present obligation where amount is uncertain, like provision for tax. So liabilities recognized, provisions is certain but amount is don't know, so that is also recognized. Contingent liability is just disclosed. But if the chances of happening that is remote, then even disclosure is not required. Contingent assets, unlike AS 29, contingent assets is also disclosed in the notes to accounts. And contingent assets are recognized in the year in which it becomes virtually certain. For example, insurance claims, you don't recognize the claim the moment loss occurs. You have to wait for the company to accept the claims. Then it is virtually certain, you can take it into books of accounts, you can recognize the assets, and from that moment onwards you no longer call it as contingent assets. In this context, the important variety which will come in exam is regarding onerous contracts. In general it's called as executory contract. Executory contract means there are two parties and both the parties have not performed the obligations, that is called as executory contracts, which is outside the scope of the standard. As an exception to executory contract, we have onerous contract, which means the expected cost exceeds the benefits you are going to receive. Ideally, if you wait for the accrual concept, you have to wait for that to happen. But applying the prudence principle, any anticipated losses, we would like to bring it now itself. So we'll recognize the loss in the year in which you anticipate. The same logic applies in construction contract, used to apply in AS 7. Now we will also apply it in Ind AS 37 and Ind AS 115. When the contract cost is more than revenue, the loss anticipated will be recognized when the cost likely to exceed benefits. A typical example from a exam question point of view, if you have to discuss, if you imagine operating lease or lease for that matter, that entity has committed for let's say 3 years, but for some reason they have to shift to the other location, they cannot stop making a payment to the operating lease, that lease payment, neither they cannot sublease to others, which basically means these expenses I'm going to pay over the next period of 3 years, I'm not getting any benefit. I don't wait for the 3 years, immediately full expense is recognized because there is no benefit. The cost fully recognized in the current year in spite of the fact that the rent accrues every year, but we are not worrying about the rental expense, we are worrying about the benefit. Loss is recognized, complete provision is made in the current year. So provision is made for onerous contract to the extent of unavoidable loss. There will be some situation where you have entered into a contract, and if you execute that contract, your loss is 50,000. If you don't execute the contract, you have to pay a penalty of 40,000. So you cannot avoid 40,000. The 40,000 will be your provision amount required to be made. So briefly, this is the standards. Maybe the chart quickly what you can apply, maybe this one. If the obligation is possible, you can disclose that contingent liability. If obligation is so remote, then you need not even disclose it. If obligation is present and with reliable estimate, you can make a provision for liability, but it's not able to be estimated, then disclose it as contingent liability. If not even probable, then even disclosure is not required. So liability is present obligation, provision is liability with uncertain timing or amount, and contingent liability means it's a possible obligation. Use these technical words while presenting the answer connected with these points. Okay, so let's take up some problems. ABC Limited is automobile component manufacturer. The automobile manufacturer has specified delivery schedule, non-adherence to which will entail a penalty. On 31st March, the reporting date, manufacturer has the delivery schedule for June 2002. However, the manufacturer is aware that he will not be able to meet the delivery schedule in June 2002. This is exactly the situation of CA students as well. We know the exam is coming up and we have to read all, but it's not done, and we know that it's not going to be completed as well. Determine whether there is entity has any present obligation requiring a recognition of provision. Again, this is what we were talking about as onerous contract, but how much is the amounts they're not given. Now there is a penalty, but is it a present obligation? It is definitely not a present obligation, because only when he actually fails to meet, that is when the penalty will arise. So there is no present obligation, but if this is treated as onerous contract, then you need a provision. So you have to write that sentence in the exam. There is no present obligation because the penalty is arising only in the event there is a delay. But if this to be considered as where you cannot avoid this, you can also avoid. How you can avoid? You are supposed to give something, you are not in a position, purchase from outside and give it to him. You can do that. So there is no compulsion that you have to incur penalty. But so if the answer has to be only up to this point, there is no present obligation, so no need to recognize any provision. But in the exam, don't stop at this point, go one step further. If the entity cannot avoid the liability, or there is no reasonable expectation of avoiding it, then it may amount to onerous contract, in which case the provision need to be recognized. So that additional point you can add in exam solution. Next, ABC Limited has obligation to restore the seabed. The restoration means decommissioning, dismantling in Ind AS 1(6), property, plant, equipment. It has caused and it has to pay penalty of 10 lakh. No, okay, restoration. Okay, it has to restore something. It has to pay penalty of 10 lakh on March 2003. Relating to this liability, ABC Management Limited consider 5% appropriate discounting rate. the value of money is considered to be material, calculate the amount you have to provide for 2001. So you should do a present value. So 1 by 1.05 press equal to multiplied by 10 lakh. I think approximately comes to 9 lakhs 7,000. Yeah. So make a provision. That's what decommissioning, dismantling, restoration, whatever name you call it. I still like this concept of restoration. So it basically means you should earn in life not only to live but also to die. You should save the money so that you not only think of my marriage, the house, and where to go, where children. Once I die, how my body should be treated, how it is to be, wherever the treatment and expense should be for that as well. The other people should not spend money on that. There is a sentence actually, somebody wrote that when you die, the money standing to your bank account represents the work you have not supposed to do in your life, because that work you did, you received the money but you are not enjoying it. So basically it's not a matching concept. You have worked but somebody else enjoying. So according to me, the life should be perfect matching concept, such a way that you work, you enjoy. You should not use others money and let others not use your money. That's where the world would be perfect. But one situation will arise in life. Everything will be okay, you can do matching concept, but what happens is throughout your life you work for living in your own house, in your own name, but that sale value you can't recognize. That concept is also there. That's it's what sale and lease back. You sell the asset, your own asset, you receive the money, then you can enjoy by paying the rent. Outsiders will not know you're paying rent. You are in your own house and you are enjoying the sale proceeds. And once you die, that will be taken by the other person. That why do you care it? And that's what actually it's also called as reverse mortgage loan. It is existing in practical life as well. Okay. Next, this is also restoration liability. Okay, I'll just quickly read it. Marico has an obligation to restore the environmental damage in the arena surrounding its factory. Expert advice indicates okay, so expert advice indicates the restoration will be carried out in two distinct phases. The first phase requiring expenditure of 2 million to remove the containment from soil area, and the second phase commencing 3 years later from the end of the first phase to replant the area with suitable trees and vegetation. Estimate cost of replanting is 3.5 million and the first one is 2 million. So 20 lakh and 35 lakh. Marico uses the cost of capital 10% discounting rate, and expenditure when incurred will attract the tax relief at the company's marginal tax rate of 30%. But when we discount, it should be before tax, because expenses are all before tax. Discounting rate also should be before tax. So 30% has no impact. Marico has not recognized any provision of such cost in the past, and today's date is 31st March. The first phase of the cleanup will commence in few months and will be completed in March 2003, so 1 year time. When the first payment of 2 million will be made, that is 2 million. Yeah, the phase 2 will be paid after 3 years later from the end of first phase. Calculate the amount to be provided. So this 20 lakh will be spent in the next 1 year. So discount 10% for first year, 1 by 1.1 equals to, that is 1. Second amount you are going to pay it after 3 years, 3 plus 1. So discounting rate should be for the end of 4th year. So 1 by 1.1, 4 times equal to, I think you get 0.683 something, multiplied by 35 lakhs. So sum it, that is the total amount of provision to be created. No, it is not incurred in that year. No, we are on 2002. The first phase of the cleanup will commence in few months and will be completed in 31st March 2003. So will commence. So in next 1 year you are going to spend the money. When you see the word Marico, I don't know what comes to your mind. Company, parachute, but that is not interesting thing. For me, the way they offer the GST rate on that parachute, that's what amazes me, because they pay GST as showing parachute oil as vegetable or the cooking oil. That's how they pay GST. They say parachute, we are selling it as cooking oil. What they do with consumer, I don't know. We am going to pay a GST. You follow that. GST means at least this should be known. That's the case which has been there for years, I think. That they are paying it as cooking oil. Anyway, the standard name is Ind AS 12 income tax, popularly called as deferred tax. Let me give the context for few minutes, then we look at the individual calculations and formats. The main purpose of introducing this standard is to convert from tax provision into tax expense, meaning converting from cash system to accrual system. So when you calculate profit as per Income Tax Act, you know we do like this: profit as per P&L account, add depreciation, minus depreciation, allowance, disallowance, and we arrive at the income tax payable. So there will be lot of expenses and income recognized in the current year, but due to the tax incidence, it might be taken in the next year. For example, let's say income taxable on receipt basis. So this year I have shown in the P&L on accrual basis the income, but my tax will not be this year, my tax will be next year. There's a mismatch. For that, I am going to create a deferred tax this year, because income is coming in my P&L account this year. The corresponding tax impact also should come in P&L account as a matching concept, matching my income. Actual payment might take place later. That is what is tax provision, but we want to show the matching concept: this year income, this year expense, this year tax. All connected things should be recognized this year, but income tax recognizing in next year will bridge the gap. That gap is what is called as the deferred tax. Ultimately, deferred tax is an amount created on temporary difference. Temporary difference between the accounting income and taxable income. But as per AS 12, we follow income statement, which according to me is more convenient. But Ind AS uses balance sheet approach. So we do it based on the balance sheet carrying amounts, which is again according to me is more logical, because we are talking about asset liability. So we should talk about asset balance sheet. But anyway, conceptually, let's talk about the temporary difference. It is arising in 1 year, it will be reversed in another year. In a way, this is the standard you have to adopt in your life, because at this point in your age, I'm sure most of the people will experience this. You joined a CA, your non-commerce background person, he would have joined, let's say, engineering. He was in some relationship, you're doing CA. He had a breakup, you're doing CA. He completed engineering, you're doing CA. He had a new relationship, then marriage, you're doing CA. And the children will go to school, you are still doing CA. This is a common phenomenon that every CA student mostly will go through. But every time you feel that, you should remember this standard, because it's all temporary difference. It is getting created, but there will be a day when all these differences will be reversed. But at this point in time, remember, you are struggling, no problem, an asset is getting created. It is getting accrued. We will get to a day where we will realize those, but we have to wait till the day it's actually realized. But unless it accrues, the realization will not happen. So the more effort, the more sacrifice, the more feelings, the more irritation, everything means the asset is getting created. So let's look at most common element of the deferred tax in that context is depreciation, because initially in case of income tax, we will have higher rate of depreciation. The asset will fall fast, but in case of books, we will have lower depreciation. Ultimately, it will also come to scrap value. So whether it comes fast or it comes slower, ultimately it is going to be reaching the same point in time. For that only we are going to create deferred tax asset. We'll be using some terminologies. Let me quickly go through it. What are those? Tax expense is a beautiful word which considers two elements. One is current tax, or you can say provision for tax. It's a tax consequence of current period, provision for tax. Deferred tax is a tax consequence of future, which means temporary difference. It is going to be adjusted in the future years. For example, we have the depreciation impact, expense disallowed this year, allowed next year, things like that. Or impairment in the assets. Asset revaluation we will do, but we don't pay profit, we don't pay any tax on that revaluation, those kind of things. Deferred tax asset, deferred tax liabilities. Current tax you recognize based on the information situation existing. The tax rate will be enacted, that is in the force, or substantively enacted. Sometimes in February budget would have happened, but the notification would have come in month of, let's say, April or something. It's still substantially enacted. We will take it into consideration. But if the year end is December year end and the February there is a tax rate change, that will not be considered, because as on 31st of December, the date on which balance sheet prepared, the act is neither enacted nor substantially enacted. But for March ending, yes, February budget will be a deciding factor. Deferred tax, it may be a liability or it may be asset. Yeah, you can set off also if you have legally enforceable right. The tax rate expected in future is what you are going to take it based on the information available on balance sheet date. We apply balance sheet approach. We don't apply the income statement approach. So how do we calculate? That is one new term called as tax base. Carrying amount is as per our regular books of accounts. Tax base means the amount for the purpose of income tax. Let's say the cost of the asset is 1 lakh. You provide a 10% depreciation, books 90,000 carrying amount, but income tax provides 40%. So 40,000, which means 60,000 is tax base. For the asset is not at all a problem. Usually people will find it easy. The problem will arise in situation where there are things like expense disallowed, outstanding expenses disallowed under section 43B because it is not yet paid. As per carrying amount, we will have the amount, as that is whatever the outstanding and rental expense. But as far the tax base is concerned, it is 0 because it is not allowed in income tax. So what you imagine is, if something is not allowed or not taxed, that means the journal entry is not passed in tax books. Keep this as a thumb rule. If something is allowed or not allowed, imagine from journal entry point of view. Is the journal entry passed in income tax purpose? If the journal entry is passed, that means it has a carrying amount, it has a tax base. If it is not passed, it does not have a tax base. Let's imagine one more situation. Preliminary expenses incurred 1 lakh. It is allowed fully in the income tax, I mean fully in the books purpose this year itself as per accounting standard. But for the purpose of income tax, it's 1/5, 1/5, 1/5, 1/5. So carrying amount would be 0. Entire amount would be transferred to P&L account. What would be the tax base at the end of the year? You spent 1 lakh, entire 1 lakh is allowed in books purpose. Income tax allows only 1/5 to be taken to P&L account. 1/5 will be written off. Means you have spent 1 lakh. Carrying amount became 1 lakh in the tax books as well. But out of which 1/5 went to P&L account, tax P&L. Therefore, 20,000 went to P&L. Remaining 80,000 will be there in the tax base. 1 lakh minus 20, 80,000. And that becomes 80, 60, 20 and 0, 40, 20 over a period of 4 years. This is tax base. Now the question is, the difference between the carrying amount and tax base will attract deferred tax. Of course, assuming it's temporary in nature. If it's permanent in nature, means does not have a tax consequence, we will not allow the deferred tax. The confusion mostly will be regarding whether should we provide a deferred tax assets or should we provide deferred tax liability. Again, keep it very simple. think from tax base point of view. That is the key. Think from tax base point of view. If the tax base of the asset is less, that means we have less asset. Less asset means deferred tax liability. Think from tax base point of view. Do not think from books point of view, because ultimately for us income tax officer is God. Treat like that. So tax base asset is less. So if I prepare the balance sheet for the purpose of income tax, I have a lesser asset. Less asset means less value liability. If asset is more, good, you create deferred tax asset. If deferred tax base of liability is more, liability more means bad, deferred tax liability. Liability, tax based liability is less, that means it becomes deferred tax asset. In the example I just gave you, preliminary expenses written off. Carrying amount is 0, tax base is 80,000, tax base is high. Tax point of view think asset is high, that means it is good, you create deferred tax asset. In other words, you can think like this: when tax base of an asset is high, it means in future years I'm going to get the benefit in the form of expenses. Deductible difference. This expense will be deducted in the future years. So this year I'm not yet get the benefit, I'm going to get the benefit. Deductible difference, it is deferred tax asset. If I have a liability being higher, it basically means I'm having more liability, I'm going to pay more tax in the coming years. Therefore, I will have not so good thing, I'll create deferred tax liability. It's called as taxable difference. Same thing applicable to your life as well. When you are enjoying life, be careful, because it might reverse in the future anytime. If it's a result of past suffering, that's okay. You are utilizing your deferred tax asset getting reversed. But if you enjoy it too much, the liability might be created, you might suffer it in the future years. So when you are enjoying, at least just be very careful. The same thing the standard also tells you indirectly, prudence principle. So if you are having deferred tax asset, you see this asset is not realizable in cash. You can't go to income tax department and say, see, I have deferred tax asset, give me the money. You can't collect money from them. But this is benefit receivable in the form of adjustment with respect to future income tax. And therefore the standard says, you want to recognize liability, go ahead, we don't object it. But asset, if you want to recognize, ensure there is future set off taxable difference. If you have deductible difference, you need to set off a taxable difference, then only you create deferred tax asset, otherwise not. This is interesting. Unused tax losses or tax credit. Tax credit means like a MAT credit. Unused tax losses means, I think I told you earlier, when we have profits, we pay tax to government. When we have loss, government should pay tax to us. But we can't go to the government and say that we can't sit outside government. We have losses, please refund our money. They will not give it to us. But in the future years, when you have profit, you can set off this and make the payment. So this loss also going to give you the benefit. So when you have losses, deferred tax asset is created because you can set it off. If you actually think in simple mathematics, you have profit, there is tax, profit after tax will come down. You have loss, there is tax, loss after tax will come down. That's the rule we follow. PBT into 1 minus T, we get profit after tax. Whether plus, minus, everything will be taken care. But anyway, the deferred tax asset will be on the losses, and deferred tax asset on the unused tax credit, or deferred tax is on the deductible temporary difference. And there is one super very important information which is in case of acquisition, business combination. You know, balancing figure, we call it as goodwill. So if there is a deferred tax liability, then we have goodwill. You know, liability increases means balancing figure, you see, asset also will increase. But if that goodwill is again difference, not allowed for tax purposes, means again on that you are going to create deferred tax liability. Again you create a liability, again you create an asset, again differences come. On that you create a liability, again you create the goodwill. So it's a loop which will never end. That's why the standard says if goodwill is not allowed for tax purposes, which will not be allowed because we prepare only individual books of accounts, we don't prepare consolidated for income tax purpose. So goodwill is not allowed in most of the countries, at least in the consolidated books. So goodwill recognition is not applied, or deferred tax liability on goodwill is not considered. That is one exception you need to keep it in mind. Or if there is no tax consequence, for example, loan amounts are different, but expense is not allowed as income tax, then on that also you don't create deferred tax asset. So the rule is very simple. You have more asset, deferred tax asset, more liability, deferred tax liability. Keep it simple. The only point is you think from income tax point of view, tax-based point of view. Everything else is taken care. And one more small point, again matching concept should apply, in the sense of wherever the element should go, deferred tax or tax should follow. So if you take revaluation reserve to OCI, the tax impact on that also should go to OCI. It is like that Hutch dog, no? One boy goes means behind that the dog will follow. Wherever the element goes, the deferred tax will just simply follow the corresponding element. So matching concept ultimately. Which one? That is not only for profits. That was there in AS22. That you have to earn profits. Here not only for profits, for even deferred tax itself, that point is there. There has to be a deductible difference in the future years. Just having a benefit that I'm going to get the benefit is not sufficient. Next year, I should be able to make use of it, because this will not come to me in the form of cash. This will come to me only in the form of set off. Be it a loss against the profit, or is the taxable difference against the deductible difference in the future years. So there has to be an element which you are expecting in the future year. This asset can be realized, which applicable for loss also. I should earn profit in future years. We use the word virtual certainty in AS22, but such terms are not there in Ind AS. They just say that there has to be a deductible difference. Okay, let's take up some problems around this. The directors of H wishes to recognize material deferred tax assets in relation to 250 crore of unused trading losses, carry forward loss, on 31st March 2001. H Limited budgeted profits of 80 crore for the year ended 31st March 2002. The directors have forecast the profit will grow by 20% each year thereafter. However, the improvement in trading results may occur after a couple of years to come at position of break even. Maybe Paytm problem kind of thing. It's an interesting statement made by the CEO of Paytm at the time of IPO. I don't know whether you know it. He told that the IPO price can be much higher than what we have quoted. We have left the difference as a value for the investor to realize. Now it is being realized. The market is currently depressed. Okay, maybe corona situation. And the sales orders are at lower level of the first quarter, and they were for the same period in any of the previous 5 years. H operates under tax jurisdiction which allows for trading losses to be carried forward only for a maximum of 2 years. Analyze where deferred tax asset can be recognized in the statement. Okay, the next year they have budgeted 80 crores. But it will increase by 20%, very good for them. But at present, if you look at the 2002, first quarter of 2002 only, forget about subsequent. First quarter of 2002 only, they were for the same period in any of the 5 years. So nothing improvement happened. And that is only 2 years. So looking at this situation, it is very unlikely that, exactly, they have used the word, it is unlikely that deferred tax asset should be recognized. Just imagine Kingfisher was showing deferred tax asset for so many years. I don't know who is the auditor or what they were verifying. And again, Kingfisher and all is a typical case study. Kingfisher took loan from banks, you know, by keeping what as the security, a pledge, intangible asset as the pledge. What intangible asset, you can cook up any amount you want, but this value realizable may not be there, and bank give you loan after that, and after that, and after that. That's why usually, at least when people say when you're investing, do not take the banks or do not invest in the banks who give loan to corporates. We should always invest in banks who give loans to retails. That's why still many times we feel HDFC Bank is more safer than other banks like SBI. And even I don't know whether you observed, if you follow stock market to an extent, whenever the Vodafone Idea shares change, the IDFC First Bank shares change, because their major loan is Vodafone Idea. So whenever they, sometime they get the suddenly feeling, okay, now the idea Vodafone Idea will revive, IDFC First Bank share price will increase. Then no, nothing is happening. Again, their share price will fall down. The different connection is interesting to follow. And deferred tax assets, you should go and search which are the loss-making companies like Paytm, Zomato. Are they recognizing deferred tax assets? Go and check their financial statements. It will be interesting. On 1st April 2001, S Limited leased a machinery over 5-year period. Oh, it must be a lease problem there. Ind AS 116. The present value of lease liability is 120 crore, discount rate 80%. Oh, we used to calculate this. Now they only have given. Maybe we should calculate the lease payment. And is recognized as liability and corresponding ROU asset on the same date. They have done everything. What's the problem then? ROU asset is depreciated under straight line method over 5 years. Annual lease rentals are 30 crore payable starting from 31st March 2002. The tax law permits tax deduction on the basis of payment of rent. This is absolutely beautiful real life situation. Assume tax rate 30%. You are required to explain the deferred tax consequence for the above transaction for the year ended 31st March 2002. Typical case to understand how to calculate tax base. ROU asset is straightforward. ROU asset is carrying amount is straightforward. Carrying amount is 120 crores over a period of 5 years. So initially you recognize liability also 120, asset also 120. So 120 divided by 5, you get 24, I believe. So at the end of the year you have 96. So 96 will be your carrying amount. Similarly, lease liability, opening balance was 120. On that you apply 8%. I think you get 9.6 minus lease payment. Oh, lease payment not given? Oh, given, annual lease rental. That's what lease payment. So 120 plus 9.6, 8%, 9.6 only. 120 plus 9.6 minus 30 crores. 99.6. This is the carrying amount of liability. Now as far as the net amount is concerned, it's 3.6. I can say net assets or net liability. Liability, no? Net liability. As far as the income tax is concerned, asset is not recognized, liability is not recognized, only expense is recognized, and that too taken to P&L account, and that would be paid also. So tax base of liability would be 0. So think from the tax base point of view. Liability is 0 and here liability is 3.6. Liability is less. Which one? If you want to show something, what will you show? No, my question to you is, you are asking why tax base is 0. My question is why, what else it should be? How much amount do you think you show, asset or liability? I mean, amount I'm not worried. I'm just want you to think. Asset means which point of view you think? Income tax point of view, if you want to recognize an asset, which asset is there? Is there any asset? There is no ROU asset. ROU asset they don't recognize. Is there a liability? They don't recognize any liability. So there is no asset, no liability, so it is 0. You may think, no, we are paying 3.6 crores. Should I consider any impact on that? That 3.6 crores is an expense and I paid the amount also. So if you think, I have to pass journal entry in income tax books. What journal entry I will pass? In income tax books. Lease rental to bank, 3.6 crores. P&L to lease rental, 3.6 crores. Over. Do not think from liability point of view. Think what remains in the balance sheet. Nothing remains in the balance sheet because expense account is closed. If expense is outstanding, this 1.8 will come in the balance sheet if it is yet to be paid. Therefore, liability is 0, net liability 3.6. So as far as tax base is concerned, the liability is less. 0 liability. Liability less means it is good. So you can create a deferred tax asset. And we follow balance sheet approach. So whatever amount we calculate deferred tax is the closing balance of asset, and we should compare with the opening balance. Difference is what will go to the P&L account. A very typical scenario applicable Ind AS 116 learnt with Ind AS 12. So please read and tell me if you have any doubts. Important one in my opinion for exam as well. So if you can just connect the business combination, or maybe I can take up in some other problem I'll explain. But anyway, first you get clarified this one, then we'll take up other situations. This is important one, so doubt get it clarified. No doubts? I think okay, good. This situation is definitely have been asked in the exam. Popular, possible, realistic. That is in case of business combination. So in case of business combination, before I read this problem, let me just give the context quickly. Just imagine in the books of whatever the subsidiary company, not subsidiary, the acquirer or acquiree, A company acquires B company. It has, let's say, carrying amount of 60 lakh and tax base of 75 lakhs and fair value means it is taken over at 80 lakhs. How much deferred tax will you create, or what is the difference? Let's say the tax rate is 30%. Should I calculate between 60 to 75, or should I calculate between 60 to 80? Should I calculate between 75 to 80? At the time of business combination, if I calculate incremental deferred tax, if I talk about it, that means, or in other words, in the books between 60 and 75, it would have been already calculated before even we coming to the business combination. Carrying amount 60, tax base, we are talking about an asset. Think from tax point of view. Is it asset or liability? Asset 75 tax base, carrying amount 60. So from the tax base point of view, asset is high. Asset is high means you are going to create a deferred tax asset. Asset is high, deferred tax asset. Asset is good. 30%. This is existing. Like 15 into 30%, I think 4.5. Now you come to the fair value of 80. Now fair value of 80 is the incremental amount from what number? From 60. Not from tax base. Tax base will not change. Now 60 becoming 80, therefore what you are going to create? Deferred tax asset or deferred tax liability? Already created only between these two numbers, right? Now our new carrying amount becomes fair value of 80. Or in other words, you can think like this. Carrying amount 60, fair value 80. Therefore, you are increasing the value of the asset, but you are not paying any tax on this. So you are going to create a deferred tax liability of 20 multiplied by 30% is 6. Net effect basis 6 deferred tax liability, 4.5 deferred tax asset, net deferred tax liability of 1.5. Actually, we don't do any of this circus. What do we do is what is supposed to be the closing balance of deferred tax. Tax base is 75, fair value is 80, tax base of the asset is less. Therefore, we have to create deferred tax liability 5 into 30%. 1.5 should be my closing balance of deferred tax liability. But in the examination, what will happen is, in some problems, they may not give you the tax base. If they give you tax base, you go for the closing balance you get. But when they don't give you tax base, what you do is carrying amount, and you take fair value, carrying amount, you deem it to be deem it to be tax base and calculate the amounts. The fair value will become the carrying amount. I'll just repeat the last point once more. In case of business combination, if tax base is not given, in that case, the carrying amount, you deem it as tax base, because this carrying amount is already compared with the tax base and impact is already taken care. The fair value what comes in, that you take it as new carrying amount. So different this to treat like trial balance, treat like tax base, treat like carrying amount. Between these two, you calculate deferred tax asset or liability based on your regular understanding. Any confusion on this? Because this is again a very repeatedly confused area for students. That is why I am creating deferred tax liability. Depends on the amount is more or less. If the fair value is more, liability. Fair value is more, liability. So if carrying amount is 60, fair value is 80. Now this amount you treat it like a tax base. This 80 you treat like a carrying amount. You see tax. I'm just telling you to remember to apply. Now this amount is less. Therefore you create deferred tax liability. You will be paying. I will pay. You will pay, I'll tell you. So this is not business common, this is general doubt, in general thing. Let's say carrying amount is 60, fair value is 80. Let's say no depreciation also, and next year you sell. You sell for 100. You sell for 100. So what will be your profit? 40. And here profit will be 20. In your books this year, in the year of sale, you show only profit of 20, but you will be paying tax on 40 rupees. But that year tax 40, I cannot show full amount. Already I would have shown deferred tax liability for this 60 to 80. And then this 80 to 100 additional liability, I will show it in the year of sale. So that way, I will pay tax in the year in which asset is derecognized. Or if it is depreciated, it will be in the form of depreciation. That is why the value in which you realize the asset may be by sale or maybe by use. That's what ultimately they say. There has to be a deductible difference to recognize asset. Anyway, that is a different matter. You will recognize, you will pay tax in the year in which you sell the asset. If fair value is more, profit will be less. That will offset. Okay, let's read this one. On April 1st, 2001, A Limited acquired 12 crore shares representing 80% stake in B Limited by means of cash payment of 25 crores. You acquired 12 crore shares by means of cash payment. But what is the net assets? We don't know, because that only will give us an idea about any goodwill or NCI. The market value of equity share in B Limited on 1st of April can be used for this purpose. So the non-controlling interest is valued at fair value. On 1st of April, the market value of B Limited was 2 rupees. On 1st of April, the individual financial statement showed a net assets of 23 crore. The directors of A Limited carried fair value exercise to measure identifiable assets and liabilities, the following matters emerged. Property having carrying value 15 crore, estimated market value 18 crore, plant and equipment carrying value 1 crore, estimated market value 13 crores, inventory in the books of B Limited 2.5, fair value is 3 crores. The fair value adjustments have not been reflected in the individual financial statements. Yes, they cannot do it because it is outside the books. In the consolidated book statements, the fair value adjustment will be regarded as temporary difference for the purpose of computing deferred tax. The rate of deferred tax to be applied for temporary difference is 20%. Calculate the deferred tax impact on the above and calculate goodwill arising on acquisition of B Limited. Which standard is this? I think they should first give the question. Can you identify the which standard it is? If yes, then read further. If FR comes with multiple choice question, I think that will be one of the question. Identify which standard is this. It is Ind AS 110, it is Ind AS 103, and it is Ind AS 12. I think this problem, if we can solve, we can go to next problem. Okay, I think this one problem should be enough to understand the deferred tax elements. Okay, let's talk about the consolidation basics. What is the net assets? The individual financial statement showed a net assets of 23 crores. And if you remember, I was telling they will not give you the tax base. So when they don't give you the tax base, you assume the net assets as tax base. Because the difference, if any, would have been already taken care in the existing deferred tax liability. So for the purpose of calculation, you assume the carrying amount itself is tax base. The new fair value becomes the new carrying amount. Okay, so 12 crore shares they have acquired. Okay, and what is the purchase consideration they have issued? 25 crores cash payment. They have acquired 12 crore shares. The market value, okay, what is the value of net assets? And they said they want to value it on a fair value basis. So when you want to value it on fair value basis, which company's the share price I should use? Common confusion, be careful. One is this 2 rupee per share, other is, that's all given. Oh, okay, then there will not be confusion. But in the exam, they'll give you both the companies actually. Anyway, A Limited acquired B Limited, and we are valuing the NCI of B Limited, meaning share price of B Limited is relevant. They have given only that. Good people, nice people. But see, examiner may not be that. They might give you A Limited share price also. So don't do too much adventure by taking average or whichever is higher and all. Take just NCI relevant for subsidiary company share price. So you acquired 12 crore for representing 80%. So how many is NCI? How much for 20%? 1/4. 3 crores. 3 crores multiplied by 2, 6 crores will be the value of NCI. 6 crores, yes, that's what we are telling. It will be the value of NCI. Okay. Then the format, you know, goodwill or calculation will be whatever the purchase consideration plus fair value of NCI minus net assets. Purchase consideration 25 crores. Sometime they issue shares instead of paying cash. That time A Limited share price is required. It may happen in exam. This may or next November, I don't know, but it may happen. 25 crores, fair value of NCI, we just calculated, 6 crores. Net assets is 23 crores, the existing value 23. Then all these changes one by one. Property carrying value of 15 crore, estimated market value of 18 crore. So change is 3 crores. So plus 3 crores property. Then inventory is 2.5 and the 3 crores. So inventory 0.5. property is how much? 15 to 18, 3 crores only. Okay, what else is there? Plant equipment also was there. Sorry, plant and equipment having carrying value of 1 crore. Oh, it is too much. When we see the solution, 11 crore. Oh, typing mistake. Yeah, plant and equipment cannot have so much of difference. Land and building actually is okay. That must be a typing mistake. So make it as this 11 crore. This plant and equipment, not 1 crore, make it as 11. So 11 to 13 means you get 2 crores. 2 crores. All are gain only. Okay. Now on these amounts, 3.5 and 2, so you understand these are fair values. Fair value means as far as tax base is concerned, it is less. These are the fair values becoming carrying amounts. So these are the book values becoming higher after the acquisition. So there is a gain, but not, you are not going to pay tax. You can say you are going to create deferred tax liability. The asset is less. As far as the tax base is concerned, the existing carrying amount is less. Existing carrying amount is tax base less. 20% on these numbers. So 3 plus 2 plus 0.5 into 20%. 1.1 is liability, so you can subtract. So 23 plus 3 plus 0.5 plus 2 minus 1.1, that is the net assets. 27.4. So that is what you are going to get as goodwill. Goodwill, 27. 31 minus 27.4. 3.6 goodwill. And that's the solution, which is what institute has given. 25 plus 6, 23 as per books, fair value addition, plant equipment fair value addition, inventory fair value addition. So 27.4 and then 25 plus 6 minus 27.4, you get ultimately goodwill of 3.6. What is the next level of torture in exam? They might say this is impaired. And we will transfer this impairment to NCI as well as ConPL because it is on fair value basis. As I told you, one more level of complication. What they can do is, instead of giving the cash directly, they might tell you A Limited has issued its share. And to complicate further, they will not tell how many shares are issued. They will tell 2 shares for every 3 shares held. So again, you will know which number to multiply. So you should take 2 by 3 multiplied by number of shares of B Limited multiplied by share price of A Limited, because B Limited's shares, when you multiply it by the swap ratio, it results in A company shares. So you multiply it by A company shares. But when you take number of shares of NCI, it is still B company shares only. So share price of B Limited. These are the small areas. They can complicate further in exam, but ultimately this is the concept. I hope the deferred tax concept is to what extent is manageable. Okay, any other doubts in the deferred tax or income tax? Okay, no other doubts? The deferred tax, good. Okay, so next standard, Ind AS 21, effects of changes in foreign exchange rates. We'll briefly look at the charts summary. The standard takes into consideration 3 types of currencies: functional currency, foreign currency, and presentation currency. Functional currency and presentation mostly are same. Like for example, in case of India, functional also India, rupee, presentation also rupees. But in some situations where even though it is in India, it is predominantly exposed, influenced by some other currency, in case of like a foreign subsidiary, in those kind of things, functional currency may be different from presentation currency. Foreign currency is anything apart from functional is presentation currency. Or the word we use is a primary economic environment in which the entity is operating. Conversion rules is what you need to keep it in mind. If the functional currency and presentation currency are same, then it's easy. I mean, this is one rule. Monetary items are converted at closing rate. Monetary means having a fixed amount. Non-monetary means things like investments, inventory, the values are not fixed. Even share capital, reserves and surplus, they'll also come under non-monetary. They will be at historical rate. Revenue, expenses, P&L account items, at every differences we take it to P&L account. One star, because if those items don't go to P&L, for example, if you have taken something to OCI, then the corresponding exchange rate also will go to OCI. Wherever the item follows, the exchange rate also will go there. If the functional currency and the presentation currencies are different, then it will have two-step process. From the functional, you have to come to the, from the foreign, you have to come to the functional. From the functional, you go to the presentation. Transactions in foreign currency convert into functional currency. Monetary items at closing rate, the difference is this. Non-monetary items at historical rate, revenue and expenses at average rate, difference is taken to P&L account. This is same, because ultimately we are converting from foreign currency into functional currency. But because presentation currency is different, only for the purpose of presentation we are doing one more adjustment. This is a regular process, you see replica. But in the last step, that is, we are only for the purpose of presentation. It is not actually done. It is not actually the reporting purpose. It's not internal calculation or influence purpose. Only for the purpose of reporting, we are going to convert this trial balance or the amounts into different currency. Therefore, everything will be calculated at closing rate. And difference will not transfer it to P&L, difference will transfer it to OCI. The reason being, this is temporary in nature. And therefore, it is to be reclassified in the year in which any foreign subsidiary or foreign operations are sold. That is called as it is with recycling. So this is what is major conversion rules is all about. Yes, and one more small point. If you use the non-monetary items like fixed assets will be at historical rate, but if fixed assets are valued on fair value basis, revaluation model, then we will take the closing rate only, because it is standing on that point in time we are doing revaluation. Corresponding rates only should be taken as if you would have purchased on the date of revaluation. Okay, these are the, actually this is the only important point you should remember on a summary basis. Let's take up some problems. Hope you will get more idea over there. On 30th Jan 2001, A Limited purchased machinery for $5 lakh from USA suppliers on credit basis. A Limited's functional currency is rupees. The exchange rate is 60. Fair value of the machinery determined on 31st March is $5,500. The exchange rate on the 31st March is 65. The payment to overseas suppliers done on 31st of March and the exchange rate is 67. Same 31st, okay, next year, 31st March 2002. Exchange rate is 67. The fair value of the machinery remain unchanged on 31st March 2002. Prepare journal entries. Assume tax rate 30%. Okay, so the first entry is to purchase the machinery. Machinery account debit to, let's say, trade payable, $5,000 multiplied by 60 rupees. So machinery account to trade payable 3 lakhs. Then in the year end, exchange rate became 65. 60 becomes 65. So what will happen to your liabilities? Liability is to be accounted, and machinery also is revalued, because they said on fair value basis. they have shown later. Okay, so let's first focus on the asset, then I'll go for liability. Asset wise, it is revalued. We don't know any depreciation, so let's just talk about the machinery value. It is revalued at 5,500. 5,500 multiplied by actually it should be the closing rate. It should be 65 in my opinion. I'm not sure whether I've taken 60 or 65. Let us read. Oh, they have taken 65. Good. Oh, they have taken past two separate entries. One they have taken for 60 rupees, then they have taken for 65. We can pass one entry also. Even though it's non-monetary, why we are not taking this? Because it's valued on revaluation basis. So I'm taking the closing rate. If you follow cost revaluation cost model, then I'll take the historical rate. So the closing value of machinery should be 65 into 5,500. Just calculate 65 into 5,500. 3,57,500. So 3,57,000 minus 3 lakh means 57,500. We can pass two separate entries like this, or we can pass one straight away entry. They have passed two entries. One for the change in the value in dollar terms, and then they accounted for the change in the exchange rate. We can pass one entry straight away. That is sufficient. So totally you will have 57,500 is transferred to OCI. The revaluation reserve transferred to OCI. Exchange difference will not come here. I know I'm showing it as exchange difference, but it is not really in the nature of exchange difference. It is in the form of revaluation of assets. So it should go to OCI. That's what they have transferred. Both entries they have transferred, or together we can take it both way. Impact is same. And in this case, again, you see the revaluation reserve comes. This means there is going to be a deferred tax liability. The reason is revaluation done, but we are not paying tax yet. Or if you think from asset liability angle, tax base angle, the tax base will be still at 3 lakh only, whereas carrying amount have been increased. So from the tax base point of view, it is less asset, therefore it is liability. In simple words, it's a gain, but not, you are not paying tax yet, so you are going to recognize deferred tax liability at 30% of total 57,500. FCTR account will apply only in case of foreign operations. You are converting the foreign trial balance into rupee trial balance, only then FCTR will come. No, it's due to revaluation. Exchange difference also there, but we are ultimately recognizing the value of asset as on date. Mathematically it involves exchange rate impact as well, but what we are trying to reflect is what is revaluation. Today if I sell the value, what is the amount that should be reflected? So it should reflect the that day exchange rate. So difference is arising not because of exchange fluctuation, the difference arising because of method of PP valuation. Why I'm stressing on that is because if they followed cost model, this would not have come. Even though there is exchange rate difference, it would not have come. Even though, because it is, the reason is not because of the exchange rate, the reason is because of our revaluation model. So for that reason, it is taken to revaluation reserve. Loss, this is 60 becoming 65. This loss 5 rupees multiplied by $5,000, that will be transferred to, oh, that they have not shown, no? Oh, okay, that entry they have missed it. Anyway, so we should account for the liability remeasurement also, because you have to pay more liability. More liability means it's going to be a loss, and that loss you don't create any deferred tax, because that loss is also allowed in income tax purpose. The loss on whatever translation difference you calculate, that is also allowed in income tax, profit and loss, debtors, creditors, those things. So that you don't worry. So there, I think that loss we are not accounted, but anyway, 5,000 multiplied by 60 to 65. This 5 rupees multiplied by 5,000, 25,000. We are going to write it as loss on exchange, loss on foreign exchange difference, to creditors, or to trade payables. This entry has to be passed. And when you make the payment, it became 67. So the creditors account will be debited with 65, 2 rupee loss, and then to bank you write 67 rupees. That is regarding the payment. But what will happen to the asset in the next year? Should you revalue in the next year as well? 31st March 2002. We should still revalue it. What remains unchanged? The fair value of the machinery remain unchanged in terms of dollars, but when you convert rupees, it's still changed. So where you are going to do $5,500 but multiplied by 67, the 2 rupee change is still there because we follow revaluation model. That again should be transferred to revaluation reserve. 5,500 multiplied by 2 rupees. So don't fall for the information. Fair value unchanged, so revaluation reserve will not come. It will not come if I am in USA only. But I'm in India. I know it's due to exchange rate, but exchange rate has having an impact on value of asset. So value of asset is what is changed. May not be in original terms, but in rupee terms, I should reassess. And it's not exchange difference. It is change in the value of the asset. Why no more relevant? No, but that is not the reason why I'm valuing the asset. I'm valuing the asset. If I sell this asset, how much do I get? I have the asset in the balance sheet at $5,500. If I sell this asset in the market today, what value of the asset would realize? So it's not on the liability to be paid, it's my realization of asset. We are following revaluation model. So revaluation model means whatever the market value should be reflected in the balance sheet. It may be because of the original rate change, or it may be because of the exchange rate change. Both will go to revaluation reserve, not to P&L account. But on the liability side, exchange rate is because your liability is being reassessed. That will definitely go to P&L account. And that is also allowed in income tax, so we don't require any deferred tax. And on this also you have to create deferred tax next year. Anyway, they missed it. That again is not trade receivable, it should be trade payable. And this entry 65 is correct, 2 rupees correct, but for 60 rupees, 65 rupees entry is missed. That entry should be passed in the previous years. Okay, they have passed it directly here. Trade receivables, no, trade payables. Fine. This is one. Okay, let's take up this one. Entity X is an Indian entity whose functional currency is Indian rupees. It has taken plant on lease from entity for 5 years to use the manufacturing process, to which it has to pay annual lease rental in USD 10,000 every year. On commencement date, exchange rate was 68. The average rate for year 1 was 69. At the end of year 1, exchange rate is 70. The incremental borrowing rate of company X, commencement of the lease for the USD is borrowing 5% per annum. How will entity X measure the right of use of the asset and lease liability initially and at the end of year 1? It looks like big problem. It's very simple, straightforward. You compute the lease payments, you do the present value, then you can multiply it by the exchange rate. It is as simple as that. So what is the lease payments will be 10,000 for a period of 5 years. Discounting rate is 5%. So 1 by 1.1 equals GT also you can do, multiplied by 10,000 multiplied by the beginning rate. Average rate will not know at the beginning. Beginning is into 68. What is it present value comes to? You can do it one line in the calculator, or you can do year 1, year 2, year 3, year 4, US dollar, discounting rate, multiply present value. That also you can do it. Just check it in calculator. 1 by 1.1 equals to 5 times GT into 10,000 into 68. Discounting rate 5, yeah, 0.505. 5%. 1 by 1.05 equals to 5 times GT into 10,000 into 68 into 68, that is after multiple exchange 29 lakhs 44,000 something. That's what they have done in this big table. They have applied the exchange rate at each stage. That's all the answer. Anyway, let's read what else they have done. So initial lease liability is 43,300 in US dollar terms. This is interesting. This, let's take a look at it. 43,300 they have calculated in US dollar terms. That then we multiplied by 68. That's how we got this number. 43,300 on that 5%, 2165. This like opening balance of lease liability plus interest minus lease payment, closing balance in lease liability terms, 35,465. Now this 35,465 is the closing balance. So we'll take the closing rate. It's considered as a monetary item. You are having a obligation to pay financial liability. You can say it's a monetary item. So, but this 2165 is the interest expense, which you will take it at average rate because they've given average rate. If they're not given, I would have taken any closing rate available. So the 2165 is multiplied with the average rate. How many times they again multiply? Okay, 1,49,000 you get interest expense to lease liability. Then lease liability to pay cash, that is 10,000 lease payment you would have paid at the end of the year, and if the exchange rate is 70 rupees. So lease liability to cash 7 lakh. Actually one more exchange difference will come. They are not showing it. This exchange difference closing also to be reassessed. This 35,465 should be multiplied with the closing rates 70, and the liability reassessment again will go to P&L account. That is 70 minus whatever the amount. They have given. Accordingly, lease liability will be measured at 2482,550. Okay, that entry they have not passed. They have given here. So 35,465 multiplied by this. Okay, I'll do one thing. I'll just show you the calculation little bit in one space only, so it'll be more clear to you. So what I will do, only the one first table that I will show it here. So this one, lease payment 10,000, I am going to write it as into 70 rupees, and this 2165 I am going to multiply it by average rate, which is 69, and the closing value will be multiplied by 70, and this initial value is multiplied by 68. Now this opening amount, lease payment, I'll subtract lease payment. This interest expense account I'm going to add. So I get this one number, and this closing balance I get one more number. This difference also should go to P&L account. I think institute has not shown that maybe, but that should also go to P&L account. That opening balance, whatever initial recognition liability I've done, lease payment at the closing rate, interest expense at average rate, closing value at the closing rate. So you first calculate what is supposed to be the closing rate. This is supposed to be the closing rate. Opening balance plus interest expense minus lease payment will give supposed to be the closing rate. Okay, if you calculate that also quickly, so 43,300 into 68, 29 lakh 44,400, 10,000 into 70, 7 lakh, 2165 into 69. 1,49,385. So if I subtract this 7 lakh and add 1,49,385, I will get 23,93,785. But what is this balance actually you get? 35,465 multiplied by 70, 24,82,550. This difference again should come to P&L account. 88,765. That is a loss. Let's see if Institute has calculated this number. They have calculated 88,765. And on ROU asset, that is that will not be remeasured. So initially, whatever we have taken, that is 29,44,400. On that only you are going to provide the depreciation at the rate of 5 years divided by 5, 20% divided by 5. That will be your ROU asset, depreciation, transfer to P&L account, depreciation expense. That will not be remeasured. That you can say a non-monetary asset. Okay, so that can be asked in exam. Who knows? Important. Okay. Anything else in Ind AS 21 that you have any doubt? We don't calculate the difference directly like we used to do 67 minus 65 multiplied by dollar. That approach we can't apply here. This is applicable to this and also foreign borrowing. If you have taken any foreign borrowing dollar, same thing we apply. Opening dollar plus interest in dollar, closing dollar, repayment after that. Then closing rate multiplied by the closing dollar, interest expense multiplied by the average rate, the payment multiplied by the closing, opening multiplied by the opening rate, like the way I showed it, and balancing figure. That is how you take it to P&L as the exchange difference. Follow the same process even for foreign borrowings. Okay, next. Next standard, Ind AS 24, related party transactions. Certain interesting terms are there in Ind AS 24. They don't use the word relative rights. What word they use? Close member. Anyway, so basic thing is there has to be these three elements for you to call somebody is related party, be it a person or an entity. Control, usually we say more than 50%, 51%. Joint control, 2 persons put together. Of course, they has to have a contract among themselves, or there has to be significant influence. Usually we say more than 20% of shareholding, means the investor will have a say, will have an impact on the decisions of relevant activities of the investee. And then there is something called as key management personnel. Who is this key management personnel? Who will have all the keys, like watchmen? They are the ones who have all the keys, who have the authority as well as responsibility for planning, direct controlling, basically the managing director of the organization. Close member, as I told you, they don't use the word relatives, they use the word close member. Very interesting definitions. Children, okay. Spouse, okay. Domestic partner, you have to understand the background in which they are coming from. Brother, sister, father, mother, okay. Children's okay. Children of that person's spouse or domestic partner. So children, your children and your spouse children and domestic partner children, dependent on that person. You understand, no? Because their background, their culture is like that. It's very common statement where they say my child and your child is playing with our child. So those things are very common in those areas. So they don't use the word relative, they use the word close member. They don't use the word spouse, they use the word domestic partners. So person, children, spouse, domestic partners, brother, sister, they are equivalent. Top, father, mother. Then the persons, I mean spouse children or domestic partners children, or dependent on the persons, dependent on domestic partner, dependent on the spouse. So these are the related parties. Close member is what they use the word. Okay, then regarding this, how to say whether they are related or not, this has list of definition, but I'll try to share with you one quick shortcuts. Based on that, I hope you will be able to present it better. Okay, so what you are going to do is this: there are directly related parties, entity, its holding company, its subsidiary company, associate, joint venture, and KMPs. These are direct connected companies. Your holding, your subsidiary, your associate, your joint venture, your KMPs. Then because of common friend, there will be relations, mutual friends will be there. Because of the intermediate person, the two entities are related. So that in that case, you remember this rule. The common connection point may be a person, or common connection point may be an entity. The rule is this: the reporting entity will be connected provided the person who is connected to the both has got control at least in one company. In the sense, control here, these two are related. Control here, joint control, joint control, joint control, joint control here. Any possible combination the word control comes, it is connected. Where, or rather than that, we think like this: where both are having significant influence, in both places you're having only significant influence, then those are not connected, because only if you can control one, you have significant influence on one, you can make them connect. In both cases you don't have any, you have only significant influence, means those two are not related parties. So for example, if you look at the possibilities: control connected, control joint control, control associates, joint control joint control associates, associate and associates, not related. And if it's KMP here and control here, KMP, you treat it like a significant influence for the purpose of applying this shortcut. This is what is about the standard. Of course, there are some more points, like some government entities are exempted, some things are there. And if ultimate parent is subsidiary, then the intermediaries are exempted. So those kind of also things are there. I don't want to confuse too much at this point in time. Any basic conceptual doubts you can ask. And common entity, if it is a common customer, then they are not related. Common director, they are not related. Common member of maybe chamber of commerce or some unions, you are consuming electricity from same board, you are not related. No. Bescom is giving the electricity for me also, for him also, we are related. No, that is, no, the standard says it, the common ship should be through these definitions. And KMP of your company is also related. KMP of holding company is also connected with you. And one more thing, even fellow subsidiary is also related. I mean, you are part of the group. Associate is not considered as part of the group. Any holding company, fellow subsidiary, they're all part of the group and they are related. Okay, let's take up some problem. S Limited, wholly owned subsidiary of P Limited. S Limited at the top, below that P Limited, is the sole distributor of electricity to consumer in specified geographical area. A manufacturing facility of P Limited is located in the said geographical area, and accordingly P Limited is also consumer of electricity supplied by S Limited. The electricity tariff for the geographical area are determined by independent rate setting authority, are applicable to all consumers, including P Limited. Whether the above transactions required to be disclosed as related party transaction as per Ind AS in the financial statements of S Limited. Basic point is this: S Limited is the holding company. No, is the wholly owned subsidiary. S is the subsidiary company. Oh, S for subsidiary, P for parent, P holding company. And they are also supplying electricity. and to everybody in the area, the subsidiary company, holding company, also they consume the electricity. The tariff are not decided by the companies. Tariffs are decided by some authority, let's say, yeah, some independent rate setting authority. Since the tariffs are determined by the outside party, should the transaction between holding and subsidiary be exempted? I mean, from reporting? The answer is no. It is a transaction between holding and subsidiary. The holding, who is providing the P Limited is located in Joyfully, supplied by S Limited. So subsidiary company is giving electricity to everybody, and they are also giving it to the its holding company. It's a transaction between holding and subsidiary. Whether the rate is in the normal course of business, rate is high, rate is less, somebody else fix the rate, or rate is unfair, not fair, those kind of thing does not matter. Ind AS 24 does not exempt, because they have been carried out on arm's length basis. That is not an exception basis. The objective is not to report an arm's length. The objective of this standard is just to report of related party transaction. It is left for the users to make the decision whether it is arm's length or not. The arm's length is not any exemption, so it does not matter. So you still have to report as reporting entity. Okay, that's all about this question. Any other doubts you have in related party transaction? Okay, so the next standard is EPS, earnings per share. Again, from the name only you can remember the number, because if you turn it, it looks like 3 only. It is 33 earnings per share. The first letter is E, last letter is also E. Just turn it out upside, turn left to right, it becomes 3. Okay, earnings per share is again carry forward from your previous life. But what conceptually you have to understand is there are 3 types of EPS. Just like you have 3 tense in your life. That is present tense, basic EPS for the year. Past tense, that is adjusted EPS, previous year EPS restated for the purpose of comparison. Future tense, that is potential EPS that could influence the EPS because of the situations such as convertible debentures, convertible preference share, stock options, share warrants, like that. So current period EPS, the formula is the numerator profit after tax or profit attributable to shareholders, equity shareholders, divided by number of shares or weighted average number of shares outstanding. There will be situation where shares are issued during the year. You take proportionate to the extent of number of months outstanding. There might be partly paid up shares. You take only to the extent of paid up equivalent units. There might be situation of bonus shares. The date of bonus shares issue does not matter because it is just a book entry. There is no actual cash inflow or outflow. Therefore, it is assumed that the bonus share is issued in the first day of the year for basic EPS. And for adjusted EPS, it is assumed it is issued on the first day of the previous year. And if you prepare 3 financial statements, it is assumed that bonus is issued on the first day of the earliest financial year available. So basically, if bonus shares are there, it is assumed it is issued on the first day of the year in which company is formed. That is what effectively that means. Otherwise, it's not comparable. Bonus shares, again, we can talk about the share price connection. Let's not talk about it. Adjusted EPS comes mostly in 2 cases. One is bonus shares, other is in right shares. Right shares, we have to calculate something called as the correction factor, or also called as the adjusting factor, and which is calculated by numerator fair value of the share before issue of right divided by fair value of the share after issue of right, before and after. That's called as cum right, x right. X right means excluding the right. That formula is calculated by numerator the existing shares into fair value plus the right shares into the right price divided by total number of shares. Basically like an average price. The average price after issue of right, denominator x right, numerator before issue of right, that's ratio, it's called as the adjusting factor. The adjusting factor is applied up to the point in which the right shares are issued. So previous year it is applicable for full year. the correction factor in the current year, it is applied only up to the point in which the right shares are issued. The moment right share is issued, full number of shares you take, then multiplied by proportionate number of months. Dilutive EPS is applicable in situation like convertible debentures, and in those cases we have to see whether the impact is dilutive or not. For that we calculate incremental EPS, which is numerator incremental profit after tax divided by incremental number of shares. Incremental profit after tax means the interest savings multiplied by 1 minus t. Denominator incremental shares attributable to conversion of debentures into shares. If that incremental share is less than the basic EPS, then it is said to be dilutive in nature. That we will consider in calculation of dilutive EPS. We have some other things such as contingent shares. Like we had one problem of retail contingency. The one problem is there in the material. I have released a separate video on my YouTube channel. Please watch it. I have discussed at length, including the different types of presentation apart from institute presentation. Concept is, if conditions are satisfied, it will be part of basic EPS. If conditions are not satisfied, still contingent in nature, it will be part of dilutive EPS because it is potential, not yet satisfied. Basic structure is this. Please watch that video regarding that retail contingency, that problem. You will get more idea. Protective rights, substantive rights will not have any impact here. Whether it is potential, it will come. Whether it is protective, substantial, that will not have any impact. As long as you are able to understand what the impact on profit, what the impact on number of shares, that will be part of dilutive EPS. Okay, let's take up some problems to understand some areas of this standard. Okay, so let's take up this problem, exam problem, July 2021. On 31st March 2019, the issued share capital of B Limited consisted of 20 lakh ordinary shares of ₹1 each. On July 1st, 2019, the company issued 25 lakh 8% convertible loan for cash at par. We are on 31st of March 19, so next year, in the year 1920, after 3 months, they have issued convertible loans. Each of ₹100 of the loan stock may be converted at any time during the years ending 2024 to 2027 into the following ordinary shares set below. If you convert it on 31st March 2024, you get 135 shares. If you convert it on 2025, you get 130 shares. If you convert in 2026, you get 125 shares. You get 2027, you get 120 shares. So many shares you get. As you delay your decision, the number of shares keeps getting reduced. So earliest you exercise, you get higher shares. And the latest, oldest you exercise, you get less number of shares. But the problem is, earlier now the value per share may be less, later value per share may be more. That is a decision as an investor you have to make. If the loan stock is not converted by 2027, they would be redeemed at par. Then we can't give more time. Please close it. It is assumed that the return equity conversion option is accounted for as a derivative liability and marked to market through profit and loss. The change in the option fair value reported on 31st of March 2020-21 amounted to loss of 5,000, 5,300 respectively. 20 is the first year, 21 second year. Further, it is assumed that there are no tax consequences arising from these losses. God bless them, no deferred tax impact. The profit before interest, fair value, movement and the taxation for the year amounted on 31st March 20 and 21, 16 lakh 50, 17 lakh 90 respectively, and relates wholly to continuing operations. The rate for tax both the years is 33%, including cess and surcharge if any. Calculate the basic and dilutive EPS for the year 2021. Okay, let's do the easier one, which is basic EPS. Profit we have 16 lakh 50,000. and 17,90,000 we have to this is profit before interest. So first you should subtract interest, subtract tax, profit after tax you arrive, then you divide by number of shares, you give you basic EPS. And that too, please observe, it is issued on 1st of July 2019. On CA day they have taken loan, they have issued loan. So you are going to calculate interest for a period of 9 months from July to 31st of March. So 25 lakh into 8% into 9 by 12, 1,50,000. And this year, next year you don't have to do into 9 by 12, you can take the full 2 lakh. So that's what they have done. 17,90,000, 16,50,000, subtract the interest, bracket is missing. Then the change in fair value, yes, I forgot to tell, this loss change in fair value, this is before fair value change. So in financial instrument we discussed fair value change should be reported. So loss, subtract 5,000 and 5,300 respectively. I assume it is not cumulative in nature. Have they given fair value change or just a fair value? Change, okay, they have given specifically. The change in the option fair value is this. Otherwise, if they tell you fair value 5,000, 5,300 means I will take 5,000 in the first year, 300 in the second year. If they use the word fair value, they use the word change in the fair value. So clearly they have given the change directly. So 5,000 is a loss in previous year, 5,300 is a loss in the current year. You get profit before tax, subtract profit, subtract tax, you get profit after tax. Divide by number of shares, you will get basic EPS. This is a straightforward one. This is a basic EPS. Still, take a look at this. See if you have any doubt in the calculation part of it. The option to convert from loan to shares. The company has given the option for the borrower to convert the shares into options. That option value they are valuing, the option to convert. So when you give somebody else the option to buy the shares from your company, it is actually you are going to sell the shares. You are having obligation to sell the shares. Indirectly, like you are a option writer, and that option writer fair value they are changing. Call option to be specific, you are having obligation to sell. Okay, this is regarding the basic EPS. Then going towards dilutive EPS. Dilutive EPS, don't straight away go and calculate dilutive EPS. First you have to understand the impact. Is it dilutive in nature? For that we calculate incremental profits by incremental number of shares. Let's see whether it is basic EPS comparison purpose. So to test whether the convertible are dilutive, the saving after tax resulting from the conversion amounts to 100 into 8% into after tax. 33% means after tax 1 minus t will become 67%. So 100 into 8% into 67% into number of debentures. I think 25,000. Yeah, 25,000, or you could run directly. 25 lakh into 8% into 67%. How much you get? Oh, they are doing it on per share basis. Does not matter. Let's do in our way only. 25 lakh into 8% into 67%. 1,34,000 divided by number of shares. Number of shares will be 100 each. So 25,000 shares. You get 5.36. They have done directly on per share basis because the ratio is 1:1. The 1 share 1 debenture, they did directly 5.36. Okay, so 5.36 is the incremental per share basis. But what is the basic EPS? Oh, see, this is higher, no? Then just 1 second. Uh, okay, and then what the standard says is, this is the existing number of shares which we are going to issue, and if there are any possibility of issuing more number of shares, you take the maximum possible shares possible, because dilutive EPS is what we want to report. So number of shares as much you show, the EPS will be as less as possible. More number of shares, EPS will reduce. So among these four possibilities, the maximum possibility is 135, again on the prudent basis. So we will take prudent basis as 135. So 5.5, 5.57, what is it? 0.21 is that, have they taken any fair value have added back? Yeah, that is also making sense, because when you convert into share, this fair value changes, you're not going to account for it. So 5,300 divided by 25,000. Oh, they have done it here. 5,300 by 25,000. Or what you would have done, what we, okay, on this they're assuming no tax impact. Yeah, there is no tax impact, no, because this is not allowed for tax purposes. So what you do directly, let's forget about their calculation for the time being. Let's do it once more. 25 lakh multiplied by 8% into 67% plus 5,300 divided by 25,135. Directly you can divide. No, 25,000 is existing plus 135. 25,000 shares and 135 additionally you are going to issue it. If you are converted during this period, these number of ordinary shares you get extra. Therefore, you can directly divide by 25,135. So will you get this number? 4 paisa something? Are you getting it? 0.004. Just try it once more. 25 lakh into 8% into 67% plus 5,300 divided by 25,135. Okay, 5.54. Why? How come they are getting? No, here they have divided again. There, no, then 5.57 they got. Then they divide by 135. You get 5.57 by 135. Yeah, that's what you get. That's in 4 paise. Maybe there's rounding off involved. Maybe because too many spices are there. Maybe for that reason. Let's not worry about it. Okay, we got 5.57. We got 135 shares. 5.57 rupees by 135. Hopefully you get that 4 paisa. And 4 paisa is definitely lesser than 53 paisa. So it is dilutive in nature. While adding the previous year, you should be careful. Please take a look at this. This is profit given 10 lakh 60,000 and 10 lakh profit after tax, right? 10 lakh 60,000 and 10 lakh. And we add back interest 2 lakh. And here we add back only 1 lakh 50,000. Here we add back 5,300. Here we add back 5,000. Tax relief 30% on 2 lakh, 33% on 2 lakh, 33% 1 lakh 50,000. Adjusted earnings equity and divide by number of shares. How much number of shares we will divide? In the current year, we will divide by existing number of shares is 20 lakh plus the number of shares what we consider, some 25,000 something, right? Yeah, 25 lakh. No, okay. This is not 25 or 135. That's why we not get the answer. It's 135 for every 100 shares. This is not each rupee 100 nominal of the loan stock may be converted at any time during the year into the number of ordinary shares. So the number of shares is not 25,000. So what you should do is 25 lakh. So one debenture will give you 1.35 shares kind of thing, approximately, or 100 each, or this one each. What is the loan amount? Okay, 25 lakh rupees each at par at rupees 100 of the nominal value. Okay, so rupees 20 total number of shares, if I analyze 25 lakh divided by 100 multiplied by 135, that will be the number of shares actually going to be issued. 750 shares. Okay, into 100 means you get 33 lakh 75,000 shares. For every 100 rupee face value, you get 135 shares. For 25 lakh, so 25 lakh by 100 into that 135. I don't know whether you're confusing. I'll just explain once more. If the face value is 100 rupees, I'll say rupees hundreds. Number of shares 135. And rupees, how much the loan amount? 25 lakh. So number of shares 25 lakh into 135 divided by 100. 33 lakh 75,000. Maybe this number, if I take it, our per share also may come. Let's try it out once. 33 lakh 75,000, right? That number. Okay, let me write it. Okay, then try it out from the beginning. 25 lakh into 8% into 67% plus 5,300 divided by not just 33 lakh incremental, no, correct, divided by 30 lakh 75,000. Yeah. Now I think we get that 0.044 paisa. Please write down somewhere so that you can connect it later for this question. Hope you got that 4 paisa. I'm not sure how they got it, but anyway, we got the method by using the 33 lakh 75,000 shares. So when I divide by the when we are computing dilutive EPS, what process we are going to apply? 11 lakh 99,300 divided by 20 lakh existing shares plus 33 lakh 75,000, that 53 lakh 75,000 we are going to divide. This is fine. Previous year you should be careful. I will not take 33 lakh 75,000 because interest expense I took only for 9 months. The number of shares also I should do 9 months. So 33 lakh 75 into 9 by 12. Because previous year interest rate paid only for 9 months. Number of shares also should be for 9 months, proportionate. What I'm trying to tell you is, when I do profit after tax plus interest, denominator number of shares existing plus what is converted. When you do interest only for 9 months, this conversion also should be done for 9 months. That's what I was trying to refer. And these things you don't have to worry, because as per dilutive EPS concept, we should take whatever is maximum possible number. If it was reverse, like 120, 125, 130, 135, I would have taken 135 only. So basically, I want to make sure that when I'm reporting EPS, it should be as less as possible. Number of shares should be as more as possible. So read this sentence. I also did not read carefully. Each of rupees hundreds is giving 135 shares. So number of shares is 33 lakh 75,000. Which one? No, you're saving interest. When you convert the loan into shares, interest no longer payable. You save it. You pay more tax. Correct. You pay more tax. Interest will increase the profits. Oh. Avoidance of saving in tax. Actually, what you can do is you can directly start from 17,90,000. No, we have subtracted interest, we have subtracted fair value, then subtract tax. Rather than that, I'll start from this number and subtract tax. That interest, savings and all would have taken automatically. I mean, if you want to do that, but in some other problem, this information may not be there. Also, this 33%, just check on what amount they have calculated. I would like to verify that. 33% on, not on 15,84,700. Spend 1 or 2 minutes on this. It is not on 15,84,700. It is 33% on 15,90,000. Because this is not allowed for tax purpose, and therefore while adding also I have taken only 5,300, and here I have not done into 1 minus t. While calculating tax, I have not subtracted tax on 5,300. While reversing also I will not add. Vice versa, both places the tax impact will not be considered. Because they said ignore deferred tax. Had we considered deferred tax, this would have come. On this also would have taken tax impact. Anyway, they made at least one help by telling that apply that point carefully. In fact, there was a typing error in the institute material. A similar question was there in the study material. They applied in the question they said no tax impact, but in the answer on 5,000 also they applied tax rate. That was a mistake. If you have slightly old material, that mistake still was there, and then later they have rectified it. So hope you got this point. 17,90,000 minus 2 lakh. On that you apply 33%. That means on 5,300 it is not allowed for tax purpose. Similarly, while calculating this dilutive impact as well, here also you see 5,300 I have taken, I have not multiplied by 67%. Okay, I'll go further. This is MTP exam question. Not exam question, but can be exam question. Again, these are all not in the regular course of business. Extraordinary items. So it can be asked in exam. Okay. Sohan has been recently hired in Zio Life Limited. Since he is facing difficulty in computation of EPS as per Ind AS, guide him by discussing the steps for calculation of basic EPS and diluted EPS along with necessary computation for year 1. Following basic facts relating to Zio Life Limited. Net profit for the year 1, 46 lakh. Number of shares outstanding on April 1st, 30 lakhs. Following facts are also relevant. On April 1st, Zio Life Limited issued 20 lakh 3-year term convertible bonds to rupee 1 each. Okay, let's not do any mistake here. Let's read once more. Issues 20 lakhs convertible bonds for rupees 1 each. So face value 1 rupee each, face value of debenture bond issued 20 lakh. Convertible we don't know. Let's read. Zio Life Limited has an option to settle the principal amount in ordinary shares. every 10 bonds are converted into 1 ordinary shares. So 1 by 10 into 20 lakh, 2 lakh, or cash on settlement date. That is what the obligation to pay cash may be. The principal amount of the bond is classified as equity instrument. Principal amount of the bond is classified as equity instrument, and the interest is classified as financial liability. The interest expense relating to the liability of the bond is 1800. Interest is tax deductible. Applicable tax rate is 40%. Okay, let's first understand on the basic EPS, and then we'll worry about the dilutive EPS. Now, basic EPS, we have profit after tax 46 lakh. Should I subtract any interest expense? No, when they say net profit, it would be after interest expense. So that would not have any impact on the numerator, profit after tax. Divided by number of shares. Number of shares is existing only. The possible number of shares and all, we can't take it. So we'll just go with 30 lakhs. So 46 lakh by 30 lakh, that would be the 1.53 for basic EPS. Tax, this is any profit. Net profit means after tax only, no? So net profit would mean after tax, so that is straightforward thing. As far as the dilutive EPS is concerned, we want to understand whether it is first of all dilutive in nature. So we need two things: incremental profits and then incremental number of shares. The interest expense is 1800. 1800, is it 1000 something or just 1800? It's not even rupees in thousands. Okay, can't tell. Tax rate is 40%. So after tax means 1800 into 60%, 1080. We'll divide by the number of shares. I think this time we're not doing mistake. That is 20 lakh. Divide by 10 into 1 by 10. That is 2 lakh shares. So 1800 divided by 2 lakh. No, 1080, sorry, 1080 because 1800 into 60% divided by 2 lakh, it is 0.01. Ensure it is issued on the first day of the year. If it was issued after 3 months or something, then the interest also would have multiplied by 9 by 12. Number of shares also would have multiplied by 9 by 12. You getting it? 0.01 something? .005. They round it off to 0.01. Otherwise, too many zeros will come, so they round it off to 0.01. Whereas basic EPS is 1 point something we had got, 1.53. So it is less than basic EPS, therefore it is dilutive in nature. Then what you are going to calculate, ranking and all, don't worry. So calculation will be numerator will be 46 lakh plus 1080, denominator 30 lakh plus 2 lakh, 32 lakh. Correct. Correct. But how do you know whether it is dilutive or not? No, my question is, you calculate this EPS. What heading you give? How do you know it is dilutive before calculating it? We don't calculate it. That is why this incremental EPS is there. The incremental EPS, we divide by incremental shares. Like in this case, we got 0.01. We compare that with basic EPS. Like this 0.01 is less than basic EPS. Therefore, this is said to have a dilutive impact. And therefore, I go with next step of calculating dilutive EPS. If this itself was, let's say, 2 rupees, then I don't go to next step at all. That would have number, even after calculating, you can check, it would be more than 1.53 because it's after all average. 1.53 with 0.01, when you mix, the 1.53 will fall down for sure. If 1.53 is mixed with 2, definitely 1.53 will increase. So that is called as anti-dilutive. This is one case scenario. I'll tell you one more case scenario. you have potential debenture, you have a convertible debenture, you have convertible preference share, you have employee options. 3 are there. Now we have to report EPS such a way that think of all permutation combinations. Choose the lowest EPS possible. That is, you take only preference shares, only debentures, only ESOP, preference share debenture, debenture ESOP, preference share ESOP, or all the three. Among all these things, whichever is lowest. Like this, we can't do it. So Institute has a better method. It's called as rank the order of dilutive EPS. For that, what do we do? For these three things, convertible debenture, convertible preference share, or ESOP, what is the incremental EPS in each case? Incremental profit by incremental number of shares, incremental profit by incremental number of shares, incremental profit number of shares. You get 3 incremental EPS, rank order them. The highest, whatever the lowest number, will have the highest dilutive impacts. 1, 2, 3. If it's 5, 4, 3, which has 5 will have first rank, 4 will have second rank, 3 will have third rank. The highest number, the lowest number will have the best rank. That is 3 will have the first rank. Lower the number, higher the dilutive impact. And then what do? You start with basic EPS. You take the first rank alone. You add a net profit number of shares and check the number. Obviously, it will be below the basic EPS. Then come to the second step. At the second rank, add the number of shares, add the incremental profit to the previous step, cumulative in nature. And if this number is above the previous number, not the basic EPS, above the rank 1, and then I will stop at previous one itself and say previous one is a dilutive EPS. I will not even go further. So I don't have to go to third criteria, because second step only, second rank only is not a dilutive in nature. Individually it may be dilutive, but cumulatively it is not in a rank ordering process. The first one only would have become the first. After writing the first line, you got one dilutive EPS. That would be the dilutive EPS to be reported. Imagine one more point. Okay, first basic EPS you started, then first rank you got, the value reduced. Second step you started, again the value reduced. You went to third step, but the value increased as compared to previous one, not as compared to basic one. Then third step I stop it, which means after the second step only, that is where my basic EPS to be, dilutive EPS to be reported. No, why? That is the most dilutive impact. When you consider the next one, that will be further dilute. No, that number can be further dilute, not the basic EPS. Not sure whether you are getting the point. Let's see. You think on a cumulative basis. See, first you got basic EPS. You got profit after tax divided by number of shares. Basic EPS. And first step, what do you do? Plus whatever incremental profit of the most dilutive one, plus the additional number of shares of the most dilutive one. You get second number. Third step, I do plus incremental by number of shares. This number, answer what I am getting, I don't compare with the basic EPS. I compare with the previous step EPS. That can fall further, the previous EPS. First step I do only to determine the rank. But this is cumulative in nature. Cumulative in nature means I keep adding the profit, I keep getting the shares. What is my EPS? Go to next step. Cumulatively you add to the previous step, not to the original number of shares. So I'll start with basic EPS, then EPS with first order. I get EPS with first and second order. Then I get EPS with first, second and third. So I keep cumulatively adding to the numerator and to the denominator. The moment the EPS starts increasing, I will stop at that point. The previous EPS would be reported as dilutive EPS. Rank order of dilutive EPS. In the material only it is there. Look at the previous question, November 2020 exam question. Just the previous question, it is there in the material. Anyway, November 2020 is the exam question, you can check it out. Ind AS 108 operating segments. I think by this time everybody, our body parts would have segments, would have been separated one by one. And you know that at least in this city, when we have a problem, we call ambulance. The number is 108, where the bodies are ready for segmentation. Okay, Ind AS 108, segment reporting, AS 17, we had segments. The best part about is what is a segment? The standard does not say it. It is identified by CODM, Chief Operating Decision Maker. So they will decide what is operating segments according to the reporting purpose internally, how you define risk and reward criteria, that will be the basis. It may be geographical, product based, any way you want to divide it. But what we have to understand from exam point of view is which are definitely reportable segments. There are some quantitative threshold. That is what I would like to discuss. Quantitative threshold as part of A17 as well. And in the exam, if they ask you, write short notes on materiality, whether accounts or auditing paper, you can make use of these as examples. This is how the materiality has been quantified to tell that this segment is material which needs reporting. Which are those reportable segments? If segment revenue is 10% or more of the overall revenue. So if overall revenue is 200 crores and 10% of that means 20 crores, 20 or more. If any segment is having more than 20 crore revenue, that is important segment, we have to report it. Or if not revenue based, you can go profit based. But the profit based problem is some might have profits, some are losses, so you group them separately. The profit segments and the loss segments. But the loss segments, it will be negative, so ignore negative. You take absolute numbers, whichever is higher of that 10%. For example, you have segment A, B, C, D. A, B is having, let's say, 200 and 100. C is having minus 30 and minus 500. So we are going to group all the loss segments together, 530. All the profit segment together, which is 300. Among these two, whichever is higher, 530. Of this 10%, 53. So whichever is more than 53 becomes reportable segment. 200 reportable, 100 reportable, minus 30. Minus not important. 30 is less than 53, not reportable. 500, obviously the bigger one is reportable. Minus 500, ignore, make it as absolute segments. Or of the asset side, 10% total assets. Only thing, keep it in mind, when we say assets, it will not include deferred tax. Income taxes are not part of segment assets. Or this one is interesting. You, after applying these conditions, check if you are able to demonstrate at least 75% of the revenue are covered in the above points, above criteria. If you have not explained at least 75% of the revenue, then you have to add some segments in the opinion of the management such a way that it will give the report regarding at least 75% of enterprise revenue. So for example, let's say entity A is having, let's say, 50%, and B is having 5, C is having 5, D is having 5, E is having 5. Like that, there are 9 segments, 10 segments are there, whatever A, B, C, D, F. So 10 into 50, 50. So which will be the reportable segment now? Only A will be reportable segment because crossing 10%. Remaining 5% below 10% not reportable. But you have to choose some segments or combination of segment, at least 75% is reported. Maybe B, F, H, I, K, L, whatever segments put together, you have to reach 75%, like our passing criteria. We have to reach aggregate. Somehow this aggregate you have to achieve by using any combination of the segments, so that at least 75% should be passed. In fact, the CPA pass percentage is 75%. If you want to pass CA in USA, the pass percentage is not passing percentage, it's passing marks. It should be 75%. Of course, there are only 4 subjects over there. And if it's reportable in the previous year, for these conditions, it will be reportable in the next year also. Or any other segment, if the management want to report, they are definitely welcome to report it. So this is about major areas of reportable segments. And again, format will be like your departmental accounts. Like if you prepare notes to account segment 1, segment 2, segment 3 is the sales expenses, or you may have to provide reconciliation also, unallocated revenue, unallocated cost, the total revenue or the total assets, like that. Notes to accounts. Notes to, it will not be mixed with P&L accounts. No, revenue, segment expense, profit, segment asset, segment liabilities. All of them. They you have to show like A, B, C are reportable. So segment A asset for A, B, C, unallocated total. You have to provide the reconciliation also. It may be subsidiary also, it may be department also, it may be product also, it may be geography place also. The way which is being, we consolidate in consolidate fund statements, but in separate fund statements, you still have to report it. So, for consolidation also will apply, for separate also will apply. For separate statements, only inside that you might have a products. A company might have FMCG segment, might have cloth segment, might have retail segments, and they have chemical segments. If you think of ITC, they have tobacco division, you have FMCG, you have restaurants, hospitality business. It may not be a separate entity. It can be a separate entity in consolidation, but it can be a separate segment, as you have to inform the user, just like you evaluate internally. Internally, while making decision, you decide whether this product should continue, this segment should be discontinued or not. We evaluate the performance by looking at their parameters, the sales ratios, maybe number of customers, expenses. Internally, what you do, that will have more impact while deciding whether that is a operating segment or not. No, these are the minimum. Beyond this, anything you want, you can report. That's why last line, as decided by management. That is, anything you want to report extra, it is welcome. These are the minimum threshold requirements. In the sense, when this will apply? Forever. Ind AS will be applicable for everybody. Anybody for whom Ind AS is applicable. If you have a segment, if you have a segment, again, that whether you have a segment or not, the standard will not force you. You take a call. How do you want to report to the shareholders? It's more of an internal. That's why it's as decided by CODM, as decided by Chief Operating Decision Maker. As he sees it, they would like to report it. They will have some KPI, key performance indicators. So they have their own parameters to analyze internally. Keeping it in mind, you can analyze whether it is a segment or not. T Limited is engaged in transport sector, running fleet of buses at different routes. If you go to maximum extent, every bus can be different segments. If you go to the too much of in-depth, every bus can be different segments. That's where you have to apply the judgment regarding what to combine and what to be separated. Like CGU impact also you can say. T Limited has identified the 3 operating segments: local route, intercity route, contract hiring. Makes sense. Local, outside the city, and then contract. The characteristics of each segment are as under. Even in our I think government we have this, no, BMTC local, KSRTC, then we have hiring things are also there. Anyway, segment 1, the local transport authority awards the contract to ply the buses at different routes for passengers. These contracts are awarded following competitive tender process. The ticket price paid by the passengers are controlled by local transport authority. Usually the case, the buses rates, the fares are usually for middle class, lower class people, so it will be controlled by authorities. T Limited would change the local transport authority on a per kilometer basis. Would charge the local transport authority. Why would they charge? T Limited would charge the local transport authority. Why will you charge? I don't know. Let's see. They will charge. No, authority should charge the T Limited. Okay. T Limited operate buses from one city to another. Segment 2, the prices are set by T Limited on the basis of services provided. Usually the intercity and all, the government usually will not fix it much. It is left to the private operators. Deluxe, luxury, superior. Segment 3, T Limited also leases the buses to schools under long-term arrangement. I think especially you see the Infosys bus. Many people thought the BMTC is Infosys also, that there are so much buses under Infosys contract. While segment 1 has been showing significant decline in profitability, segment 2 is performing well in respect of higher revenue and improved margins. The management of the company is not sure why is the segment information relevant for users when they should only be concentrated about the returns from the overall business. They are telling, why are you bothered about individual segment? What you want is total. We are preparing P&L accounts. Like that, if they give you marks card, imagine in CA exams, total marks 202, group 1 result fail. We want to know the breakup also. They would like to aggregate the segment 1 and segment 2 for reporting under operating segment required. Okay, that's the question they want. Whether it is appropriate to aggregate segment 1 and 2 with reference to Ind AS and discuss in the above context where disclosure is relevant, what disclosure would be relevant in appraisal of financial statement. So this concept is called as the aggregation criteria. The aggregation is possible provided they are similar. Similar in the nature of, in the case of nature of products, production process, types of customers, method used. Now again, all these cases, can we say they are similar? If you want to argue similar, all the three are similar only. All our buses, all our passengers, all we charge and you collect the money there. So in that sense, there is no and also in case of local route, who will fix the prices? The authorities. And intercity route, the company only will fix. I think in that way also the pricing mechanism is different. Maybe the competition is different. It looks like it is all different manner. T Limited is exposed for passenger revenue risk as its set presides, which customer may or may not choose to pay. I mean, in the sense, if you increase if you increase the price, they may not come. That's what they meant. The English is like that. So if you are increasing the price, the passenger may not come, so you are at revenue risk. That's what they meant. Operating segment provides information that makes financial statements more useful to investors. How management divides profit is therefore relevant information to the investor. Okay, so inappropriately aggregating segments reduces the usefulness. Basically means you should show the segment 1, segment 2 separately. Combining would not be appropriate. It will be useful for the investor only if you make a separate disclosure, segment reporting. So basically, after this, what you have learned, once the result comes, so if parents ask what happened, tell them FR I got, SFM I got, law I got, so that they understand that you can pass in all subjects, but still you can fail. Yeah, normal human being can't understand. It happened to one of my friends in my intermediate. We had 6 subjects then. Intermediate exam had come, the result also had come. Then my friend called his parents. I cleared all 6 subjects. Next time I have to write all subjects again. Normal human being can't understand. How can you pass and still be failed? So that is basically, we have to understand passing a subject is different from passing a exam. Okay, so that's about this. Let's take up next one. Super Sounds Limited had the following transactions during the financial year 1920. On 1st of April 19, Super Sounds purchased the net assets of Music Limited for 13,20,000. They purchased net assets. So again consolidation, no? Somehow. They purchased for 13,20,000. The fair value of net identifiable asset is 10 lakh, which means the goodwill is 3,20,000. They have not given NCI. I hope it is 100%. Super Sound Limited is of the view that due to popularity of Music Limited's product, the life of goodwill is 10 years. On 4th May 2019, 1 month later, Super Sounds Limited purchased a franchise. Is this intangible assets or what? Is this intangible section? No, have I included the question here wrongly? It is more of an intangible question. Anyway, we started it. Let us complete it. In the exam which started, it does not matter, but still. So Super Sounds Limited purchased a franchisee to organize musical shows from Armand TV for 80 lakhs at an annual fee of 2%. The franchisee expires after 5 years. So 80 lakh will be spread across 5 years. The musical show revenues 10 lakh for the year 1920, and project revenues, future revenues are 25 lakh and 30 lakh for remaining 3 years. So we can divide in the ratio of the revenue there. On 4th July, Super Sounds Limited was granted a copyright that had been applied by Music Limited during the year 1920. Super Sound Limited incurred 2,50,000 on legal cost to register the patent. This also will be capitalized, and 7 lakh additionally to successfully prosecute a copyright infringement suit against a competitor. This also will be capitalized. Life of the copyright for 10 years. Super Sound Limited follows an accounting policy to amortize all the intangible and straight line method basis or any appropriate basis over maximum period permitted by relevant in days, taking full year amortization in the year of acquisition. They are required to prepare a schedule showing, because of schedule only, I think it looked like a segment reporting. Schedule showing intangible section, a schedule showing related expense in the balance sheet and P&L account. Okay. What and all will be shown? Let's look at the format. You acquired goodwill 3,20,000, that is 13 lakh 20 minus 10 lakh. 3 lakh 20 you acquired, and here you acquired 80 lakhs, and here 2 lakh 50 plus 7 lakh. Anything else? Copyright value only they have not given now. Okay, whatever we have. So it should be 7 lakh also will be capitalized. They have not capitalized. They have taken into legal cost. Okay, let me read the sentence once more. They incurred 2 lakh 50 on legal cost to register a patent and 7 lakh additional cost to successfully prosecute a copyright infringement suit against competitor. Okay, this is a controversial point. When this cost was incurred, is it cost incurred during the process or just before the patent, or is it after registration of patent, after some months you have defending this suit? The question is not specific, so you have to make an assumption. They have assumed it is subsequent. You can assume it is during the course, and this also can be capitalized. So okay, let's go with whatever they have done. 3 lakh 20, 80 lakh and 2 lakh 50,000. Then you provide the accumulate whatever the expense and goodwill. I know it is over a period of 10 years, but I can't do divide by 10 because goodwill is tested for impairment. We can't do any amortization of goodwill, not allowed. Only impairment testing is done. Whereas this is proportionate over number of years. So how do you calculate? The amount spent is 80 lakh in the ratio of 10 is to 25 is to 30, 30, 30. Divide that number. Maybe they have shown some calculation here. Or they have divided by 5 years, so straightforward. Yeah, there's a reason, because usually the standard does not allow based on the revenue. The standard intangible asset standard says you should not take the revenue as the basis. Cash flow basis you can take, number of units basis you can take, any other systematic basis, but revenue usually they will not take it because revenue comes from many other items, not just maybe this. Anyway, so they have taken divided by 5, easier one. You also go for it. 80 lakh by 5, 2 lakh 50,000 by 10. That's how they got the closing balance. And the legal cost entirely they have transferred it to the other expenses in P&L account. Okay, so this problem, July 20,000 to 2021 question, it was asked earlier also, looks like a very big problem. So let's take up this one. So when something is big, actually simple, they keep asking such questions. U Limited is operating in paint industry in the business segments comprise of paints, wall paints, lead paints, zig paints, aluminium paints and others consisting of primer, varnish, thinner, related products. Certain information for the financial year is given below: paint, external revenue, GST, other operating income, result, asset, liabilities, paints and others. So only we will have basically 3 columns: paints, others, total. Unallocated income, net of expenses, interest and bank charges, income tax expenses, current tax, deferred tax, unallocated investments, unallocated liabilities, depreciation amounts for the plant and others, capital expenditure for the plant and others, revenue from outside India, and segment assets outside India. Based on the above information, how you, limited, would disclose about the reportable revenue, profit or loss, asset and liabilities, and others for the year ending 2021. Ignore corresponding figures for the previous years. So we will report in 3 columns. So external revenue will be 10,000, 3,500. You see 10,000, 3,500, 13,500. GST inclusive of that, so I'll subtract 250, 150, total 400. You get the net revenue. Expenses, I don't have information. I'll show the operating income: 2,750, 2,750 total operating income. Then total income will be 9,750 plus 2,000, 3,370 plus 750, and total will come. Expenses, we don't have information. Ideally, we should show that as well. Whatever the revenue minus expenses is the profit. Result is what they told. Result 500, 200, 500, 200, 700. Then unallocated income means that could not be taken to any of these things, so I will take it additionally. This is rupees in lakhs, so ignore all these zeros. Lakhs means ignore 5 zeros. So 150 is added here, unallocated. That will give you the income side. And so total profit will be 700 results. Unallocated income 150, so total income will be 850. This is regarding the income sides. Just take a look at this income side. See if anything is odd to understand. Profit. Income minus expenses, they use the word results. Results means profits. Ideally, what should have happened? Revenue should be this line. One more line should be expense, and then we get the profits. That should have been the process, but information on expense not there, only profit directly. So profit before interest, tax, depreciation. Then you keep subtract income tax, okay, given interest and bank charges, keep subtracting it. You have got EBIT basically, profit before interest and tax. Subtract interest. Interest is this 1 crore. Take out the zeros, 100. Then you subtract income tax expense, that is also 1 crore. So 1 crore you subtract interest, 1 crore you subtract tax, income tax. So totally you get profit after tax as 650. This will complete the information regarding the income statement, P&L account. Come to balance sheet side, assets information: 2,500 paints, 1,500 others, unallocated investments 500, and other assets 500. That's what you write it here. So segment assets, then unallocated investments, unallocated other assets. So total assets is what you will get. Regarding liabilities, 1,500 for paints, 500 for others. Or liabilities, what else we have? Unallocated liabilities are 10 lakh, 15 lakh, 5 lakh. That's what you write here. Segment liabilities 1,500, 500, then 1,000, 500. Total of these amounts: 1,500 is reserve surplus, shareholders funds, 2,000 plus 1,000 plus 500 plus 1,500 reserve surplus, 2,000 plus 1,000, 3,000 plus 500 plus 500. Total of liability and shareholders funds 5,000. Then other information, that is just information: depreciation, capital expenditure, just information for 2 segments. They also given information on revenue from outside India and the segment assets outside India. That also you can show as information. Geographical information: India, outside, total revenue within India, outside India, segment assets within India, outside India. Capital expenditure, that is, and that you can ignore, that's fine. So this looks like a big problem. Essentially what you are doing is preparing in a columnar format. You provide for the revenue, expenses, profits. Any unallocated income also you add, then you keep subtracting interest and tax, you get profit after tax. Regarding assets also, segment A, segment B, then total unallocated assets, then unallocated assets, total assets. Liability also A, B, total unallocated liability, share capital and surplus, you get the total liabilities. No, this is not a balance sheet. It is a notes to accounts. So the format of schedule 3 will not apply. You don't have to write non-current, current and all. It is just a information in the notes to account. So this will not have any particular format. The structure is columnar and you should show reconciliation by way of the unallocated elements. Okay, so this is about Ind AS 108. So I tried my level best to include, but we could not do Ind AS 101 and analysis of financial statements, integrated reporting and corporate social responsibility. These are the areas which I could not cover it here, but I would request you to go through it, especially like analysis of financial statements. It is a combination of all standard in one place. So you can't understand that unless you understand all other standards. Same thing with Ind AS 101. It provides some optional exemptions, some compulsory exemptions. So only if you know the existing situation, then only you can understand what is applicable, not applicable. What I would request you to is, at least whatever notes I've given, those questions try to read once before you go to exam on these areas. And this CSR, corporate social responsibility, it's a very small topic, still be asked in exam. Every attempt 5 marks is compulsory. So look at those 3 conditions and what expenses are conditions are satisfied. If you know the company law, that would be covered in detail over there. Okay, so whatever possible from my side, I have covered it. So the PDF is there, so at any time you can please use it. Any doubts at later point in time, you can message me or you can message in the group. So next we will have SFM. Would you like to come here, or if online is also more comfortable? No, it will be a live session. Okay, no problem. Fine. Okay, so that's it with respect to the FR thing. 3 days marathon sessions. I hope everybody, all body parts in proper condition. There is no impairment testing or indicators that requires testing. Okay, so we'll stop at this point. So please do well in examination. FR is important because that's the first paper. To gain confidence on all other papers, it will be carried over. Okay, I'll just conclude all my sessions. I'll do the same thing. This session also I'll tell, but any conclusion session, I would like to conclude with that statement. That is my standard format. So let me do that. Most people live as if they don't die, and most people die as if they have not lived. Only few people will be alive even after their death, because when they were alive, they made the difference to others' life. So I wish you to be one of them. Please make the difference to others' life. All the best for examinations, and thank you for your patience. So see you soon later. Take care. Bye-bye.